Good morning. Good morning. Thank you so much for joining us for the Trader Summit this morning. It is 8 hours of trading education goodness, and we can't wait to get it started here in about 8 minutes and 45 seconds. As you're coming on today, go ahead and make sure that you say hello and let us know where you're from, because we really enjoy, hello, Jeff Gibby from Utah. We really enjoy the interaction, and it really, I think you'll enjoy it too if you take the opportunity to chat and interact with our 8 presenters today. Hey, a couple things. My name is Greg. I'm the manager here at MetaStock, and I'm coming at you from the Salt Lake City studio. It is a gorgeous morning outside and a balmy 69 degrees, which is so much nicer than it has been. Couple things. Make sure if you like what you see today that you go ahead and like and subscribe. That always helps us, and we really appreciate it. And when you do that, that means that you'll be notified of our live events, which are usually about 2 a week. So don't forget to do that. Anyway, also we are sponsored today by us, as well as AAII, the American Association of Individual Investors, as well as Task Magazine, and we really appreciate those guys for coming on board with us today. And in case you don't know what MetaStock is, in the time we have before we start our main presentation, I'm going to go ahead and run a little video to just sort of introduce you to who we are and what we are, and I'll do that now.
Hi there, Greg Lewis, MetaStock Software. As the marketing director, I get asked all the time, what is MetaStock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you. MetaStock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, MetaStock is a tool for traders like you to analyze the markets. MetaStock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of MetaStock are the Power Tools. The Power Tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the MetaStock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The MetaStock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the MetaStock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love MetaStock's Option Scope. Option Scope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And MetaStock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, MetaStock explains how they work in an easy-to-follow commentary window. MetaStock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. MetaStock even has the very popular and exclusive Rahul Mohindar oscillator system, or simply known as the Armo. And as you become a more experienced trader, MetaStock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith. the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why MetaStock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about MetaStock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
All right, so I hope you enjoyed that small presentation. A couple things before we get started here in 3 minutes and 17 seconds. Oh, there goes Jeff, our main presenter. I hope he returns in 3 minutes and 11 seconds. We do want to point out that so you are either watching this, well, if you're watching it right now, you're watching it on YouTube, but you have the option of watching it on YouTube or GoToWebinar. If you're watching it on YouTube, that means you may or may not have actually registered for this event, and if you don't want to register for this event, that's okay. But we recommend that you do register for this event, because then you'll take advantage of a lot of the free bonus items that most of the presenters offer. And in order to do that, all you need to do is go to our homepage I wonder if I've got a little screen I can show you. Yeah, there you go. You go to our homepage and you select the banner at the top, and then you'll see this landing page. And this landing page is where you can register for this event. And that just means basically when you register, of course, you'll be put in our database and you'll get some emails from us once in a while. You can simply opt out of getting those emails. In fact, you can actually opt out of getting those emails right when you register. But the good thing about this is then we will be passing on your information to the presenters, who then have the opportunity to fulfill the free bonus items that they're offering. If you go to the bottom of this page, I'm not going to attempt to go to the bottom of this page because it never works for some reason on this. Oh, there it goes. So you can see where you register, and then you can see how your opportunities to get these free things. So there's that. Go back down here to me. Now we got about 1 minute and 33 seconds. Again, I do encourage you, let me hear my own voice just a second. I do encourage you to really participate. That really is what makes it fun for everybody. Answer questions, makes comments. Hey, if you have an honest, question that might be controversial, go for it. That's fine. We just ask that you don't be trolly and flamey and snarky. There's just no need for that. And if that does happen, we will suppress your comments. But otherwise, everything's good. It's all good. All right, Jeff, I'm going to start here in 50 seconds. I hope you're ready over there. I'm ready. He says he's ready. Yeah, so Jeff's just next door, getting things ready at the GoToWebinar level. By the way, our host is our very own Jeff Gibby, and our very first speaker today is going to be the very popular, very knowledgeable Steve Bigalow, who is really such an expert on candlesticks. I know you'll enjoy his presentation. Everyone always does. So for the next 18 seconds, I'm going to let you listen to some very jazzy music, and I'll go ahead and get you going here in about 10 seconds. Thank you again for joining us.
All right. Hello, everybody. Jeff Gibby here with MetaStock. Thanks for coming. I want to say hello to Joe and David and Kel and Garth and Long and DD929. Thanks for coming. As you come in, make sure to say hi. It's good to see you. Thanks for coming today. If you're watching us on YouTube, I think Greg just probably mentioned this, and he's going to type a message in the chat. If you haven't registered for today's event, you should. All of the registrations, you're eligible to get like a free magazine from Stocks and Commodities Magazine, tons of free training. And in addition to that, you'll be notified when we do other sessions just like this. So I appreciate your coming. I hope you enjoy today. We have a great lineup. So let's get underway. What I'm going to do first is I'm going to go ahead and read this legal disclaimer real quick or recite it from memory. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and MetaStock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. Hello, good to see you, Charlie. Thanks for coming. Okay, let's see. Before we start, I want to kind of throw a special thank you to our sponsors today. The first one being American Association of Individual Investors. You can find out more about AAII at AAII.com. They're an independent nonprofit organization that's been helping traders since the 70s. They've helped millions and millions of traders. Very, very well-respected company, AAII.com, if you want to find out more about them. We'll actually have Ray Rondeau in just a little bit, and he'll be talking about kind of their active investor stuff. But they're a great organization, and we're very, very happy to be partnered with AAII for today's event. The next person I want to mention is Stocks and Commodities Magazine. Stocks and Commodities Magazine has been great partners of the MetaStock Trader Summit. They've been supporting these for 10 years, ever since we started doing them. Actually, I think it might be closer to 11 now. But Stocks and Commodities is a great magazine. They've been publishing since 1982. They have over 1 million subscribers. And actually, if you're a subscriber to the Stocks and Commodities Magazine, they actually have 17,000 trading articles you can get. So if you go to metastock.com/traders-summit, traders-summit, which we'll put in the link, and register, that you can actually get a free issue. So very, very much appreciate Stocks and Commodities Magazine today. We are, of course, MetaStock. We've actually been rated #1 in our price category 30 years in a row now. But we'll talk a lot about MetaStock. I like MetaStock for scanning. You can scan instruments. You can find the right stock at the right time. You can test trading ideas. It's been rated #1 30 years straight. And pricing on that starts at about $69 a month. We'll talk about it all day long. But you can, if you're interested in doing like an extended trial where you pay for a month and get 3 months for that, you can go to metastock.com/Trader Summit 3 for 1. So I think that's good enough for us to go ahead and get started. Good morning, Sterling. Thanks for coming. Again, as you come in, say hi. I appreciate it. We like to see who you are. Our first guest today has been a partner with MetaStock for more than 10 years. In fact, about 10 years ago, we released a product called the Chart Pattern System that's gone on to be one of our most successful add-on products that we've ever released. It's gotten really, really good reviews in Stocks and Commodities from their reviewers. It's actually been rated one of the most popular add-ons for any software, not just MetaStock. And we really appreciate Steve. I've had the privilege of kind of traveling around the country with Steve, seeing Steve present, learning all about his patterns, and probably seen him over the course of our working relationship do hundreds of presentations. He's funny, he's smart, he knows what he's talking about, and we love having him on. We really appreciate all the work Steve's done with us over the years. So with that being said, let's go ahead and get him started. Hold on just a second here, Steve. Let me make you the presenter, and we'll go ahead and do that. Then I'll also turn back on like the audio as soon as I can find it real quick. Okay. All right, Steve. There you go. We should be able to hear you and see you. And I can't see your desktop, so I can see it.
Yeah, can you hear me?
I can hear you.
All right, let me hit the right screen. Oh, right here. Let's see.
I want to know if that's your barn in the picture.
Oh, no, let's see. My barn's a metal barn.
Okay.
So,
All right, very cool.
all right, can you
All right.
see the screen?
We can. We can see the
Okay.
right screen. We can see you. You're coming through loud and clear. You sound great. So
All right, good.
I'll get
Well,
out of the way.
All right, well, welcome everybody. The first thing I do is ask everybody whether they've seen my presentations before. Y for yes, N for no. That'll give me a little bit of feel for how much description I need to do on each chart or on the charts. So if you've seen my presentations before, type in Y. If you haven't, type in N. And whoop, am I not seeing anything yet?
Yeah, there's usually a little bit of a delay, but Gray is saying
okay.
yes. Ike is saying yes. Garth and YouTube is saying yes. So yeah, they're trying to come in.
Okay. Okay. All right. So mostly everybody's seen this before. However, the what I always kind of illustrate is that when I started learning candlesticks by accident over 35 years ago, I was the worst investor in the world. I'd been a stockbroker for 8 years. I got out of the business, and I discovered that the brokerage firms had no more idea about what moved prices up or down. So since that time, I've written 3 books on candlestick analysis, and the feedback we always get is that they're very easy to read, very easy to understand. My theory of investing is make it simple, right to the point. I don't need all the little fluffy stuff. So what we've discovered through the years is there are 50 to 60 candlestick signals. But when I first started learning candlestick analysis, I wanted to learn everything because I'm a greedy son of a gun, and I wanted to know what each signal and pattern was telling me. However, going through thousands and thousands of charts, I discovered there's only 12 signals you really need to learn. And the information that is built into those signals are what will give you a high probability result that there's a change of investor sentiment. So out of the 50 or 60, all you need to learn is 12, 6 long and 6 short. Oh, another thing I should add is if you've got questions as we're going along, throw them in here. We'll answer them as we're going through. So once you learn these 12 major signals, you're understanding what a high probability reversal of a trend is looking like. And that's because you've got 400 years of Japanese rice traders' logic. And the Japanese rice traders' logic is very simple. Where do most people buy? They buy exuberantly at the top. Where do most people sell? They panic sell at the bottom. So candlestick analysis is something that allows you to keep your emotions out of your trading, because these signals, if you see buy signals on gap up in the oversold area, that's where the bulls are stepping in. If you see gap ups in the overbought area, that's where the exhaustion is. That's where you get ready to sell. So everything built into candlestick analysis is based upon simple logic. And that is that prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And that's what candlestick analysis is all about. It's the graphic depiction of everybody buying and selling during specific time frames. Now, out of those 12 major signals, there are signals that are very strong. This is what we call your best friend signal. You can see a doji down here. Doji is where it looks like a little cross, where it opens and closes right about the same level. And that's illustrating that there's indecision between the bulls and the bears. But if they gap it up the next day after that day of indecision, not only does that give you a very strong indication of a bullish move, but of a very strong bullish move. Now, as long as you can see what the signals and patterns are, and you can see the strong signals. Here's a trend kicker signal. A trend kicker signal is merely where they open it here and close it here. That's what creates a dark candle. The next day, they gap it up and go the opposite direction, giving you a trend kicker signal, which this is what we call 2+2 analysis. This is a fry pan bottom. The Japanese rice traders illustrate this as a buildup of investor sentiment. And you can see that you couldn't trade this one way or the other if you wanted to. But when you start seeing this trajectory, this is the expected results coming out the other side. Now, this is based upon 400 years of the Japanese rice traders observing what investor sentiment does. So no matter what trading platform, you're going to see some very good trading styles later today. But if you have candlesticks on your chart, it's going to even make every one of those trading styles that much more clear. So not only do you have the prospects of seeing when a good trade is working, you always have a good prospects that if you see a fry pan bottom and comes up to a resistance level and fails, that gives you that old adage, cut your losses short and let your profits run. That's probably something you've heard, which I've heard for over 40 years. The problem is nobody ever tells you how to cut your losses short and let your profits run. Candlestick analysis does that very simply. If you're setting up for a good trade and it fails, get out right away and move on to something else that has a high probability. So every time we see something that is building up, we know exactly when to be buying. We know when to be selling. And this is what we call observe the obvious. Notice when they pulled back right to the 200-day moving average, it traded flat, indecisive, until it came back up above the T-line. Now, real quickly, my charts, as you can see, aren't very difficult because the most important factor on the candlestick chart are the candlestick signals. The red line is the 200-day simple moving average. The blue line is the 50-day simple moving average. The reason we have those on our charts is that's not what we are using to make our decisions. That's where we're getting illustrations of what everybody else's decisions are. Then we have some very simple trading parameters. This black line is the T line, which we'll go into in a few minutes. I use stochastics. And my stochastics are 12-3-3 because I'm a swing trader. Most of my trades last anywhere from 2 to 10 to 15 trading days. The T line, which we'll get into, but the major benefit of candlestick analysis is I'm sure you've all read research reports of what Apple could do or what this company could do. And when you buy it, you got to hope that's what happens. There's a different philosophy using candlestick charts. It's telling you exactly what the investor sentiment is actually doing right now. Is oversold the RSI? You can use RSI or stochastics. It doesn't matter. Whatever works effectively, because the simple logic from the Japanese rice traders is that if you see a candlestick buy signal in the oversold area, more than likely there's a change of investor sentiment. If you see a candlestick buy or a sell signal in the overbought area, more than likely there's a selling sentiment. So logic says if you see a candlestick sell signal in the oversold area, it doesn't mean anything. If you see a candlestick buy signal in the overbought area, it doesn't mean anything. So everything built into candlestick analysis is just common sense. And basically, I always illustrate it as being common sense put into depicted into a graphic depiction. Now the T line. The T line is that black line. It's the 8 exponential moving average. It has Fibonacci characteristics, which This is the most important screen in this whole session. That if candlestick signals are the graphic depiction of changes of investor sentiment, and the T line acts like a natural support and resistance level of human nature, you've got a very simple T line rule. That if you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. Now, why is this important to us? Because the biggest bugaboo of most investors is our own emotions. Again, I became a very good candlestick trader because I was the worst investor in the world. Everything I did was, well, when the news was great, I'm buying. But I was always thinking, how come when I start buying, it immediately turns around and goes the other way? Or when I tell everybody to sell, as soon as everybody's out, when we're all panicking at the bottom, it turns around and heads up. What we discovered was the smart money is buying at the bottom and selling at the top. So if that was the case, all I had to do was change my investment sentiment 180 degrees. I want to be the buyer down here when all the news is bad, and I want to be the seller up here when everything starts getting exuberant. So very simple candlestick trading rule. If you see a buy signal to close above the T line, you stay long, because what is our biggest fear, or one of our biggest fears? Boy, I've got a profit, and I sure would look stupid if I let this turn into a loss. I better take profits. Deciding when to buy or take profits has nothing to do with what the price is doing. The T line acts as that additional factor that says as long as you don't see a sell signal and a close below the T line, you can stay long. So here's one of the truisms. If you see a candlestick buy signal and a close above the T line, you've got an extremely high, and I stress the word extremely, high probability that you're going to be in an uptrend until you see a sell signal and close below the T line. Herb, I'm sorry I didn't mention that. Candlestick analysis is the graphic depiction of everybody buying and selling during a specific time frame. I used to trade the E-minis off the 1 minute, 3 minute, 10-minute chart combination. I trade commodities during the day using the 10-minute chart as my bellwether. If I'm swing trading stocks, I'm using the daily chart. So, yes, you can use it, and people will ask, can you use it for Forex? Remember, candlestick analysis is the graphic depiction of everybody buying and selling during a specific time frame. It doesn't matter what the trading entity is, as long as it's got fear and greed, which is all investments. So whether you're trading stocks, bonds, currencies, futures, tulip bulbs, anything that has fear and greed is going to be represented in the charts as far as what investor sentiment is doing. So the logic works the same way. If you start seeing candlestick sell signals and a close below the T line, you can stay short until you see a candlestick buy signal and a close back up above the T line. Again, this is a very powerful indicator that keeps your emotions out of your trading. There's lots of times I say, maybe I should be taking profits, but I've learned through the years that until I see a buy signal and a close above the T line, the investor sentiment is still in control based upon whether you're above or below the T line. So same scenario on the sell side. A candlestick sell signal and a close below the T line, you've got an extremely high probability that the downtrend is confirming, which makes it very simple that if you're in a good profitable trade, you just stay long until you see that close below the T line, and as soon as it does that, the probabilities have changed dramatically. So this is what candlestick analysis allows us to identify. Alerts for news sentiment. So when we started seeing this gap up, best friend gap up above the T line, breaking out through this level, how long would we hold on to this position? we're still long PLTR. Just because you've heard all the rhetoric through the last few months about AI being so terrible it's going to destroy the world. Well, it hasn't changed investor sentiment as far as stocks in that area. And it works just as effectively on the sell side. When you start seeing sell signals, like an evening star signal in the overbought area at a level everybody else is watching, like at the 50-day moving average, and a close below the T-line, you can stay short until you see a candlestick buy signal and a close back up above the T-line. However, there's one caveat to that analysis. But the further away you move from the T-line, the higher the probability it's going to come back up and test it. So if you see something that has in the oversold area is selling well below the T-line, you're going to be that much more diligent to say, well, if I'm short, I'm putting a safety stop right here. Because logic says if it starts coming up through that level, they're probably at least bouncing up to the T-line. So working with MetaStock and Jeff for the last, decade and a half, we've put scans on MetaStock where you can find the strongest signals. Now, out of the 10 or the 12 major signals, that's your bricks and mortar. That's your bread and butter of learning when there's changes of investor sentiment. There's also about 8 different patterns. And the reason the patterns work so well is investor sentiment works the same way time after time. All we're doing is identifying when these signals are setting up. So again, a doji in the oversold area followed by a gap up is your best friend. We also have about 15 what we call top ranked signals and patterns that we've also put on our MetaStock scans. And those illustrate the higher probability trade setups. So once we see this, remember what investor sentiment was probably being touted at that time. All the talking heads were telling you how bad this sector or this stock was. And they're still probably telling how bad it is all the way up here. But we can see somewhere where the smart money is finally buying. Now, how long do we hold on to this position? We use the simple T-line rule. You stay long. There are sell signals up here, but they haven't closed below the T-line. So anytime we see that doji gap up, especially when we're in the oversold area, that's not only giving us a high probability of an uptrend, but a very high probability of a strong uptrend. So a lot of people say, well, how do we learn all of these signals and patterns? I mean, there's a bunch of them. How can I learn them fast? I tell people, learn 4 or 5, with the best friend being one of them. You're going to put yourself in situations where the probabilities are constantly in your favor. So anytime I see this, what does this deter us from doing? That investment philosophy of, boy, I don't want to be chasing something. I'm going to wait for it to pull back so I can get a better price, which is not the right investment philosophy. Because what do we want to see on a strong bullish signal? Bullish sentiment. If it's gapping up and you're buying it when it pulls back, when it's pulling back, what is it telling you about investor sentiment? It's not there. You shouldn't be getting into it. We would rather be buying into strength that's going to give us the strong price moves. So if I think this one is going on right now, WBX, kind of your doji, look at this is an inverted hammer, one of your strongest reversal signals. There's your doji spinning top. There's kind of your little hammer signal gap up. And notice where it gapped up. It gapped up through the T-line. But what is everybody else is watching? Now, the reason the T-line is so effective for us is you'll see quite often how the T-line acts like a natural support and resistance level of human nature. And what is the confirmation of that? Because nobody has the T-line on their charts. Notice how a few days or yesterday, let's see, what is today? Thursday. When they pulled back, look where they pulled back to, right smack dab to the T-line. And right back to a level that's not on everybody's chart. So it's not like everybody's watching to see what's happening here unless you have the T-line on your chart. So these are what caused strong price moves. We have a chat room that's open every day, all day long, and we've got usually 120, 150 people in there each day, but there's plenty of them that know what they're doing with candlestick analysis because they've been doing it for years. So not only do you have good scanning techniques that are applied to MetaStock scans, but you also during the day have people in there saying, "Oh, look at CRBU, they've gapped up. That's a best friend signal." Now you start watching this on your 10-minute chart. Or what do we expect after a best friend signal? More upside. So the next day, if it opens down here, we wouldn't be getting into it. If it opens up here and starts trading higher, it's telling us exactly what they're doing. They're confirming this signal. So when do you get in? Well, there's your buy. If it opened positive, no, it didn't. It didn't. But notice what the nature of the pullback is. Remember, a doji is indecisive. And look where it pulled back to, right smack dab to the T-line. Now we're buying this. And what do we expect from this information? This information told us there was a drastic change of investor sentiment, which is usually going to be followed through by a steady uptrend. I'm greedy too, so I learned the signals and patterns just to take some time and effort, folks. Good stuff. Okay, thanks, Joe. So they work just as effectively on the downside. I mean, observe the obvious. They came in a downtrend. They reversed it. Where did they reverse it to? Look at your day of indecision. What was the high of the day of indecision? Right smack dab on the 50. And now there's a doji rule, just like there is the T-line rule. And the doji rule is the price will usually move in the direction how they open after a doji. So the next day when they opened here and started trading down, what was the trend already doing in a downtrend? What did they tell us right here? This is the information we see instantly. What is the information that we got when they hit the 50? They traded indecisively. And then the doji rule said, well, they're trading lower. That meant they failed at the 50. They're still in a downtrend. So again, everything based on a candlestick chart is just simple logic once you know what the signals are telling you. So you can identify the patterns, such as the J hooks. There's 3 J hooks. A J hook is when you have a strong price move, then it pulls back indecisively, and usually pulls back right to the T line, and then wave 3 starts. Oops, keep going through this. So there's a very simple method of knowing what the next price move is going to be. Wave 1 and wave 3 are usually the same magnitude. So if we see an uptrend, we see that wave 2 pullback, then a buy signal, a bullish engulfing. If we're buying right in here, what is our expectation? That this wave is going to be the same as this wave. Now, this sets you up for a bunch of good trading strategies. One, if you're a stock buyer, you're buying stock. If you're an option trader, you might be buying calls here. And as it continues, knowing that this is your target, you might be buying spreads up here at very inexpensive price as it moves up. Those inexpensive spreads become very lucrative. So a J-hook pattern is when it comes up, fail, or it starts selling. But notice where the pullback came to, right smack dab to the T-line. Here's another little candlestick signal. This is a doji sandwich. A bullish day, a doji. Stochastic's coming back up. And what is our doji rule? The price will usually move in the direction of how they open after a doji. So if it's opening positive, this day right here is usually going to be the same magnitude as this day right here, with a doji sandwiched in between. And the result of a doji sandwich is more upside. So if we see them buying down here at the T-line, J-hook pattern, doing a doji sandwich with expected more upside, we can see that there's a J-hook pattern setting up. So aggressively, we could be buying right in here. More conservatively, you could be buying up here because that told you this level is not acting as resistance anymore, that this is likely going to be the same magnitude as this wave right here. Now again, this is not rocket science. This is only identifying what the Japanese rice traders have illustrated to us for hundreds of years of what normally happens in investor sentiment or price moves. Look how wave one started. There's your best friend signal. There's your sell signals. There's your pullback. There's your kicker signal. Kicker signal is one of your strongest reversal signals. Opens here, closes here, gaps up and goes the opposite direction. That's a strong signal. So if we're buying right in here, what's our calculation? Well, if this is wave one, wave three about the same, that makes the 200 your next likely target. Now you've got some very high probability strategies, buying calls, buying spreads, buying stock, whatever your trading style is. So once you have that initial strong price move, usually started with a strong candlestick signal, you've got a wave one, a wave two, and look what happens right on the T line. Wave three, what's that indicate if we're buying right here? That this move right here is going to be the same magnitude move as this. So a J-hook pattern usually occurs when you see buy signals right at the T line. Again, the reason this is effective for us is because nobody has the T line on their chart. We see it become much more effective because we can see exactly what's happening at that level. So if this is wave one, and this is a potential resistance level, and we see this starting back up, what's it tell us? That if they break out through this level, which is probably some people are watching to see what happens here at this resistance level and they start piling in, we're already in that uptrend. So a J-hook is an up move, a pullback, usually to the T line, and a next up move. Now a J-hook plus is where you get a little bit more credibility, because once the wave one came up, look where it pulled back to. Right smack dab to the 50. And there's a left-right combo. This is a doji followed by a bullish engulfing signal. On our top ranked signals and patterns, this is ranked number 2, right behind the best friend signal. Because this is such a high probability reversal that if you were short, you're definitely covering your short immediately without confirmation. You don't need confirmation. The fact that they gapped it up, so you have a strong reversal signal followed by a gap up, what's that tell you? Not only have they reversed, but now they're coming back in with great enthusiasm. What's that tell you about your resistance levels? That if this is wave one, that resistance level is not going to be effective or relative. You're in wave 3. The T line is the 8 exponential moving average. You put it on your chart just like you would a 50-day simple moving average, or a 200-day moving average, or a 50-day moving average. And I tell people, put it on your chart and see if it works. The nice thing about candlestick analysis is we know the signals work. Everything else we put on our chart is a confirming indicator. So if somebody tells you to put the XYZ indicator on your chart, and you have it on there for a few weeks, and it's not helping your trading, take it back off. We try to keep our charts as simple as possible because the most effective reversal indicators are the signals themselves. Then we want to see what our confirming indicators are telling us. So when you see a move like this, what's the normal reaction to human nature? When they come up through a resistance level, they'll come back and test it to see if it's going to act as support. And notice what it did right here. There's your morning star signal. What did that kind of imply? that the 50 was going to act as support, which everybody is watching, which makes the 200 your next target. What constitutes bullish or bearish doji sandwich? Well, a bullish doji sandwich is a bullish candle, followed by a doji, followed by another bullish candle. A bearish doji sandwich is a bearish candle, followed by a doji, followed by a lower open, the doji rule, another bearish candle, confirming that your downtrend is probably in progress. A bobble breakout is even more compelling because it comes right up to a level that everybody's watching. The 50-day moving average in this case acted like a resistance level. You would have taken profits right here. Simple logic. Says if you're in an uptrend, they shouldn't be trading back below the open of the previous day. And if they did, what's that tell you about the 50? They're not going through the 50. They've resisted. However, notice immediately we start seeing a little J-hook pattern. So if we took profits right here, we're buying right here because now you're coming back up with a J-hook. And if we're buying right here, what is everybody else watching? They're watching to see whether it's going to get through the 50 or not. We can see it's going to because of the J-hook pattern. We're buying right here when everybody's still buying up here. What are the three J-hooks again? The J-hook, which just comes back and uses the T-line as support. The J-hook plus usually pulls back and uses a major moving average as support. And then the T-line or the bobble breakout is where they come up, they fail at the resistance level, they do a little bobble, J-hook setup, and then you can be buying back as soon as it comes back up through this level. Now, the reason this was effective for me was in the old days, if I happened to be lucky enough to be in a positive trade and I took profits and it started back up, I'm thinking, oh, they're not going to trick me. They're not going to make me buy again and then pull it back and take some more of my profits. At least now I know what patterns happens in human nature. Oops, I'm getting way behind here. So here's your J or your bobble breakout. You can see how they came up, failed, pulled back, did kind of a spinning top kicker type signal. Where was your next target? Up here. And this one we would call a J-hook plus because it came up, it didn't come back through the 200, did a bullish engulfing, told you the bulls were still in control. This is a high probability trading strategy. A bobble breakout, then you see the buying again at the T-line. What does this kind of alleviate? That fear of, oh, I don't want to be chasing this. You want to be chasing it if you know what the pattern setup is. So there's a different connotation of the stochastics. You're looking at buy signals in the oversold area. You're usually looking at candlestick breakout patterns when your stochastics are already up in the overbought area. So high probability trade setups just can be utilized or taken advantage of by confirmation. So a fry pan bottom looks like a fry pan bottom. Then you have this breakout to the upside. So this is what we're looking at. Kind of your rounding bottom, and then look at your best friend gap up. Again, your stochastics up closer to the overbought area. So these are what we expect coming out of a fry pan bottom. Strong price moves. Now, the rhetorical question is, do you always get into big moves like this because of a pattern breakout? Definitely not. We would have been happier than a pig in doo-doo to have go up like this. But it puts you in situations where the probabilities of being in big price moves are greatly in your favor. This is a buildup of investor sentiment. Buying right here puts you in situations where you know the investor sentiment is building up. So whether you're buying on a bullish pattern or a bearish pattern, called the Japanese rice traders call the dumpling top. It's a rounding top, and notice once you started closing below the T-line, the force to the downside gets extremely strong. So we shorted DG a while back because as soon as you could see this trajectory and a close below the T-line, the probabilities of this type of price move were greatly in your favor. So the candlestick power signals are things like the kicker signal because they've got proven results. When you see an open here and a close here, remember the change of investor sentiment is already built into the signal. They've gapped it up at or above the previous day's open and go the opposite direction. That's what starts a very strong uptrend. Works just as effectively on the bearish side. Opens here, closes here. The one thing that I learned many years ago was, boy, I'm happy, we're profits. Oh, wait a minute, they're gapping down here. My first thought was, oh man, I had some good profits. If they would just take it up one more time and let me out, I'd be so happy. What I discovered was, if they're gapping down below the previous day's open in the overbought area, there's a definite change of investor sentiment. There's only one thing you want to do: close it immediately. Now that does three things. It gets you out of the bad trade quickly, number one. Number two, it puts that money back in your account to do something else with. And number three, it keeps you from being mentally boggled all day long. Used to be, I would say, oh man, maybe they'll take it up. Oh man, I should have closed it out on the open. And where do I finally close it at the end of the day when I don't have any more decision to make? Now I know to close it and then say, wait a minute, this is a kicker signal setting up. Not only should I be out of this trade, but maybe starting to go short because of the strength of that sell signal. So BE on Friday did a bullish kicker signal off the 50. Where do you think the next likely target is if they're kicking it up off the 50? Probably up here. So we've been in positions like next. Look at your kicker signal. Is this chasing? No, this is telling you there's a drastic change of investor sentiment. How long do we hold on to this position? Until we see a sell signal and a close back below the T-line. Same thing on ENVX. Is this chasing after it? No, it's telling us there's been a drastic change of investor sentiment. Stay long until you see a sell signal and a close below the T-line. Jenny, we recommended this one on, what is today, Friday? On Friday morning. There's your kicker signal. There's your breakout. Look at where your kicker signal occurred, right here at the T-line. What do we expect? Wave 1, wave 2, wave 3. It's not because we're any rocket science as far as analysis. This is where we put what we call our RARE process in place. That's RARE, research analysis reverse engineering. That if we see a strong reversal signal, what's the next thing we can do? Just simply go to the news and see if there was news that created this to see whether that's going to continue that uptrend. This is also another signal we teach people. It's called the message. The message is they gap it up, but immediately start selling off. Not a pretty picture. However, what was the message? The message was they gap this up. So now all we do is watch to see when that profit taking's over. This is the expectation of the next move. A nice steady uptrend. It works just as effectively if you're trading as a swing trader, a long-term investor. It works on all time frames. If you're a day trader and you see a move like this, should you be buying here? Should you be buying here? Should you be buying here? That's a big percentage move. What keeps most people out of this trade like this? Oh boy, it's already moved pretty big. I don't want to be chasing it. Well, there's a very simple technique. Because candlestick analysis works on all time frames, you go to your 10-minute chart. You could be buying here. You could be buying here. Maybe you're not buying here, not buying here. Maybe you're taking profits. But then look what happens, another buy signal. This is your cradle pattern. You could be buying here. And why would you be buying here? Because they're still buying on a stock that's up tremendously. So even as a day trader, you can be buying here, taking profits here, buying here, and holding until you see a sell signal. Same scenario. What is our simple T-line rule? The further away you are from the T-line, the higher the probability it's going to come back and test it. So if you get into a trade like this, which we did, and it's trading way up here and you've got a big percentage profit, very simple. You go to your 10-minute chart. And remember the trading rules we had about the 10-minute chart or the T-line? The further away you move from the T-line, the higher the probability is going to come back and test it. Well, you're way up on the daily chart, and your 10-minute chart says you're way up here. Now you've got some logical places that says, whoops, if they're trading higher, and I'm that far away from the T-line, I'm putting my safety stop right here. Or if I didn't do it in time, I'm putting my safety stop right here, because if they're starting to show sell signals that far away from the T-line on the 10-minute chart, that's telling you they're probably coming back to test the level. What's the worst case scenario? Comes back, does a J-hook pattern on the 10-minute chart, you can always buy back in. So candlestick signals work just as effectively on the downside, little shooting star, gap down, and this is what we call a McMuffin. A McMuffin is a morning star signal. That's one of your 12 major signals that works extremely effectively. The Japanese rice traders say you can expect more upside from a morning star signal. And then followed by your doji sandwich. What's the expectation of a doji sandwich? More upside. So when you combine these two, you have a McMuffin, which is basically your morning sandwich. That's a very high probability that you're now in an uptrend. And this is, I always tell people, you don't listen to people, the talking heads. You don't listen to analysts. You listen to what the Japanese rice traders tell us. Let the market tell you what the market is doing. We've been following QuantumScape because it's one of these companies that are making solid-state lithium batteries for automobiles, getting closer and closer to perfecting it. Somebody downgraded it here. They said this is a $2 stock. Stay away from it. As we were sitting in the chat room, I said, all right, wait for the pullback to end when everybody that's following that analyst has finally sold, because then you see what the overall trend is doing. And so it was trading up pretty good on Friday. So they, at that point, somebody's opinion said, oh, we think it's a $2 stock, and everybody who was following that person got out. We were still buying because the chart was telling us we're still in an investor sentiment buildup. So this is why we say observe the obvious. If you see a candlestick sell signal in the overbought condition, right at the level everybody else is watching, you're probably back in a downtrend. If you see a doji gap down, you're probably still in a downtrend. There's nothing difficult about candlestick analysis. It's using the most basic, simple investment indicator, human nature. Perry, we recommended this one on Friday because there was our best friend gap up on Thursday. And notice after it gapped up, what it did, it stayed above the 50. Now we're seeing it as a best friend signal, but what's everybody else watching? Oops, they've traded back up above the 50. I bet you dime to donuts, there's dozens of you out there that have been told, oh, you don't buy a stock unless it's trading above the 200 or the 50, blah, blah, blah. The 200 and the 50 mean nothing. It's the signals telling you what's happening. Everything else, again, acts as a confirming indicator. So the reason candlestick probabilities work so well is because they've been proven for over 400 years. The Japanese rice traders did not become wealthy trading candlesticks. They became legendarily wealthy. They were the financial powerhouse in Japan for centuries. And they did it on the most boringest commodity in the world, rice. So remember, prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals, which is exactly what the graphics of candlestick signals tell you. So anyways, using the simple scanning techniques that we've put onto MetaStock, it changes your investment perspectives. It allows you to start thinking, all right, what is the price actually telling us, not what some talking head or some analyst is telling us. So that's about all I've got. I don't have a graphic to say. I tell people we have a 2-week free trial on our website. Our website includes, I put out stock picks every night. If we think the market is heading up, I do a 2-minute video saying, here's why we think the market's going up. Look at the charts. And here's some recommendations. But we don't put out recommendations so that you have recommendations. We do it in a video so you understand why those recommendations are being made. And I always end the session by telling people you don't have to overanalyze candlestick analysis. I use the illustration of the lady that brings her parakeet into the vet and lays it down on the table and says, "Oh, can you help my parakeet? He's been my best friend for years and something's wrong." He goes, "Now I think your parakeet's dead." She goes, "Oh, no, isn't there something? He's such a good friend. I can't lose him." He goes, "All right." So he goes out to the back of his clinic and brings in a cat, leaves the cat next to the parakeet. Cat sniffs it, looks up at the parakeet and says, "Ma'am, I'm sorry, but your parakeet's dead." She goes, "Oh, no. Are you sure? Isn't there something else you could do?" And he goes, "All right." So he goes out to the back of his clinic again and brings in this great big Labrador retriever, comes bounding in, puts his paws up on the table, stiffs the bird, looks up at the vet, kind of shakes his head, goes, "Ma'am, I'm sorry, your parakeet's dead." He goes, "Oh." So they go out to the front desk. He goes, "Well, that'll be $250. And she goes, "You're charging me $250 just to tell me my parakeet's dead?" And he goes, "No, ma'am, I would have done that for $18. Then he wanted a CAT scan and a lab report after that. So you don't have to overanalyze candlestick analysis. Human nature works the same way time after time. So, Jeff, that's about all I got.
All right. I have just a couple questions from YouTube, if you don't mind.
All right.
CB wants to know, what does the T and T line stand for?
Oh, we didn't know what to name it when we first came across it. One of my first private training students that came out of Anchorage, Alaska, loved candlesticks, and he said, "I'm just not getting it." And then he called back about 8 weeks later and said, "Hey, if you put the 8 exponential moving average, it works extremely well." So it's like anything else. You can put it on. If it doesn't work, you take it off. Well, it worked extremely well, but we didn't know what to call it. The trade line, the trigger line. So just for typing's sake, we just called it the T line. Cool. And it's been that way for 15
So you can make
years.
up anything you want.
That's right. And I usually do. When I don't know the answer to something, I'll make it up.
Let's see. David, last one I think we have time for. David wants to know what time frame do you have a recommended time frame if you want to be a day trader?
That's up to each individual. If you're trading actively, maybe you use a 1 minute, 5 minute, 10-minute combination. If you're just trading maybe 2 or 3 trades during the day, maybe you're using a 5 minute, 10-minute, 30-minute combination. So it doesn't take 10 minutes to look at a chart that you're trading and then see which time frames work most effectively for the times that you're trading. So, right now, as I say, I'm trading commodities, but I use the 10-minute chart, which works very effectively. That if I see a setup starting on the 10-minute chart, I'll flip down to the 5-minute chart to see if it's time to execute that trade.
All right. Well, Joe and Dave said they'd let you joke. But in addition to that, let's see. Excellent, Steve. Really exceptional presentation from Julian. Nevin says, thank you, Mr. Bigalow. Thank you, MetaStock. Long says, thank you for your great presentation. And so does Garth. So really appreciate your coming in. Great job today.
All right. Well, thank you, everybody. As I say, if you want to test candlestick analysis, our chat rooms are open all day long. If you email abraham@candlestickforum.com, just say, Steve said we could come in for a 2-week free trial. You'll get stock picks. We have a session every Monday night and Thursday night for training, free for members, and Thursday night is free for everybody. And then we usually do a free training during the week where it might be stop losses, entry and exit strategies, when to take profits, things that are all related to the common sense built into candlesticks. So with that, everybody, thank you very much.
Thank you, Steve. Appreciate it.
Yep.
And one of the questions that we get a lot is like, how do you actually scan for patterns? And that's like one of the biggest questions that we get. And obviously with MetaStock, one of the things I absolutely love is the ability to do scanning. And so when Steve and I started initially working together, I think we've been doing webinars and he's been teaching 15 years now with MetaStock. But one of the things that we worked on a lot was actually creating a package where you could kind of automate and where you could kind of see these patterns, where you could do it. And the result of that is a product we released about 10 years ago that's went on to be one of our most successful products of all time. So, and right now, we just finished up a pretty major enhancement to it. We just got done with this yesterday, in fact. But the Steve Bigalow Candle Profit System has been a very, very popular add-on for MetaStock. We've sold thousands of copies over the years. And there's a couple of things I'm super proud of. We spent a lot of time kind of getting this ready. And it took us a while. We wanted, when we were thinking about like kind of like what we wanted to improve and what we wanted to change, we wanted to kind of make it more useful. In other words, we just want to throw a bunch more patterns. But CPS 1 and 2 have been highly rated. Like I said when I was introducing Steve, they've been rated the most popular add-on for any product, not just MetaStock, as the reader's choice in stocks and commodities. We've had some really good reviews over the years from like Dennis Peterson and Barbara Starr on CPS and how it works. And so right now, what we've actually done is we've just finished up a ton of work in terms of refining the candle profit systems and releasing version 3. This was available for the first time yesterday. Even yesterday morning, we're kind of fixing a few things with the manual and making it just right. And so I want to kind of talk a little bit about not just the CPS, but a little bit about what we've added. So the next thing I'm actually going to show you, not quite. Here's a chart. Okay, we'll look a little bit more at this in just a second. I have to go a little bit quick just so we don't go too far behind schedule. But right here is just a table that I put into Excel that lists all of the patterns that are included in CPS. So you'll notice that we have another category right here called the top rank patterns. Doji Dynamite's past friends. We've added a whole bunch of new patterns that we call the power patterns. We've got the major patterns. In total, with the patterns that we've added to CPS, there's 58 patterns. And in this version, we added another, I don't have that number really readily available, about 20 patterns. Of those, about 7 of them are what we rank as the top ranked patterns. So when Steve and I were talking about how to make this thing a little bit more useful, what we wanted to do is we wanted to kind of make what Steve calls his top ranked patterns more visible, more easy to find, more addressable. And so every time one of these, what he ranks as his top pattern shows up on a chart, you're going to be a little bit different. And to kind of just illustrate what I mean, I've got a chart ready. So let me go ahead and kind of look at this for you. And what you'll see here is this is a chart of Meta, which has been an absolutely great stock, Facebook, this year, particularly if you bought it around the first of the year. But all of the patterns are labeled. So right here on Meta, just a couple of days ago, you had an SC. And if I highlight over that SC, you'll see that it pops up and says that this was a slow curve. A few days before, it was engulfing. This was a bullish engulfing. You've got LRBC, and if I highlight over that, that says left-right bullish channel. Here it says doji at the top. You'll notice some of the patterns are kind of like, I tried to abbreviate it. There's just a lot of patterns on the chart. And so for the patterns that we're kind of pointing out, but we don't want to kind of take up a lot of text room and kind of make the chart look clean, a lot of the patterns that are kind of not the top rank patterns are just going to kind of be abbreviated a little bit. And you can hover it over. This one was an inverted hammer. You can very easily see what they are. They're marked. You can see them, but you don't have inverted hammer on the chart. What Steve really wanted to do is for the top rank patterns, the patterns you should really, really pay attention to, he wanted those to stand out. And I think you can see how we made them stand out because they stand out on the chart. So right here, if you look at this one says doji SW, that's a doji sandwich. Right here, you've got the trend kicker, you've got the fry pan, you've got a kicker here, you've got a fry pan. So we made a lot of, and a doji best friend, all of the ones that you should pay more attention to, we've made larger, we've color coded them on the chart, and all the ones that are kind of patterns that are good to know, we've kind of made a little bit less obvious. And that's just to kind of keep the chart looking clean, okay? For all these 58 patterns, we integrated commentary. So if I want to know what this T kicker was on the chart, I'm going to go ahead and zoom in a little bit here. And if I wanted to know what a trend kicker was, I could go into the commentary here. I'm going to go ahead and open it up. It's going to show up right here. And when I do that, just notice right here that on the chart, there's no patterns on this bar. We're not labeling anything on this bar, but there's a little bit of an arrow above it, meaning that that's the day it's looking at. So if I wanted to see what the recommendations for this kicker are, I'm going to go ahead and move the commentary back to that day. And right here, it's going to say the patterns on the current bar, the bullish kicker, and then the trend kicker. And it's going to give us a definition for those particular patterns, what they mean, what to do with them. So I really like kind of the new look and feel. What we tried to do is take advantage of the new charting engine that we did with MetaStock 18. I just think it looks better. And more importantly, I feel it's like more useful because the patterns that you should be paying attention to are really just kind of knocking you in the face, said, hey, this is a pattern that you should look at. So in terms of explorations and things like that, well, of course, we have scanning. We've always had scanning with CPS. But because Steve went through the effort of actually going in and categorizing the scans, what we wanted to do is, if it's a top rank pattern, like your doji best friend or your trend hooks or that kind of stuff, we wanted to put those in such a way that you could very, very easily find the top rank patterns. So if you're running a scan, you want to find those top rank patterns. You come into the Power Console here, you type on the Explorer, which is our scanning engine for MetaStock. And what I'm going to do is I'm just going to type in CPS, and everything is now enabled CPS 3. So you've got your Doji Dynamites, your J hooks, your major patterns. But if I just, and then the power signals, there's a number of scans that you can do here. If I just want to find the stocks that are top ranked, that are in a bullish category, or that are top ranked and in that bullish category, all I have to do is just select those categories. I can just scan for those highest top ranked patterns. So let me go ahead and do that again. We'll go ahead and CPS 3, and we'll just do the top ranked bullish real quick. I usually have it set to scan the S&P 500, the Dow 100, and the NASDAQ 100, and those options are all set. Go ahead and click on Go, just because I have to wrap up. But you can use this to scan anything that you want to in the market. So if you're in India and you want to scan these patterns in the National Stock Exchange or the Bombay Stock Exchange or whatever markets that you're interested in, you can do any region. If you're in London, Australia, we cover a couple hundred global exchanges, and all those are available. So in any case, that's, I think, where I'll leave it. You'll see right now, just by looking at those bullish top rank patterns, which is the one I actually told it to rank, we're eliminating right now 98% of the stocks. So the idea here is show me the stocks that closed with a powerful pattern on Friday. And that way I can look at just the ones like Baidu and Domino's and HP and JD. These are ones that had one of those top rank patterns on there. If I look at the columns, this is the Doji best friend. None of them were best friends. Flutter kicker, trend kicker, kicker. Okay, so there were a couple kickers in here. Baidu and JD.com both had kickers. There's a BABA pattern. But what we wanted to do is actually we wanted to, of course, include more Steve patterns because they're awesome. But what we wanted to do, and I think we were able to achieve that, is highlight the ones that you should really, really be learning, the ones that you should really pay attention to, the ones that the ones that you should be scanning for. So there you go, in any case. Let me go ahead and show this again. Bill's wanted to look at the slide with the patterns. There you go. Joe asks, do bells and whistles go off when one of these scanning patterns happen, or how does the scanning process work? Okay, I think that was a question that I talked to you before we did this scanning. By default, if you're just looking at a chart, any pattern that happens will show up on the chart for you automatically, as long as you've got the expert attached. If you're looking at an open bar, you want to make sure that that pattern still exists at the end of the bar, in case we're waiting for a close above the T line. That might close above the T line and come back down. But any of those particular patterns are automatically going to show up on the bar. Once the bar is closed, they're not going to repaint or redraw. It's just during the open bar that you need to be aware of. So hopefully that answered your question, Joe. Thank you for it. Bill, here's the first slide with all the patterns. Again, there's 58 of these, and the ones that we've highlighted in yellow are brand new. So and 7 or 8 of these are top rank patterns that are brand new, and then we added like Tasuki gaps, Tasuki lines, separating lines. This is a very, very cool add-on, and I'm really, really proud of, well, even the first version, but like one of the things that took us a while to kind of create the third version is like, well, how can we make this more useful? We've already got all these powerful patterns in there. And so I think we added some more patterns, but I really like the way that Steve went through and highlighted exactly, these are the ones that you really want to pay attention to first. Okay. So in terms of the explorations, again, I've got everything highlighted that we've added for CPS3. You've got the power signals. There's a bullish and a bearish version of that. No, there's a top ranked bullish and bearish, and then the power signals. And you still have the ability to do any of the other scannings for any of the ones that are already existing. These universe scans, what they're going to do is they're going to allow you to set up universe of lists that, or have stocks that fall between a certain value and stuff like that. It's all covered in the instructions in the manual that's provided. So I did also, when we were creating this, I did create a expert advisor that you can use if you want to, that will just show only top rank patterns and eliminate everything. So if you really want to focus in just those highly rated, highly ranked patterns from Steve, you can do that. If you want to see all the patterns, you can do that as well. So again, some of the things that we worked on as new features for this one, 20 new patterns, 7 of those were top ranked. We formatted the patterns to make them cleaner. We wanted those top ranked patterns to stand out. And one of the things that Steve did, Steve worked really hard with us on this, and I appreciate that. But one of the things that he did is for every single pattern, he actually put together a guide for it. He put an example of, he put together the requirements for what constituted that pattern and how you'd actually trade it. And we wanted to make good use of that because there's just so much good work that he put into it. So the manual on this thing, 70 pages. And every single one of those 58 patterns has a picture of one pattern. They have a description of the pattern that we're looking for and exactly how you trade it. So very, very cool with that as well. So with this one, again, just to kind of recap, it's 11 explorations. You've got the 2 expert advisors. It's got 4 layouts and a pretty big 58 unique patterns. So such a cool thing. So again, just with version 1 and 2, it's been one of our most popular add-ons. It's something that's been highly rated by both the readers of Stocks and Commodities and the reviewers, like Barbara Starr and Dennis Peterson, both reviewed this for us for version 1 and 2. But here, what we're going to do is $6.99 normally, that's the retail price. We are going to do a webinar special here, where if you want to buy it as part of the summit, as part of the launch special, we're going to do it at $5.97. We're going to back that with a money-back guarantee. So we're going to put a 30-day money-back guarantee on that. And you can try it. If you don't like it, you can return it. You like it. The other thing I want to mention, because I know there are thousands of you that have bought, excuse me, that have bought CPS 1 and 2 over the years. Thousands. If you already own one of these and you want to get CPS 3, the actual price that you'll pay, normally the upgrade is going to be $199 for that. And if you do it as part of the launch special, the launch promotion, you can pay $97. To do that, you'll need to call in 800-882-3040 or metastock.com/saleschat. And thank you for using it. I appreciate it. It's been an extremely popular add-on over the years. I think a lot of that has to do with Steve's personality and what he brings to the table, but it's such a great add-on. So again, for that, $699 will be your price. $597 one-time cost. It does require MetaStock to use. If you want a free trial of MetaStock, we'll give you with it. 30-day money-back guarantee. So if you don't like it, if you don't think it's helpful, well, we'll give you a full money back. No, well, I used to say no questions asked, but we want to know if it's something we can help you with. If you have an issue and you just don't know how to run the scans, we got staff that can help you with that. So, but if you want a refund, if you just don't think like it's helpful, we'll give you that refund. So it is also going to be part of a Summit action pack that is going to include everything that we talk about. You'll get the Steve Bigalow Candle Profit Systems. You'll get the Primo Momentum Strategy number 4, AAII Conviction Plus, Oscar Boni's Trend Lines and Trainings, Adrian Manz's Around the Harm, a 3-month subscription to learnmetastock.com, and a training video called Unleash Your Power MetaStock. We have some of the best add-ons in our catalog here today with our speakers. And all of that, if you bought it separately, would be $3,987. If you want to buy them all as one big add-on, one big bundle package, we're going to give you a huge discount. It's going to be $2,344. So you can do that online. You can take advantage of the metastock.com/summit deal. You can give us a call at 800-882-3040, or you can take advantage of it at metastock.com/saleschat. So there you go. I know there are a lot of questions. I'm going to answer those in chat in just a minute. I'll just type up answers for you. Appreciate your coming. I know I just ran a little bit long, and we need to get moving. So before we do, thank you to AAII.com. We appreciate the sponsorship. Great organization. We really a great company to work for too. So thank you to them, and thank you to Stocks and Commodities for publishing the event. Of course, we're just MetaStock. I just talked about all the great scanning we do. I'll talk a little bit more about that later. For now, let's get Steve Primo on the line. Steve is another partner of MetaStock that has another great name. We started with the Steves today. Steve, I've probably seen him present a whole bunch too. And a couple of the things that I like about Steve is he's extremely understandable. When he teaches, I can totally understand what he's talking about, what he's teaching. He talks about his pattern. I think he's a really, really good trainer. And I think that's really helpful too. So let's go ahead and kind of get you moved over. Steve, how are you doing today?
Hey, Jeff, doing great. Thanks for inviting me to speak, and thanks for everyone attending today.
Yeah, sorry I went a little bit long there. Let me go ahead and make you the presenter.
Okay.
We won't waste time there. Again, we're starting a little bit late. If you run over, I'll make my presentation a little bit shorter this afternoon. So it's not a big deal. Let me go ahead.
No problem.
I will let you know that I can hear you, and I can see your screen. And so I think I'll just let you go.
Okay, sounds good. Thanks once again to everyone at MetaStock and for everyone attending today. Now, today I have a great educational presentation for you where I'm going to be talking about 2 edges that I truly believe will change the way you trade. And the reason why I feel this way is because they've actually changed the way I've traded. These have been the cornerstone to the methods and the techniques that I use in my personal trading that have sustained me now going on 46 years. And the good news is that I'm going to teach you these 2 techniques. You'll be able to apply them as early as Monday to your own trading method as well. For example, let's take a look at this chart here in AVGO, all right, Broadcom. Now, here's the way I was trained when I first started trading some 4 or so decades ago. I would look at a chart like this and say, well, it's a whipsaw market, right? I mean, we're trained not to trade these markets because the minute you buy, it goes lower, and the minute you sell, it goes right back up. So this is where you run into a lot of losses, so it's better not even to touch them, right? Well, with the 2 edges I'm going to share with you today, the first one identified that the trend, the overall trend, I should say, was up. Even though it looks like we're going sideways, you know that the overall trend is up. And the second edge I'll be teaching you confirmed that the short-term trend was also up. So there's no reason to overcomplicate trading, to look at double time frames, to look at different charts. We now know that the overall and the short-term trend are in sync. So once I learned these edges, I no longer looked at this as a whipsaw market. And so I was able to see something here and to have a buyer's bias, and potentially someone could have captured roughly 300 points in just 2 months. Now, these two edges I'm going to share with you and teach you today how to identify actually are the cornerstone and the first two rules of one of our most consistent strategies. And they generated buy signals well in advance of that 300-point move. The strategy we're talking about is strategy number 4. Now, this is what we call our momentum pullback trading strategy, strategy number 4. So you'll get the first two rules to this method in just a few moments. So thank you for joining us today and welcome once again. My name is Stephen Primo. I am the president and founder of Specialist Trading. I've been trading now for 46 years. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist. If you're not familiar with what a specialist does or did, because there are not a lot of them around anymore since the market has gone to electronic trading. If you ever Google those pictures of those guys making those weird hand signals with lots of paper on the floor and they're standing behind these large wooden podiums, those are specialists. So in the old days, before the internet, before high-speed computer trading, what you would have to do is you'd call your stockbroker. Let's say you wanted to purchase 100 shares of IBM. You would call your stockbroker. Your stockbroker would take down your order. He in turn would call the floor broker for that particular company. The floor broker would take down the order. The floor broker would walk over to the person who specialized in making a market, the specialist. And by the way, I made markets in IBM, US Air Waste Management. And then you could either buy or sell from that specialist. So that's how trading used to really take place. So I did that. I made markets during the crash of '87 and the bull market that followed. I left the floor in the mid to late 90s to manage money and to also teach students around the world. So I'm happy to say that once we formalized specialist trading, we have students now in over 115 countries around the world and in every state in the United States with one goal in mind, and that's simply to educate traders. You see, it's my opinion, what I've learned in over 4 decades of trading is that the only traders that have stood the test of time, the ones that are still trading, not meaning that you have a couple of good months or even a couple of good years, but the ones that are still trading are the ones that make their own trading decisions. You know, most of these successful traders don't read daily blogs or listen to the so-called gurus on TV or go to chat rooms. They have a specific plan in place, and then they just simply follow it. Now, a lot of traders will say, well, Steve, I haven't been trading long enough. I don't have enough education the way you may have. Well, I didn't have a degree in finance. I knew nothing about the stock market when I first started. The beauty is that what we do at Specialist Trading is that we provide you with all the things that I've learned and accumulated in my 46 years that have high levels of consistency. And then we work with you so that ultimately you can make your own trading decisions. We basically want everyone to be a really successful trader. That's our goal. Now, before we begin, as always, we're required to share this with you, so please take a moment to view our disclaimer. I'm going to share with you a lot of performance results using these two edges and in the form of our strategy number 4. But please remember that we can in no way guarantee that any of the results you're about to see will be repeated in the future. Also, since we are first and foremost an educational company, all examples are strictly for educational purposes only. Now, from time to time, people, whether they're students or not, say, we love your education, Steve. Is there any way to get more of it? Sure. You can follow us on Twitter. There's our handle right there. Every day I post anywhere from 4 to 5 or 6 different snapshots of signals that our methods have generated. Also little bits of financial wisdom. So there's lots of great ways to get free education on a daily basis. Please feel free to follow us on Twitter. You may want to copy down our handle right there. Now, as I stated in the opening statements, we're a little bit different from other companies in that our only goal is simply to educate you. We feel that education is what's missing from most traders' toolbox, and that's why most traders take themselves out of the game. All right, they listen to someone or something else tell them what to buy, what to sell. They have a nightly signal service or listen to earnings or interest rates to find out what they should do with the market. They listen to some people on TV, and that's really just a simpler way of saying, I don't know what to do, so why don't you tell me? You should never get to that point. I mean, think of any other endeavor. Think of any other career. If someone had to ask someone, what do you think I should do? Or a brain surgeon asking the nurse, how do you think I should operate? Or an airline pilot asking the passengers, how do you think I should fly this, okay? But for some reason, it's perfectly admissible for traders to do this on a daily basis. How do you think I should trade? What do you think of this stock? What do you think I should do here? Okay, what's the best time frame? This is why most traders fail. Been estimated upwards of 85%, because you're simply taking yourself out of the game. Our goal as a mentor is to provide you with things that have stood the test of time so that ultimately you can make your own trading decisions, not us. Okay, so with that said, let's begin today's educational presentation. Now, I'd like to start out with a theme, because this is what my mentors usually taught me when I was struggling so much. You know, I've made no secret of this. When I first started trading 46 years ago, I had a very difficult time. Even though I was on the floor with high-speed computers and access to information that most traders weren't seeing, I still couldn't make a dime. I was struggling tremendously, and I was using all of the things that I've been taught. All right, having tons of indicators on my screen, looking at multiple markets, multiple time frames, waiting for interest rate, to come out, the announcements, looking at earnings, listening to all the trading gurus. It was just, there was just so much things I was watching that were supposed to be valid, but it wasn't working at all. And my mentors, who were specialists on the trading floor, saw how much I was struggling, and this is what they told me. They said, Steve, trading is actually very simple. It's the individual trader who makes it more difficult than it has to be. Okay? Now think of it. How many times, once again, are you following far too many indicators, far too many so-called trading gurus, waiting with bated breath for all the earnings announcements or economic news to come out, and it's still not working, right? It's because we overcomplicate things. But once you simplify things, you really see how consistent you can be. I know we've all been taught and trained that the more complicated something is, the more valid it will be, right? But in my 46 years of trading, I've actually learned it's the opposite. It's the simpler things that have more validity, that will get you on that road to consistency. Now, these two edges I'm going to teach you today are extremely simple. In fact, you're going to say, wait a minute, this is too easy. I mean, how come no one's ever said this before? And it's too easy to work. Well, I'll show you a number of examples how they are incorporated in a very, very consistent method, and how I use these on a daily basis. So let's jump into it. We're going to be talking about strategy number 4. And these are some of the highlights of this particular method. It's a pattern recognition strategy, okay? So we teach our students how to identify this pattern. And this is a pattern that occurs over and over and over again. So once you know how to identify it, you'll see it happening all over the place, okay? Now, originally, this method was designed for traders looking to catch momentum. And it still is, but looking for catch momentum on a very small time frame. When I was on the trading floor, I was in and out of trades in a matter of minutes. But we've developed ways, because we know not everyone trades that way, we've developed ways for traders to stay in days, weeks, or even months, if you like. But it's still capturing momentum. Oftentimes, when on the chart, it looks as if there's no momentum at all. Now, here's the good news, another highlight about strategy number 4. You can apply it to all markets and all time frames. Oftentimes, you'll see a great strategy or a great technique or method, and then someone will say, well, if you want to try this on, let's say, crypto, the crypto market, well, you have to buy another method because it doesn't work the same way. And you have to buy another one if you want to apply it on Forex, and another one if you want to intraday trade with it. The good news is the same rules apply to all markets and all time frames. It makes absolutely no difference what market or time frame you're trading. Wherever this pattern occurs, a signal will be generated. Now, the advantages of trading strategy number 4, 1, it's extremely consistent. Now, I know a lot of you may say, well, consistent, well, that's great. That means there's a lot of winners. That's not really what consistency means. Consistency, to put it really basically, is just an awareness of losses. In other words, you know that there will be losses from time to time. And that's okay, because a consistent method is one that's able to recoup those losses. How many times have you bought this fantastic new system or new trading method that's supposed to, make you a millionaire in 6 months or so, even maybe 6 weeks? And sure, it has a couple of good winners, but then all of a sudden it goes into a really strong drawdown where you have 5, 10, 20, 30 losses in a row, right? That's not a consistent method. What you want to see with a consistent method is a 2 steps forward, 1 step back approach, a nice upward slope on your P&L statement, okay? Number 2, strategy number 4 makes you a part of the process. Remember how we've said how basically most traders take themselves out of the game. They basically, let's say, I'll let you decide for me. I'll go to this signal service, or I'll purchase this system that automatically spits out the buy and sell orders, or I'll listen to that guy on TV tell me what to buy and what to sell. Remember, that's a recipe for a disaster. You have to be a part of the process. You have to make your decision. Now, strategy number 4 generates these setups, but we in our course give you upwards of 6 or 7 different ways to enter, upwards of 6 or 7 different ways to exit, and upwards of 6 or 7 different ways to place your stop. So let's say you're the type of trader that doesn't like to take a lot of risk. Well, then you would use one of our stop placements that has a small risk factor. Let's say you're the type of trader that likes to trade 10, 20 times a day. Well, then you would use a certain type of entry point. Let's say you're the type of trader that likes to get in and out quickly. Well, then you would use a certain type of exit. But ultimately, we provide you with these variables for you to decide. Remember, you have to become a part of the process. And then lastly, strategy 4 is designed to be as simple as possible. It's an extremely simple method. As I said, we have students around the world who have been trading it. We have hedge fund traders who have 20, 30 years experience trading this. We also have people that have been trading for maybe 20 minutes. They have no experience in trading, and they're getting the exact same rules that a hedge fund trader would get, because the basic format is extremely simple. All right, so let's look at these 2 strategy number 4 rules. These are the edges that will change the way you trade. And once again, you're going to be surprised at how simple they are, but they're very easy to see, and you can go back and do your own research and see how they could have helped you with your last 10 or 20 trades. All right, these are for buy setups, okay? Regardless of market, regardless of time frame. That's why we have this generic chart up here. All right, rule number 1, or edge number 1, is price bars must close above the 50-period moving average. All right. Now, in this example right here, we see that the entire bar is above the 50-period moving average. But you could open below the 50 as long as you close above, even if it just closes 1 or 2 ticks above. That's fine. I'll show you a few examples of that in just a few minutes. But what you want to see is a series of these closes above the 50-period moving average. And someone will say, well, why? What does that mean? Well, remember, things are simple. The simple things work. And we have found, and this is what my mentors taught me over 4 decades ago, that when price bars, consecutive price bars, are closing above the 50, the overall trend is up. And the odds will be in your favor if you only have a buyer's perspective, if you only look for buy setups. All right? Go back and look at your last 10 or 20 trades. I can almost guarantee you that the reason why you had losses were because you were out of sync with this rule. You were buying below the 50. All right. I know a lot of traders say, well, no, this is ridiculous, because there were some great buy setups below the 50 I saw last week. Well, sure, there were always going to be some nice setups, contrary to some of the rules. That's just the way markets are. But remember, we're trying to instill consistency in you. We're trying to give you an edge here. We're trying to put the odds in your favor. So think of the slot machines, okay? Think of going to Vegas or Atlantic City or somewhere where they have gambling, all right? Now, the slot machines are there designed to give you a few winners every once in a while, because they give you this false sense of security that you're actually doing well. So if you stay there every once in a while, you'll get a nice little winner. But remember, they're designed to have you stay there, because they know if you stay there long enough, you'll eventually give all your money back. The odds are really not in your favor with that. It's the same way with buying below the 50-period moving average. Every once in a while, you get a great buy, and it'll be fantastic. And you say, wow, I could have made tons of money if I took that signal below the 50. But if you do that over time, I can almost guarantee you, you will give all of it back, probably sooner than later. So we want to instill in you consistency. It's not about hitting home runs. It's about 2 steps forward, 1 step back. And the way you do that is by following rule number 1, that you'll only be a buyer if price bars are closing over the 50. Now, rule number 2 is just as simple. If price bar is above the 50, then you want to see it close in the top 25% of its range. So what does that mean? Well, if we look at this bar here, if we divided this by 4 separate but equal parts, we want to close in that top quarter. And someone would say, well, what does that mean? Well, that's the short term telling you that it's in sync with the overall trend. In other words, the short term trend is also up because we close in the top 25%. Now, if we closed in the mid-range or even lower, the short term is telling you not that the short term is not going up because we're closing lower. So you want to see a close above the 50 and also closing in the top 25%. These are the short term and the overall trend in sync. Remember we said about keeping things simple? Absolutely no reason to look at two different time frames. I heard about that years ago when I was on the trading floor, and I don't look at two different time frames. I only look at one. If price is above the 50 and it's closing in the top 25%, the short term and the overall are in sync. There's no reason to look at a daily time frame to trade an hourly bar. There's no reason to look at a weekly time frame to trade a daily bar. Everything is in the chart in front of you. Now, conversely, for sell signals, we just turn everything upside down. We want to see price close below the 50. Why? Because the overall trend is down. And if the overall trend is down, we are never going to be a buyer. Sure, as I said earlier, there may be some great buys every once in a while, but you will have a higher level of consistency if you only look for sell signals. Remember, we're not going for that sucker jackpot win where it gives us the sense of security that, hey, this is working great. Over time, if you do that, you'll most likely give it back. So rule number one is price bar closes below the 50-period moving average. So this is telling us the overall trend is down. We want to look for sell setups. Rule number two, if we're below the 50, then the price bar must close in the bottom 25% of its range, okay? Right here. So if we look at this from top to bottom, we're closing in the bottom 25. Now we know that the short-term the short-term trend is in sync with the overall trend. So we have these two things in sync together. No reason to overcomplicate it. You see, trading should be black and white. It shouldn't be subjective where someone says, well, if this happens, there's a good chance of this. No, you need to know that if price is above or below, you need to know automatically if I'm a buyer or seller. If it closes in the top or bottom 25%, we know this is where the short-term trend is. It's that simple, and it's very, very easy to see. All right, these are the first two rules of strategy number 4, our most consistent method I continue to trade to this day. So let me share with you some recent strategy number 4 examples and showing you these two edges, how they work in real time. Excuse me. All right, let's look at this chart here in MCHP microchip. All right, obviously it's been going up, right? This is just about 3 weeks ago in mid-June. This has been going up. But let's say you go to that chat room and you say, I don't know what to do here. Should I buy it? It's kind of high. And the guy in that chat room says, oh no, we are amazingly overbought, okay? All the indicators that we follow are overbought. So you've got to sell here. You got to go short, or at least don't do anything and wait for it to come down to these lows again. And for another week, it does go down. So you say to yourself, wow, that guy's pretty good. We're in a downtrend. So I'm going to look to go short because he was right. We topped out here. But are we really in a downtrend? What's the first thing we teach our students around the world? Apply what we call the buy-sell line. And it's just the 50-period moving average. And then ask yourself, where is price in relationship to that? Because that will tell you the overall trend. Well, here's the 50. So are we in a downtrend? Absolutely not. The overall trend is up. All right, so that's edge number 1. Let's go to edge number 2 now. Let's look for bars that close in the top 25%. And look at all these bars here. All right, they're telling you that the short-term time frame is in sync with the overall time frame. So these are rules 1 and 2. Now we have 3 more rules into identifying that pattern that need to be met for a strategy number 4 signal to be generated. Now, none of these right here on the left qualify, but this one did. This is a strategy number 4 buy signal, happened just a couple of weeks ago, and look what happened in the next week or so. Could have made a nice 10-point gain. Now, what had happened if you had looked to go short? How well would that have worked? Just like the slot machines, you would have had a couple of days of profit, and then you had to be quick because look what happened, right back up. You'll have a higher level of consistency if you apply these 2 edges. You can start using them as early as Monday. Here's another example, okay? This is in Micron. Once again, the way I used to look at charts like this, I'd say, well, you know, Steve, someone would say, Steve, there's major resistance here. All right, this is where all the institutions are selling. If you're a student of institutions, I'll have you know that when I was on the floor, I traded with the institutions. They used to enter orders in my book, orders in Waste Management, IBM, Beverly, a lot of different stocks. And guess what? They had probably the worst performance of any other trader I ever traded with. They were always entering at the wrong place. They were always exiting. They were always canceling their orders. I would never rely on what the institutions are doing. But let's just say you like to follow that, and you say, well, Steve, you can't go against the resistance right here. There's major resistance. We can't get above that. That's where all the banks are selling. Okay. Well, remember, we stopped looking at what an outside source is telling us. What is the market telling us? The way to do that is apply the 50-period moving average. And we ask ourselves, where's price? It's above. We only had one bar close below. The majority of price bars are closing above. So even though you may think there's some resistance here, the market is telling you the overall trend is up. You should look for buying opportunities. Now, if we look for that short-term time frame, we see a number of bars that closed here. But the ones that met the remaining requirements were right here, 1, 2, and 3. And look what happened. You could have potentially captured 15 points by applying any one of those strategy signals. Here's an example now in Costco. Okay, this was just a few weeks ago. Once again, someone looking at this would say, okay, it's been going up, but we've got a bearish engulfing pattern here, extremely negative. Okay, bearish engulfing pattern. It says even its name, it's bearish, right? So we should sell. We should get out of this. And for the next couple of days, it goes down a little bit. Let's say you got short, but where is the overall trend? The overall trend is up. We're above the 50. So I don't care what pattern you're looking at. It doesn't matter. Have to be candlesticks. Doesn't have to be, support and resistance. Makes no difference. If the overall trend is up, we only want to have a buyer's perspective. And on top of that, look what happened on the very next bar. Now, if you're still short, you're basically breaking even or maybe taking a small loss. And on top of that, we closed on the top 25%, and it met all the requirements of the strategy number 4 and generated a buy signal. So we are in sync with the overall trend, in sync with the short-term trend. And look what happened to Costco just last week coming into this week, 20 points. So how well did that bearish engulfing pattern work? Remember, you want to be in sync with the overall trend and the short-term trend. You'll have a higher level of consistency. Now, we have nothing against candlesticks. In fact, we have a couple of courses that incorporate candlesticks. But the first thing we teach our students is you always have to be in sync with the overall trend. Okay, here's an example now in American Electronic, okay, AEP. Once again, let's say, well, Steve, there's major support here. I took that $20,000 course on support and resistance, and it meets all the requirements here for major support. So I'm going to be a buyer. All right, let's apply the 50-period moving average. Well, it's not giving us a real lot of information. It's closing above, closing below, back above. But what do we have here on this last bar? We closed below, and we closed in the bottom 25%. So this is a little bit more advanced signal, but it still meets all the requirements right here, even though we closed just one bar below. It's a sell signal, a strategy number 4. Had you taken that, you could have potentially captured 10 points. And if you missed that signal, another one was generated on the next bar. All right, let's look at an older chart of Amazon right here, right? Most traders would say, wow, Steve, there's nothing, it was going up and then it's going down. I don't think there's any trend here. I'm going to kind of stay away. What do we teach our students? Always apply the 50-period moving average. So even though it may have gone down recently, that's a buying opportunity. Why? Because the overall trend is up. We're above the 50-period moving average. So we look for bars that close in the top 25%. We have one right here. And on top of that, it met all the remaining rules of a strategy number 4 buy signal. So let's say you bought, and you could have potentially captured 23 points coming into mid-June. Okay? See how simple this is. We're not looking at any news. We're not looking and concerned with earnings reports. We don't care about economic reports. We don't listen to anybody in a chat room. You can make your own decisions based off this simple, very powerful pattern. All right, range market, right? We're always taught to stay away from range markets. The minute you buy them, they go straight down. You sell, they go back up, and then vice versa. But is it really a range market? If we apply the 50-period moving average, we see that the majority of bars are closing below. Now, we have some bars closing above that close in the top 25%, but none of them met the remaining requirements of a strategy number 4 buy signal. So there were no buys, even though we closed above. Remember, just because we're above the 50 doesn't mean you go buy at the market. You have to apply the structure. But guess what? Below the 50, look at all these sell signals. They all closed in the bottom 25%. We're all below the 50-period moving average. and they all completed the pattern that we teach you how to identify. So right now, even though it looks as if PayPal was in a sideways range market, it's basically screaming, I want to go lower. And look what happened. All of a sudden, it fell out of bed 13 points. The good news is, if you happen to miss any of those, the market will always give you another chance to get back in. 2 more sell signals were generated along the way. All right, let's look at another market, entirely different market, the Forex market. Here's a snapshot of the Japanese yen. This is coming into May, all right? Once again, not a real clear-cut idea of what's going on here, but if we apply the 50-period moving average, well, then we know that the majority bars closed above. So the overall trend is up. So I'm not even going to consider selling the Japanese yen, even if some guy in a chat room tells me, you've got to sell this. There's some economic news or some indicator coming out that's going to cause the yen to really go down. Nope, I don't care until it closes consecutively below it. Until then, I'm looking for bars that close in the top 25%. There's one here, there's one here, one here, one here, and also that meet the remaining requirements of strategy number 4. And guess what? We have 2 right here. So had you taken either one of these setups, you could have potentially captured over 500 pips coming into June, all right? See how simple this is? If you're in sync with the overall and the short-term trend, very cut and dry. There's no room for discretion or subjectivity. It's very cut and dry, and I think traders are looking for that. All right, let's look at GFS. This is what we mean by consistency. Remember, consistency doesn't mean you're going to have a lot of winners. Consistency is an awareness that you will have losses from time to time. That's perfectly okay. Some of the best traders I know lose, from time to time. They don't worry about it because they have a method that's able to recoup that loss. So you have the confidence to continue on trading. Not the, with so many other methods where you go into a series of losses and you say to yourself, I can't trade this anymore. I can't take any more losses. For example, in GFS, this was a buy signal. All right, we're above the 50. We close in the top 25%, meets all the rules. So let's say you take this, and in the next 2 days, you're not seeing any gains. You're saying to yourself, wow, I'm going to be stopped out pretty soon. This is not working very well. Really don't understand it. I thought this was supposed to work. All right, but what do we have here? We have a bar closing below the 50-period moving average and in the bottom 25%. Now, this is a little bit more aggressive, but it still meets the requirements of a sell signal. So in order to be consistent, we want our traders to stop and reverse if they can. So you would have exited this buy and reversed and gone short. You would have taken a small 3-point loss, okay? That's all determined how many shares you purchase, but still 3 points is not a lot. But here's what we mean by consistency. Now you're on the short side. Look what happened. You could have potentially captured 13 points, enough to make back that 3 points and then some. This is the true definition of consistency, an ability to recoup a loss sooner than later. Let's look at a very current chart here in Tesla. This just happened a couple of weeks ago. Now we've been going straight up, right? Tesla's really, if you were a long Tesla, you say to yourself, wow, this is great. I've got a nice profit. Or maybe if you were thinking about Tesla, you go to that chat room and they say, Don, I wouldn't buy it. Here's a bearish engulfing pattern. It meets all the requirements at the very top of a nice run. Looks like a reversal. So most likely you should sell if you're long, or most likely go short. So you say to yourself, okay. And for the next 3-4 days, it goes down a little bit. Here's what we teach our students. Where is the overall trend? Obviously, it's up. It's been going for a long time. So we're going to look at any sell-offs as a buying opportunity. While it's going lower, we look for bars to close in the top 25%. We have a couple of them, 2 or 3 right here. But only this one meets the requirements of a strategy number 4 buy signal. So rather than thinking you should be going short Tesla, we're actually going long, and you could have potentially captured 35 points just coming into this last week. Once again, go back and look at your last 10 to 20 trades. I can almost guarantee you that the reason why you lost is because you're not using these 2 simple edges that I've taught you today. Remember, these are the first 2 rules of strategy number 4. Here's an example now in Netflix, all right? Going back to May, we're above the 50-period moving average. We have a buy signal right here, closes in the top 25%. Let's say we realize this is an expensive stock. Let's say you bought options, okay? Maybe you bought calls, or maybe you bought some type of spread strategy with a bias to the upside. And the next day, you've got a nice profit. Now, this is why we say it's your decision. In other words, you should trade according to your means. If you're the type of trader that likes to get in and out quickly, well, then obviously you could exit here if you like, take a nice profit and say, thank you. That was a nice one-day gain. If you're the other type of trader, though, that says, hey, listen, I like to go in for the long haul. That's not my style. Well, that would have been wise as well because another buy signal was generated here. Perhaps you could have bought more, doubled up, or maybe just stayed long your original position because Netflix went up 100 points coming in to mid-June, just about 3 weeks ago. How about ILMN, okay? Now, here's a perfect observation example of an uptrend. Higher highs, higher lows, right? We're in an uptrend, obviously. Or are we? Nope. We are simply bouncing in an overall downtrend. This is actually a selling opportunity, not a buying opportunity. And we look for bars that close in the bottom 25%. And we have 3 here. And they also meet all the requirements for a strategy number 4, sell signal. So where most traders were buying, say, hey, Steve, this is going up. You got to get along this. Our students knew to go short and potentially capture 23 trades coming into this past week. Okay, these are very recent setups that our students were able to catch. Now, someone looking at this older chart in the video would say, gosh, all right, this thing has skyrocketed, but how did I know? I mean, there's no way to have known it was going to take off like this. In fact, how would I have known this was even in an uptrend? Well, looking back in hindsight, it really wasn't that hard. If you had applied the 50, you would have known well in advance back in January of this year, a good 6-7 months ago, that it was wanted to go higher. And on top of that, look at all the buy signals that closed in the top 25%, and that met all the rules of strategy number 4, okay? All without the aid of having to listen and take orders from someone else telling you how to trade. You have to be in charge of your own trading process. All right, let's look at Moderna now. Obviously in a downtrend, right? We're going straight down, but what is this? It's a reversal. We opened lower and closed higher. Hey, Steve says close in the top 25%, so that's a good sign, right? Yes, it's a good sign if we are above the 50. Where is the 50? Well, we don't care because it went up for 3 or 4 more days. So who cares where the 50 is? This is going up. Well, we're below the 50, so this is a seller's advantage, not a buyer's advantage. Sure, for 3 days, like I said before, you may get some nice setups below the 50, and everyone will say, well, why would I listen to that guy? That stuff doesn't work. Because how well did it last if a sell signal was generated? And sure, you had maybe 3 days of profit, but you didn't get out, and you could have potentially captured 30 points. Remember, we're all about instilling the odds in your favor. Sure, you may have some nice setups to buy below the 50 and sell above the 50, but just like the slot machines, if you do that over time, you'll most likely end up giving it all back. You'll be much more consistent if you're in sync with the overall and the short-term trend. All right, looking in hindsight, how could we have taken advantage of this 4-hour chart in the Canadian dollar? Someone would say, well, yeah, it's easy to say I should have sold and gone short, but how did I know that? Well, you apply the 50 and you would have known that well in advance, going back here to the beginning of June. And then you apply strategy number 4 and look at all the chances you had to go short and sell prior to the currency pair dropping over 200 pips. All right, let's look at that first chart we share with you in AVGO, Broadcom. Remember, it looked like it was in a whipsaw market, right? We're always trained, stay away from these markets. But what's the first thing we do? We apply the 50. Now, the majority of bars are closing above the 50. We have a few bars closing below, but none of the bars that closed below generated sell signals. But look at all the bars that closed above that generated buy signals, a total of 5 bars. So these bars all closed above the 50 and in the top 25% of their range. They met the requirements of strategy number 4 rules. So now we say to ourselves, wow, this is screaming that it wants to go higher. Even though it looks as if it's going sideways, this is a screaming buy. And that's when it went 300 points in just 2 months. Remember, you just learned the very first 2 rules to strategy number 4. These are 2 edges that I truly believe will change the way you trade. The theme of the day, trading is simple. It's the individual trader who makes it more difficult than it has to be. You've just seen how simple these 2 edges are. The remaining rules of the strategy are just as simple. We just have to complete them in order to generate a signal. All right, let's recap. Some of the highlights of strategy number 4, it's a pattern recognition strategy, a pattern that repeats itself over and over again. It's designed for traders looking to catch momentum. And the beauty of strategy 4 is that signals will be generated, as you just saw, before it looks as if there's any momentum taking place at all. Many times it'll look as if the market is going sideways in a range or just a whipsaw market, but it'll be generating numerous signals for you to get in before momentum kicks in. And lastly, you can apply it to all markets and time frames. We showed you examples in the Forex and stocks, different time frames. It's a great, great method to trade for all markets. It's extremely consistent. We share with you examples of how you would have a loss here, but then you were able to recoup it. It makes you a part of the process because we teach you in the course, not just where these setups are, but we teach you how to exit, how to enter it, and how to place your stop. And it's designed to be as simple as possible. As I said, we have traders who have been trading for less than a week who are trading strategy number 4. That's how simple it is to learn. So ask yourself, do you think this strategy can help your trading for the remainder of 2023? Now, everyone starts off the brand new year with all these hopes and dreams. They promise themselves that they'll be up so much this year. Maybe they can go on that dream vacation or have some extra income for the month or have that addition to their house they've been waiting for so long. And most likely, by the time you get to mid-year, you know that there's no way you're ever going to achieve those dreams, right? How would you like to finish out strong? I think strategy 4 can really help you finish out the year strong, and you can hopefully get somewhere close to those dreams and wishes you had that you wished upon at the beginning of the year. Because of that, we have a great special offer for everyone attending today and listening to today's educational presentation. We're going to offer you our most consistent strategy. Strategy number 4, you're going to get instant course access, detailed instruction. You'll learn all the different variables for entries, exits, and stops so that you can be in charge of your trading. You'll get the automatic buy and sell arrows, complete course rules. Remember, you can apply this to any market and any time frame. Now, if you're not sold already on how consistent this method is, let me share with you some recent examples of this taking place. Here's an example, in JOBY, okay? Sure, it had a really nice run up, but it looks like it's met some resistance here, a so-called top, a bearish engulfing pattern. You've got to sell it, right? And for all intents and purposes, it looks like in some type of downtrend. So it's a good thing that you didn't buy it because we're going lower. But what do we have here? We're above the 50. So this is a buying opportunity, not a selling opportunity. I don't care if it was a great sell up here. We're looking for a buying opportunity. So a bar that closed in the top 25%, such as this one did, and that meets the remaining requirements. And so strategy number 4 found this and identified it and generated a buy signal on the 27th, just about a week ago, okay? Look what happened. In one day, the price of JOBY gained 45%. Think of it. This is a cheap, inexpensive $6 stock. It gained 45% in just one day. You could have bought a lot of shares because of its inexpensive price. Here's another example. We're looking at Wolf, WOLF. Once again, most traders would say, can't really tell what's going on here, but if you apply the 50, this is a buying opportunity. Now, no signals have been generated using strategy number 4, but look what happened on the very next bar. We are above the 50 period, and we close at the very high of the day. And these are the first 2 edges I shared with you. On top of that, the remaining 3 rules of strategy number 4 have been identified, and a buy signal was generated just a few weeks ago. Look what happened after that. A 17-point gain coming into last week. These are all things that you could have taken advantage of in the last couple of weeks. I know a lot of times you'll see webinars where they show you some great examples and they happened like 6 months ago. This just happened a week or so ago. You could have taken advantage of a 17-point gain. I've been trading strategy number 4 for over 46 years. I continue to use it to this day in my own personal trading. I really feel it can help you to take you to that next level. If you've been struggling, if you've been having a difficult time trading, really think that you should become a student of mine in the strategy number 4 course. Here's how to take advantage of this, okay? This is our strategy number 4 special offer in our association with MetaStock. The strategy number 4 regular price is going to be close to $600, $599. What we're doing for this presentation for the Online Traders Summit is we're dropping that price down to only $499. You're going to save $100. That's a special discount price if you act now, because this is for a limited time only, okay? This is a great price. You're also going to get educational correspondence, meaning that you'll get my personal email address. You can contact me virtually whenever you'd like. Now, I'm on the West Coast. I was answering emails from my students around the world this morning. So usually I will get back to you within the day. Sometimes I get back if it's not that busy. If you have a question concerning what's going on in the real-time markets, I can get back to you within a matter of minutes. So it's like having a personal mentor sit right next to you. So you'll have educational correspondence and a great method that I currently use myself. Take charge of your trading for the very first time. Become a student of mine in the Strategy Number 4 course. Here's how to take advantage of this great offer. Contact MetaStock. That's the email address you can contact them at. I would highly suggest giving them a call at 800-882-3040. They have trading consultants. They can take your order over the phone or give you any more information you like about Strategy Number 4. And I believe Jeff is probably going to post that link you see there, or that phone number to contact them. And this special will last for a limited amount of time. So please, if you're interested at all, now's the time to take advantage. Now, I thank you all for taking the time to listen to the presentation. I believe we have a couple of more minutes. I don't want to step on the next presenter's time slot. So I don't know, Jeff, if you have questions for me real quick, I can kind of go over them and I can answer anything that students may have asked, or if we have any questions at all.
Okay, sure. Let's see. We do have a couple of questions from Julian. Julian wants to know, how much volume is required to decide on the patterns? So as part of your patterns, do you take volume into consideration?
That's a great question. And the good news is, remember we started out the presentation saying keep things as simple as possible. Volume is not a consideration. It's not required at all. Okay, that's the good news. We're only using the factors that contribute to this pattern, and volume is not one of them. Now, we never dissuade anyone from using anything. In other words, if you're a student of fundamental news and you like to look at volume, sure, go ahead. But by all means, use whatever you want that makes you feel comfortable, but it's not required at all. Remember, we want to keep our trading simple, and we feel that these things only clutter and make you a little bit more confused.
Another question that he had, so Bigalow focuses on the 8-day moving average and you focus on the 50. Would you incorporate both?
Sure you can. Steve, Steve and I have different methods and different ways for generating signals, but we're really going down the same road. If you listen to Steve's presentation, which I did, we believe in a lot of the same thing, where you have to make your decision. Don't rely on what's going on outside of the market, someone telling you what they think. The last 20 minutes, Steve talked a lot about that, how the people will be telling you their opinions about what they think a stock should do. Follow on what the chart is telling you. Now, he has one way of looking at the chart. I have another, but we're still following the same guidelines. Everything you need to know is right there on the chart in front of you. And the reason why our opinion is most traders fail is because you're using traditional worn-out wisdom, which is basically having someone or something tell you how to trade. If you learn to listen to the chart, which Steve talked about as well, you'll see how you can become consistent and how things are a lot simpler. Now, if he uses a different moving average, I believe he's using it more for a short term. When I use the 50, I'm looking at the overall time frame. And the reason that is because, remember, if you're a trader that likes to trade daily bars, if you're a trader that likes to trade monthly bars, or if you're a trader that likes to trade 10-minute bars, the 50 period, in our experience for trading this for over 4 decades, works well with all those different time frames. See, we don't want to change and alter if we have to go to a different time frame or a different market. So that's why we applied the 50. Okay.
Yeah, I really like the answer to that. Just the other day, I ran a scan in MetaStock and came up with a signal, and I used another method to confirm it. And that's what I really, I think it's always good.
And I always tell prospective students, do your own research, your due diligence. Go back and look at your last 10 or 20 trades. Most likely you're losing trades were because you were out of sync with that. And most likely your winning trades were because you were in sync with that. So that can just really help you. But you can also combine things from Steve and from other educators. Just we don't want you to overcomplicate things. That's all.
Yeah, find something that works.
Right.
DD929 wants to know, what currency pairs do you trade?
Well, remember, once again, we're not about talking about what we trade. I used to trade the currency pairs tremendously. What I focus on mainly is the E-mini futures. That's mainly my market of choice. But I was trading the British pound, the Australian dollar. I was trading the yen when I used to trade a lot. When we show examples, we have we have a large number of students that only trade Forex markets. So we show them how simple it is to apply this same method. But remember, as I said in the beginning, we never want our students to pile on and say, well, I want to know what they trade, then I'll do exactly what they do. No two traders should ever trade alike. You have to find your own way, because that turns into a crutch. So I really don't like to show. I tell students all the time that I use strategy number 4 on the E-mini futures. But you know, whatever I'm trading, what time frame, that's really for you to decide.
Cool. Okay. And let's see. Herbert wants to know what your thoughts are about your strategies 1 through 3.
Oh, those are great strategies as well, but they're entirely different because there's different ways to view the market. Number 1 is a pullback method. It's a really consistent pullback method, but it's looking to buy only at lower levels within an overall uptrend, okay? Strategy number 3 is the opposite. It's a continuation method that is basically looking for a trend to already be established, and it doesn't matter if you want to buy at the high. If a signal is being generated, it's saying that most likely there's a little bit more room left in that. So you see, there's totally for 2 different types of traders. Now, when I first started out, I was more of a continuation trader, because I was on the floor, and I was, even if a stock was up 5 points, I was buying it because I knew it was going to go higher on the day. Now, as I get older, I'm more of a pullback trader. I like to wait for stocks to go at lower levels to buy, because my risk is lower and I'm not getting as many trades, and I don't mind waiting. The good news about strategy number 4 is it's kind of a hybrid. It's a hybrid between a continuation and a pullback. So everyone should trade according to their own means. You know, if you're the type of trader that likes to trade a lot of signals, and trade strategy number 3A. If you're the type of trader that likes to trade less signals but at a higher probability at a lower level, then trade strategy number 1. Everyone has to find out what works for them.
All right. And I think that's the last question we have time for. But I did want to read this comment to you. Your presentation of your powerful strategy is greatly appreciated. That's from Long Wen. So thank you, Long. Appreciate that. I'm glad you enjoyed it. I'm going to talk a little bit more about it. But Steve, before we let you go, I want to say thank you for coming in. Thank you for spending some time with us. And thanks for helping us get a little bit back on track with time. Yeah. I know we started you quite late, so I appreciate that. Thanks for coming.
Thank you so much, Jeff. I hope I didn't rush a little bit, but you can see the consistency of this method. And I think Jeff has some great information to show you how you can apply it on MetaStock.
Absolutely. Thank you so much, Steve. One of the things okay, all right, cool. Let me go ahead and one of the things that I really like is how much just information is included, or the training that's included too, because it's a simple method. I'd like methods that are easy to see, easy to understand, easy to implement, the things that I can understand. And we won't go into a huge amount of detail, but one of the things, I just want to show you the same chart that we were looking at with Meta and kind of the strategies, and the strategies are automatically drawn on the chart for you. In addition to that, you can scan for them. So you can go in and create explorations. The way that the exploration actually works without actually just kind of running it is it'll show you anything that happened yesterday or on the current bar in the same scan. So as Steve talked about, you're going to want a confirmation. When that confirmation comes in, you're going to want to be able to see it. So it really takes advantage of the core power tools of MetaStock, like the expert advisor, to draw these signals on the board for you. It really takes advantage of the scanning engine. And I think one of the things is one of the things we absolutely do best is explorations. And that ability for me, with just a few minutes left in the market day, to run an exploration and just be able to identify what stocks are kind of coming up, so helpful. So with his strategy number 4, you're going to get an exploration. You're going to get the expert advisor. You're going to get the layout that puts the 50 SMA on there. The thing I really like about this is it comes with actually 12 training videos. And I'm not going to read through all of them, but you get the rules, you get the buy and sell line, the entry, the exit technique, stop placement, ideas for how to do position sizing, things that you should be looking with that, simple ways that you can increase your odds, gap opportunities, trading strategies, just you do a whole collection of course materials that are just available for you. They're online. You can go through them at your own pace. And if you enjoyed Steve's presentation, if you thought what he was talking about was understandable, something that was addressable, well, he's got 12 videos that just kind of help make sure that you implement that well in the trading that you do. So a big thank you for Steve coming in, showing us that. The normal price for the strategy number 4 is $4.99. Here at the summit, we're going to do it for $4.97. There's a little typo right there. $4.97 is the price that we're going to do. And we do give that, you do get all the training, all the method, the scans, all that kind of stuff. We do offer that with our 30-day money-back guarantee as well. So 1-800-882-3040, metastock.com/specialist-trading-A will also get you there, or metastock.com/sales-chat. If you have questions, if you want to see maybe some charts, feel free to reach out to our guys. They'll do a really good job of helping you out and kind of helping you with it. So in addition to that, it is part of all of, I think we have some of our best presenters today, some of our best methodologies, some of our best add-ons. So we have a Trader's Action Pack that's going to get you everything all in one package worth a huge discount. So you can get the Steve Bigelow's brand new CPS 3.0. You can get Steve Primo's Momentum Strategy number 4. We're going to have AAII. We're going to have Ray Rondeau come up next. He's going to talk about Conviction Plus. You'll get some training from Oscar Carboni. You get some around the horn by Adrian Manz. And we'll also give you a 3-month subscription to learnmetastock.com. Normally, the price for all of this would be $3,987. Here at the event, it's going to be $2,344. So you can do that. If you want to go to metastock.com/summit deal, you can give us a call at 800-882-3040. And you can also visit us online at metastock.com/sales-chat. So anyway, we've had a lot of questions. Real quickly, I want to say thank you again to our sponsors, AAII. You can find more out about AAII.com. Or about them at AAII.com. They're great. They've been great to work with, particularly Ray, who's up speaking next. In addition to that, if you want to get a free issue of Stocks and Commodities magazine, they're a partner of MetaStock for going on 11 years now. I think we've been doing these long style events for 11 years now, but they've been a partner ever since day one. If you go to metastock.com/traders-summit, you can register for today's event, especially if you're watching on YouTube. But you also, there's a checkmark box where you can get a free issue of Stocks and Commodities magazine. You can get free membership to Steve's room. You can get, there's all kinds of really good bonuses and add-ons. So if you're watching on YouTube and you just stumbled across the link, right after you like and subscribe, go to metastock.com/traders-summit and register for the event today. We'd appreciate it. It helps us a great deal. So in any case. One of the things that I was going to say real quick is we have had a lot of questions about the recordings. So if you're watching us on YouTube, the recordings are just going to be the same place that you're at. So if you want to just bookmark the page that you're on YouTube right now, you can watch the stream anytime you want. We don't charge extra for the recordings. We keep them available forever. And actually, kind of funny enough, most of our actual views come after the event, not during the event. So if you're watching this on YouTube, hit the like and subscribe. It does help a great deal. We do these kind of events all the time. And we also do other types of events like market recaps and full week conferences and single session conferences. And so if you're liking the content today, I am, subscribe so you can get notified when we go live. If you're watching us on GoToWebinar, let me finish my thought and then we'll move on. If you're watching us on GoToWebinar, 1 hour after we complete the webinar today, GoToWebinar will automatically send you an email. I've already got it queued up and ready to go. And it's just going to send you the link to the stream on YouTube so that you'll always have that recording. So there you go. Thank you for all the questions about the recordings. When we get questions about the recording, that makes me feel like we're doing a good job. So I hope you're enjoying the event today, and I hope you want to come back and watch it again. And I think the presenters are doing awesome. So thanks for coming. Thanks for participating. Like, subscribe, all that good stuff. But there's how the recordings work. So in any case, our next presenter is also awesome. You're gonna like him. One of the things I'm going to say about Ray, I'm going to say a couple of things about him, and then I'm going to kind of get the time turned over to him. Ray is I love kind of the unique ways that Ray creates his indicators. Last time we had him talking a couple weeks ago, I think it was, and he was kind of talking about kind of like the pitfalls of certain indicators versus other indicators and kind of how he had designed around that. And what you're going to find out is he's like a super smart guy, especially when it comes to kind of the studies that he's designed. So I really like the indicators that he kind of creates. I know why AAII has him as kind of one of their technical analysts. He does a really, really good job. And one of the things that he also does a really good job of is system design. And one of the things that I really think is impressive about what he has to say is he creates systems. And I think he'd agree with this. You're welcome to disagree with me if you want to later, Ray. But I think one of the things that he's really concerned about is that equity curve, consistency of the equity curve, avoiding big, huge account blow up events like drawdowns and stuff like that. So he does a really good job with that. He's also been trading, I think he said, since the 90s, and it's been his sole source of income, I think, since 2000. So correct me if I'm wrong on that as well, Ray. But we really like Ray. Last time he presented, he made me laugh a couple times. When he started to talk about kind of the advantages of his webinar, of some of his indicators, there were some really serious light bulb moments for me. So in any case, let's go ahead and get you started, Ray. How are you doing?
I am here and ready to go, Jeff.
All right. Did I miss anything important in that introduction?
No, I would say no, absolutely not. The only thing I would say is I'm just trying to find my monitor here is I have about 47 minutes of formal material, so we're going to have to step on it a little bit.
Yeah, you're totally fine. So the next presenter we have, I'm going to just warn him that we're going to start him late. After that is my turn, and I can talk for as long as I want to or as short as I want to. So don't worry about time. Try to keep it within a reasonable amount, but we can modify it as we need to, and we always do. Time is always something that we're kind of running behind in these events, so not a problem. I can see your screen though, and I can hear you. You're coming through well. I don't see your webcam. I don't know if you wanted to turn that on or not. That's up to you.
I do want to turn it on, and I'm not sure why it's not on.
I can send a request through, and that might help.
That would help me. What a professional.
There we go. Cool. All right. So I can now see you. I can hear you. I can see your screen. I'm really good at getting out of the way. So it's your turn. Go.
All right, guys. Well, thank you. And ladies, of course. So welcome to today's presentation. I would like to thank you for attending. And these are really great events, right? I mean, MetaStock does a great job helping retail investors and professional investors. The primary focus of this presentation is going to be on the concept of conviction again. And really our long-term goal, our trading strategies with hit rates of 85% and profit factors of 3.5 to 1 realistic. Are they attainable? Is there evidence to back this up? And what are some of the factors that make up these systems? This presentation has 5 sections, again, around 48 minutes of formal material. Section 1, we're going to look at strategies in general, some of the design elements, and the importance of understanding performance reports. Section 2, we're going to do a quick review of the basics of conviction. This was covered in previous webinars. Section 3, we look at the indicator kinetic conviction, how we use it, and why it's more effective in today's high volatility market environment. And then on section 4, we'll look at the conviction factors and some of the scans that make it up, how some of our systems are very different than others. And our final section will cover the 7 methods to improve any system's performance, including the conviction systems. And that's kind of the must-see TV. So that's a pretty interesting area. Before we start, a little housework, and you don't have to read this. If you want to, you can. This screen basically states don't steal our stuff. And the next screen tells us all the reasons why the material may not be 100% accurate, that there are exceptions to every rule, and why the materials may not be suitable for all investors. Now, do you have any questions on this? I'm kidding. I don't want any questions on this. But if you do have questions, please write them down. You can put them in the chat. Jeff answers a lot of these. He's a pretty smart guy. And if not, we can try to get to some of these at the end. Even with these questions, because we're going to cover some of the areas relatively quickly, please keep in mind that AAI supplies full education classes on many investment topics, including conviction. As an attendee today, I believe that everyone is going to get a free class on active investment management. In this video, you can see what the class entails. It's a lot of stuff: additional resources, slide, tools, testing, credits, certificates of completions. You can even use the credits for benefits for other AI products. With these classes, we also provide you with an additional AI instruction guide. In addition to the MetaStock version, this covers a lot of different things, how to interpret it, what the calculations are. We give a lot of examples. So take advantage of this stuff. It's there for your benefit. Conviction, what it can do for you. Because there's been so much confusion around the concept of conviction, this MetaStock offering the tools and the systems and how conviction in this presentation can assist investors, we're going to start here today with a brief 5-minute section. The concept and reasoning in this presentation can assist all investors if you use conviction or incorporate it into your trading approach. You don't have to. A lot of this theory you can use. For those that choose to use conviction, there are 3 specific tools that can be used. 2 of these we've already covered in other presentations. They may be available offline. Jeff may be able to put the link in. I'm not sure. Those were RCM, relative momentum conviction, and you can see that right here at point A. It would be good if I turned on my laser pointer right here. And then we had OBC, optimized balance conviction. We'll talk a little bit about these coming up. In the next section, we're going to talk about kinetic conviction right here, and that's really the primary focus of this presentation. Now, to be clear, these indicators can be used in isolation, probably better together, and they do plot signals right on the chart, as you can see here, but there's a subjective quality to using these, like with pattern recognition, trend analysis, and classic indicators like stochastics and RSI. There's an interpretation element. But the positive is that all these tools can be used in conjunction with other trading and investing approaches for deeper insights, including with the 2 previous presenters. The other component of the conviction systems is the systems themselves. And to be clear, they show actual signals, both historically and in real time. These signals are pure and there's no ambiguity to it, like with many other approaches. There's no second guessing. The slope of the line wasn't correct. Well, yes, but you shouldn't have took the trade. There was a hidden Fibonacci resistance that you didn't factor in. That's why it didn't work. It's not like that. These are very acute signals. You don't need more training or anything else, just the systems and an understanding of the systems. The results, albeit historically, are direct. Now here you can see the back-tested results of one of the systems. This is called the conviction profit factor system. And we're going to look at all the systems and how to trade them in more detail at the end. But this table shows the performance results. If you took every single trade, there was only 410 of them over the last 10 years, and these were generated on every single stock in the S&P 500. When reviewing systems, ours are on your own. I would recommend key things to look at. Your hit rate, this one was around 81.7%. Profit factor is certainly important. This was 3.73. And you can see that this we had a 2.78% non-compounded return on a 26.5-day duration. And that non-compound equates to over 30% a year. Again, non-compounded. And that's it. We just assumed that you took the profits after each trade. Now, there are major advantages to backtesting and generating performance reports, and that's my methodology. And I want to highlight some of the other key elements to look at when you're evaluating a system. Jeff alluded to this. Risk control and equity curve analysis is an important consideration, especially in our systems. To be sure that we're on the same page here, what you see is the realized equity curve of the profit factor system. It's the actual back-tested computer-generated equity curve of the system. These are not hand-drawn lines or return lines showing the returns of 1 or 2 securities that are hand-picked because they worked out well. And I'm telling you right now that these results are actually much better, and these are being significantly understated. And I will, for all intent purposes, prove that in our last section, that these numbers and everything that I'm showing here is very much understated. Unfortunately, this conviction system is very selective, and it only generates about 41 trades per year. So if you desire more action or longer holding periods, then we have other systems that might be more right for you. Now, although these reports are computer generated and precise, these are still historical results. But we do have some recent figures for you, and they should be more recent. And the next slide is. But if you started following the conviction system the day following my first MetaStock webinar on May 8th, and then when the product went on sale, you started trading on May 9th, and you held to May 31st, because I didn't update this. I did update the next one. You would have had 27 trades. It was 23 winners and 4 losers. These are direct. Everybody would have had the same thing. You can confirm this on your computer. The green screen shows the actual signals and all the signals. Total profits were over $3,000, and that's by allocating $5,000 per trade. Now, I did run the base reports on the LT system, and we're going to talk about these again. This system had a rough patch, but profits from May 9th to date were $5,677 if you allocated $5,000 to each signal. Obviously, if you're only putting $1,000 per trade, you would have already paid for the entire conviction package. And cost return is an important consideration in any system's evaluation. Now, backtesting is not perfect, far from it, and a few headline numbers can be easily manipulated. And, as we know, historical results are not transitive to future returns, and you knew I was going to get that in. So included with conviction systems, because there's no system that's right for everyone, including these, we provide each conviction user extremely detailed reports for all 3 systems, so you as an investor can make an informed decision. Things to focus on in these or any system evaluation, as we said, are the equity curve, performance consistency in good markets and bad. The PR system didn't have a losing year, including during COVID, and incredibly, it never produced more than 2 consecutive losing trades in a row in 10 years. I mean, think about that. It never lost more than twice in a row. Max consecutive wins was 20. Other things that we provide are the study parameters, so you can assure that they're realistic and they will fit your profile. How much capital is needed? I'd say you probably need maybe at least $2,500 total to start one of these. Was the study over a long duration? Were the dates curve fitted to a bullish market only? We always go back 10 years. This included COVID. This is critical. Is there a large sample size? We did all 500 stocks in the S&P 500. Showing examples of individual stocks where a system works tells you nothing. All systems work sometime, right? Performance reports showing where they don't or didn't work, how often and to what extent are a critical part of the evaluation process to make an informed decision. Other key areas that we provide are hit ratios, certainly projected returns, the popular ratios, transaction entry and exit efficiencies, and drawdown efficiencies. As you want to be aware of performance in the worst times to see if it matches your risk profile and if you think that you can hold through it. We also provide yearly return consistencies, as you can see right here. Lastly, we want you to be confident that the trades are verifiable. You should always do this. So we provide you every single trade historically, so you can back and look to assure that they match, and then you can follow along with them in real time going forward to ensure that they match the updated reports, right? Full transparency. That's something that I think is important. And basically, that's what Conviction Plus is. It's 3 intensity-based analytical tools, which we're now going to look at, and then 3 trading systems along with Prove, and that's the plus. And that's what you see on the screen here. And what Prove does is it tells you how many shares to buy of each security to equalize your downside risk on a volatility-adjusted basis, as we want each position to have an equal end effect on your portfolio's performance. It also has a very good hedging strategy to neutralize risk, and we're going to be having a webinar on that tool coming up in a few weeks. Conviction basis. In this section, we're going to look quickly at conviction and why it can help an investor. And I will say we're going to do this quickly. If you're interested in conviction, really go back and watch the other webinars. I think we all know what volume is. It's simply the number of units, shares, or contracts transacted in a given time period. And it's widely used and it's the tool of choice for measuring intensity. And the base reasoning for the importance of volume is that price movements on days with relatively high volume are considered more important and relevant than price moves on days with lower relative volume. High volume signifies importance. The big boys are here, maybe dock pool activity. And we often see high volume at the beginning of a new price trend or at the end of an established price trend or on a major breach of an important technical phenomena. So we want to incorporate this into our analysis. And we can expand this theory to volume and trends. And we were taught that volume expanding with price moves in the same direction of the trend is supportive of the current trend. We can see that in our green arrows. And on the same token, lower relative volumes and diminishing normal retracements of price back to the trend are also considered supportive to the current trend. And these are our arrows right here, red arrows. And this is logical, and we use this as one factor determining if a trend is likely to continue or reverse. And that's all good. And this brings us to the term, the concept, the theory, and the tools related to conviction. So why conviction maybe as opposed to volume? And I should point out that conviction is just a general term that we are using. Conviction in its most basic form is almost identical to dollar volume by classic definition, with both values representing the approximate total dollars exchanged over a given time period. Not volume, but total dollars or total dollars exchanged in a security on a one-day period. And I would propose to you that this is a superior alternative to volume. First, why do we even assume that conviction is relevant? Well, I'm going to tie this in with section 1, because conviction is the base factor for all of the convection systems. And how do we know this? We test it for validity. I want you to look at this table right here, and this is taken right from the computer-generated reports. Notice how on the right here, every time we increase the conviction factor going down, the number of trades obviously decreased. As we would expect, it's becoming more restrictive. But notice how the average trade profit, the K ratio, and the total return to max drawdowns almost universally, step by step, improved across the board. And higher values are better, and a K ratio is just a measure of the consistency of return. So we do a lot of studies like this, looking over and over, and something like this would support that intensity and specifically conviction matters, as it has an effect on our end results. So how is conviction calculated? Well, conviction's calculation is very close to dollar volume, and the difference in the reasoning is covered in the previous webinars. But in a sentence, dollar volume uses the closing price, and conviction uses the average price of the high, the low, the open, and the close for a projected, more accurate reading of the amount of dollars. In truth, the difference in the calculations between dollar volume and conviction dollars is irrelevant, but the benefits of using conviction of dollars over volume is not. This is a key slide. Here we have a single colored volume bars plotted in the middle pane, and conviction dollars with the RCM indicator plotted in the lower pane, showing dollars. Now look at point A. Here, the amount of selling pressure seems to be increasing with the volume bars on this downtrend. And because of this, we would conclude, according to traditional theory, that the downtrend intensity is increasing and the downtrend is likely to continue. But when looking at the actual dollar values, conviction, at point B, we can see that the intensity is actually decreasing from a total of around $100 million per day to $80 million per day from the start of the downtrend. Yeah, the volume may be increasing, but that's only because the stock prices during this period are now less than half of what they were when the downward trend started. It creates an intensity illusion. And we invest money in balanced portfolios according to dollars, not shares. And this obviously works both ways when price rises dramatically. Here's a long-term example of this on PBF, where prices went from $5 to $50. In this view, RCM at line B seems to be supporting the continuation of the upward trend, showing supportive or increasing intensity. But when you look at volume right here, the yellow line, this seems to be showing a decrease in buying intensity against the continuation of the trend. Now, through the magic of television, we can see again it was an intensity illusion. Of course, the amount of volume was probably decreasing. The price is now 10 times higher. By using conviction, it more accurately represents what's going on. And unfortunately, this phenomenon has hurt many investors who have attempted to use volume analysis in this manner. It's not because they did not know the rules, but it's because of the visual volume skew that occurs on large price moves. And this is a mathematical certainty. And this volume relationship has caused buyers to not buy low on a turn because of that illusion of increasing selling pressure or still panic. And it also has been encouraging investors to sell prematurely in a strong uptrend because of the illusion of decreasing intensity of buying enthusiasm, with the volume bars losing steam, which conviction in general and RCM and OBC specifically address. Now, we don't have time to look at this in depth. In RCM, which is the indicator on the bottom here, does many things. But here you can see RCM identifying areas of diminished conviction on uptrends and downtrends on forward. And where the trend, so it's looking for where the trend may be weakening for a potential turn. And of course, in MetaStock, it highlights these areas with green dots and red dots, and it does a very good job at locating these areas. And here you can see the RCM signals on a chart of one of everybody's favorite companies to trade, Apple. And again, does a good job, highlights it here, grabs this one before the turn. Excellent job here. It's a little early right here. Beautiful. You can see the diminishing conviction on the downtrend. Same deal here. And it grabs these pretty nicely. Now, we don't have time to cover OBC, and it's too bad, but I want to touch on it with one slide. Unbalanced conviction is our second conviction tool. And this indicator is similar, but it measures and analyzes up versus down conviction amounts. Okay, up versus down. It's similar to OBV that uses volume, and it's interpreted in the same way by looking for divergences, but it has a few major differences. Primarily, that OBC factors in the magnitude of the price move with the intensity reading. As where OBV is kind of all or nothing. A penny move is treated as the same as a 30% move. It doesn't differentiate the two. Additionally, OBC includes overnight price moves and includes gaps, unlike other first-generation indicators like Chaikin's accumulation distribution, where, believe it or not, a stock can gap down 30%, but if it finishes up a few pennies, these indicators say that's positive volume, right? The stock lost 30%, but because the close finished over the open, they consider that positive. OBC doesn't do that. It adjusts for it, and it backtests very well. So that's kind of to get you up to speed on what conviction is and some of the advantages and how it's trying to compensate for things of the past, for things that we've been taught. Now, kinetic conviction, our third tool, is the primary focus for today's presentation. And this tool has a number of valuable uses. One, it uses conviction, right? Two, for traders, it's very effective at highlighting true important moves, as you're going to see. Three, for investors, it is good and can be used in isolation or in conjunction with RCM for gauging momentum changes for trend evaluations. Four, for system users, it's the foundational factor for the conviction systems, and we're going to look at some of the factors that make up these systems. Five, it's designed for today's market environment, and that's where we're going to start. The reality is that our markets have changed dramatically since the first generation tools that plot and analyze volume were first developed. Our markets are more volatile. We're in a global environment now. There's more price gapping, margin and leverage. We have derivative structures, dark pool activity, and we certainly have high frequency trading. And because of these changes, it's only reasonable to theorize that our tools need to adapt along with our approaches to be effective. We want to keep up with the changing market. RCM and OBC directly address some of these areas, and that leaves us kinetic conviction to address high-frequency trading and dark pool activity, which is not as clear-cut, but we're going to try to define the problem. HFT, high-frequency trading, although I'm not sure anyone knows how much HFT activity there is, we know it's a lot. So based on a consensus of supposedly reliable assessments, we're going to say that it's 50% of the market. And for these examples, we're going to assume that the HFT activity is relatively consistent. The truth is that HFT incorporates many techniques, and this is hard to qualify. So this area is not quantitatively exact. But what we can say with certainty is that in regard to intensity analysis, we're not interested in flash orders or volume numbers of executions that happen for a millisecond with HFT. This is going to distort the readings, or at least the sensitivity of the readings, and I think we can all agree with that. So we're going to look to compensate for this. I know, another Rondeau math example, and these are not real popular. But we need something for conceptual purposes only. This is for conceptual purposes only for understanding. And this, again, has some assumptions, and some of these areas are complex and unknown. But to keep the math simple, let's say that a stock's average volume was 1 million shares before high-frequency trading existed. With that, we would say that the true volume that we'd be interested in for accumulation and distribution analysis, holding milliseconds doesn't count, would obviously be 1 million. Let's say for illustrative purposes that today's volume is 1.25 million shares. That leaves us with a true volume relative amount of a plus 250,000 shares, or plus 25%. That would signal us a moderately important move for the day's price action relative to this security's normal average volume. Straightforward. Now let's look at what happens in our current market environment with our average 50% HFT activity skewing our readings. Now our average displayed volume would be 1.5 million. And keeping things relative for comparison, the true volume is, of course, is 1 million, because the HFT volume is 500,000 shares on our estimated 50% of total exchange volume. Now with the same 250,000 share increase, we're assuming HFT consistency, the true percentage change on our chart only appears to be 16.7%. This happens because of the larger denominator with the HFT volume being added in, and it's a blunting the amount of the change. And this leads us to a 33% reduction between these two values of the true change. This would be reduced amount that would show up in the height of our volume bars. We wouldn't see as much change as may be truly happening on the elements of the intensity that we're interested in, excluding HFT. Now, this brings us to dark pool activity. And for this section, because of the nature, complexity, and confusion surrounding dark pools, which is a full presentation in itself, we're just going to define what a dark pool is. Dark pools are private exchanges for institutional investors that allow them to trade large blocks of a security without adversely impacting or shocking the market price. The exchange shares where the public can't see them. These are controversial, and there's pros and cons to them. For our purpose, the key things to keep in mind are that dark pools do not disclose their intentions, so our order books do not show them. You will not see it over here, but the results are reported, albeit on a delay, after the completion of the entire block trade to the consolidated tape. And this is the area on the right, otherwise known as the time and sales or the print. And this is the information where the charts are derived from. So we don't see it here, but we do see it here. Now, dark pools account for a large number of total shares traded. And if somebody can tell me what that is, I'd love to know it, because estimates vary so widely, I won't even touch that number. But we do know that we want to see this activity, which we can label not only as true, but perhaps even true and significant, as there are beliefs that these trades have a forecasting element to them. So that's the theory and the reasoning for the tool. So what is kinetic conviction? It's an indicator that highlights important activity by increasing relative sensitivity through the means of measuring price, volatility, volume, and conviction dollars. And it does this by calculating and displaying the difference between the current bar's conviction and its exponentially weighted average conviction differential. That's a lot. I know that. We're going to look at it. KC displays the conviction differential, not the level, and it's plotted as a histogram, and you can see it right here. And here we can see a simple math example of this. And I'm sure that Jeff is rolling his eyes right now back in the studio, but I think this is our last math example. And in this table, we can see here we have a traditional intensity format. It would show the reading of the conviction dollars, the volume or the dollars. And we can see how KC shows the difference from its average. This is very straightforward. In this example, a traditional format would display the actual value 10 million, but KC would display a plus 2 million because the average is 8 million. Or it could display a negative amount, say minus 3 million if the day's activity was only 5 million as compared to the average bar. Very straightforward, right? A few other key elements that you should be aware of with kinetic conviction before we look at how to use it. We've killed this point to death. Volume, although standard, cheap, and easy to distribute, is not the best choice because of skews on large price movements. For the same reason as with RCM and OBC, we use conviction dollars of volume to offset those large price swings. I mean, that's pretty straightforward if you want to consider using conviction. Here you can see KC in the middle pane, and again, it's plotted as a histogram over a zero axis. Why? With standard volume bars, it's not always to see if the volume levels are above or below their average. I'll ask you, are these intensity areas right here above or below average? It's not easy to see. Yes, we can put in a moving average as we have here in red, but it's still difficult to tell the degree. We can use relative volume. It's not as effective. And no, it's using volume, right? So kinetic conviction clearly shows us if the relative intensity, even over large price changes, is above or below its average by using a histogram approach. For base evaluations, pretty simple. If KC values are above the zero line, they are displaying that the bar's conviction differential is above its recent conviction differential average. If KC values are below the zero line, then they are displaying that the bar's conviction differential is below its recent conviction differential average. It makes interpretations very easy. But because intensity levels are only relevant when compared to the issues levels, they're not cross, and because volume or conviction levels are more noteworthy when being compared to more recent activity, dollars really help here, KC uses and weights the more recent activity, hence the word kinetic. This may get a little confusing, but the relative base point, the zero line, is a sliding scale that's constantly being adjusted for relevancy determinations. It's moving with each new bar or kinetic moving average constantly being centralized to zero. And this approach greatly clarifies the move's relevancy, it simplifies its readings, and it gives us numerous advantages for relevancy determinations. I agree with the previous two presenters that you want to keep things simple. The interpretation simple, but I'm not so sure that simplifying our indicators and tools and not allocating to the best strategies is always the best approach. So for this and relevancy determinations, kinetic conviction plots two standard deviation bands of the conviction differential, again, not conviction, and it makes interpretations easy. KC price moves with intensity values above 150 are considered more relevant and meaningful. They are above the upper green band. The move is considered of greater importance. KC price moves with intensity values below minus 50 are considered less relevant and meaningful. They are under the lower red band. The associated price moves are less relevant, could be questioned. We don't really want to factor them in as much. Complex calculations, but maybe simple interpretations. As you would expect, we also added the other standard elements to kinetic conviction. We color gradient the bar color to the magnitude of the price move, as opposed to just being red or green. So when you see brighter green, red colors, this highlights large relative upward price moves than darker green colored bars. And brighter red colored bars highlight larger relative downward moves than darker red colored bars. Color reflects the amount of the price change. Height of the bar represents the intensity of the change. And of course, we've also included the ability to have kinetic conviction highlight the important readings right up here on the top of the price chart. These two additions give traders a quick view of the relative importance on a day-to-day basis and assist them with their breakout analysis. Now, in addition to being beneficial for single-day evaluations, KC also can be used for long-term investors and for trend evaluations. Here we can see an example of this with kinetic conviction being combined with the same trend analysis theory that we covered earlier. Yes, prices may be pulling back the downward sloping arrow slightly, but on clearly diminishing conviction, and then it resumes its normal upward path. And you can see how this is easier to spot than with standard volume bars. KC has an expert advisor and commentary report with more statistics than you'd probably ever want, along with written assessments to provide guidances for newbies. Here you can see we're getting a message, insignificant dollar move under one standard deviation. One key measurement that I do want to point out is the KC dollar intensity right here, the blue arrow. This displays the conviction dollar percentage above or below its moving average. A value of 0 would represent that the dollar's bar conviction is equal to its average, not much to look at. A value of 100% would indicate that the bar's dollar conviction was twice its average. Let's take notice. A value of minus 50% would indicate that the bar's dollar conviction was half of its average. That's the correlation. This is probably the single most important value of all the conviction indicator series, as it provides a quick assessment of the day's relative intensity and overall relevancy. Answering the question, well, how much intensity assessed weight should you place on the move? As with all of our trading and investing tools, we've included a lot of adjustable parameters for more advanced investors. We're not going to cover these, but users can have kinetic conviction plot volume differentials as opposed to dollar differentials. I'm not sure why you'd want to, but if you want to stick with volume, you can. You can adjust the moving average length to include more historical bars or to weight the readings to more recent activity, become more sensitive. You can have the bar coloring represent close to bar open, or close to previous close. That's the default. That's a change from many systems. You can control what's being displayed in the commentary reports. It's completely customizable. But for most users, I would say that you're probably just going to want to start with the default settings. And each of these settings is explained in detail in the manuals. Our last setting that I do want to touch on, now that we're all experts on kinetic conviction, is that kinetic conviction has a built-in buffering factor. And this is turned on by default. And with this on, the deviation amounts, the heights of the bar remain the same. But as you can see at points B and point C, the bandwidths change. With buffering, it will narrow them. KC was designed to increase relative sensitivity intensity readings, so you can see it more clearly. But this does have a drawback when we get an extremely large deviation. So we included this to buffer extremely large intensity moves and to prevent them from skewing the bands for upcoming readings. This rarely happens, but we recommend that you keep it turned on for a more accurate and relative representation. All right, we're going to look at the last couple of slides here. How might a trader use this? Well, KC can be used for intensity-based support analysis with other classic trading techniques for directional assessments. KC is very effective for spotting things like blow-offs, selling climaxes, and high-activity dojis or churning. Perhaps its most useful application is looking for a reinforcement and a clarification of breakout moves from reversal patterns and overbought or oversold levels. It acts as a confirmatory indicator. You can see it right here. Low breakout. Something's going on here. It can support your price assessment to see if the rest of the market participants and really the plethora of computer systems moving money in the markets is along with you, right? You can look at it and say, I think this is an important move, and you want to look down and you can see, wow, I'm not the only person that thinks this is an important move. The rest of the market also does. It's confirming of the true relative intensity. The last example we're going to look at here, this is for longer term analysis, and we took this right out of the instruction guide, and I'm just going to kind of read this one to you to give you an idea of what the guides have for content. Say an investor decides to purchase stock in Tesla based on their fundamental appraisal and outlook of the company. Starting their analysis in early December 2020, the investor looks back and sees that prices have not only been trending upward, but that the conviction readings are reaffirming of continuation. This is interpreted with higher above average levels of support conviction at times when the issue was moving upward, the green box, and lower levels of relative conviction at natural pauses and retracements, the red box. Based on the analysis, the investor put Tesla on their watch list, and a few weeks later, in mid-December, KC triggers an alert identifying a significant move with high levels of bullish conviction. This is displayed as a tall, bright green colored bar. A look at the assessment commentary report confirms this, that it's an important bullish dollar move. It's a significant dollar move over 2 standard deviations. Additionally, the commentary report shows that KC bar's dollar differential level, or intensity level, is over 500%. Based on the fundamental assessment of the company, the recent conviction trend analysis, the current price action, and the high intensity move by the KC indicator, the investor decides to purchase Tesla at the next day's open at 222.08 and accumulates a 32% gain over the next few weeks. That would be a kind of a brief example how everything works together. Now that we've covered all 3 indicators, this is kind of the money slide, and I'm going to do this quick. On the bottom at point A, we have RCM for classic trend intensity momentum analysis, and I should say this is already set up for you in MetaStock. It's called the AI Conviction Trilogy. At point B, we have kinetic conviction, which you just covered for breakouts, blow-offs, and selling climaxes. And at point C, we have OBC that measures up and down conviction. The expert advisor and plotted signals should probably be set to RCM. Unless you're a very short-term trader, you may want to alter it to kinetic conviction. But we have complete analysis in one window, and in the end, pretty easy to interpret if you know what to look for. Jeff, just so you know, I have 12 minutes left, so I'll be well within my hour from when I started. The conviction systems we're going to look at next, and then we're going to get to the big finish, right? In this section, we're going to look at 2 other systems and how they're constructed and project with systems for different types of traders. You know, there's many different systems, and you want to match the system to the trader or investor. And we're going to do this with the understanding that all of this material is for educational purposes only and for understanding factor relevance, selection, and system design. There's no guarantee that these results will be replicated in the future, even though they have fairly consistently each year over the last decade. There's still no guarantee of that. I want to make that very clear. All of these systems generate candidates in MetaStock's Explorer, and they display on the charts the exact signals. One thing to keep in mind is to get elevated performance, these systems have multiple exit algorithms, meaning that one of many different things can happen to get you out of a trade, either good or bad. Each new bar is factored in. And because of this, these systems do not project stop exits immediately at the time of entry. Although they do have profit target extremes and fail-safe stops built in based on the ATRs of each security. The reason for this is to get improved performance. Let me ask you, is there really one set of things and only one set of things that can happen in a chart where you would want to get out of a position? No, or at least I hope not, right? So we try to program multiple reasons to get out of a position, both good and bad. Another thing to keep in mind is that the signal algorithms for entries and exits are different. And I know that it's common with most indicators and systems to use the same formula, but common is not necessarily better. Again, let me ask you, do markets rise and fall differently? Slower and faster? Yes. So why would we use the same factor criteria and the same parameters and sensitivity for both entries and exit signals? It's easy, it's simple, but does it really give you the best performance? My research says no. So here are the results for the LT scan, and LT stands for long-term. Highlights here are a good number of candidates, 1766, strong 2.66 profit factor. And just so you know, profit factor is total wins divided by total losses. LT generated an average trade return of $215 on a $5,000 investment. Gives you 4.35% with a modest holding return of under 11 weeks. So 4.35 under 11 weeks per position average. That results in over a 20% non-compounded annual. It had an incredible maximum consecutive win number of 48 in a row, but on a negative, it had a maximum consecutive loss number of 13. And this is a ramification of doing a strategy, a long-only strategy, and holding it through COVID. Here's the equity curve. And it did have a minor drawdown during the COVID crash right here. It's not huge, but it's there. But it held up very well over the last bear market. I would say this is appropriate for investors and traders with a long-term time horizon who are focused on total return, including dividends, and who are looking for a system to identify potential positions or assist them with the timing on a group of securities that they're currently interested in. And I might add that this would be a better system for option players due to its longer holding period. Here are the results for the ST scan, which stands for short term. Highlights are the highest number of candidates, 1873, and it really has the most balanced approach. The STM system generated an average trade return of 2.24% with a modest holding period of 31 days. And that's not market days, that's calendar days. Negative, it had the lowest profit factor, although still respectable at 2.5 to 1. And it did have 9 consecutive losses at one point in the 10-year period. But max consecutive wins was at 35 to help offset that pain. Here's the equity curve of this. And this has a beautiful, consistent equity curve with no signs of the COVID crash. Can't even see it right here. And a very fast acceleration after it. And also it created profits, albeit slowly, during our latest bull markets. It still churned out profits. I would say this is appropriate for investors and traders with an intermediate term time horizon, looking for a system to identify a list of potential positions. For optimal performance, investors can apply additional analysis methods to refine the larger number of candidates to things look better than they are. Here are the results for the PT scan. That stands for profit target. We've already covered these results at the beginning. Extremely impressive results, but it only generates 3.5 trades per month on the S&P 500. Here's the PT's realized equity curve. It's just so selective. Because of that, it had no losing years during the 10-year period. And again, never lost more than 2 consecutive trades. But I would not expect that to continue. It did, but I mean, I wouldn't bank on that. I would say that this system is probably best for investors and traders with a shorter term time horizon who prioritize risk and consistency of returns and who are willing to scan a larger universe of stocks for potential positions. I have 6 minutes left. Our final segment. This is the segment you want. We have now covered kinetic conviction and we've covered conviction. And we've shown you the canned baseline hit rates for the systems from which they're derived. But we're still short of our 85% hit rate in our 3.5 profit factor goal. And I would propose part of the reason for this is that we take a very conservative approach here to the studies and performance reports. And I'm going to let you decide if this is true and if the performance is actually better. In this section, we're going to look at 7 methods to improve the performance of these systems and really your systems also. A couple people who have purchased the program thought because they saw a lot of signals occurring with gaps that was the secret sauce. I'm saying that as a joke. There's no secret sauce. Okay. This slide addresses this. If you were to simply use gaps alone with the exact same study parameters of our profit target system, your back-tested results shown at the top would not have been satisfactory. You would have only hit 57% of your trades. The difference between a 58% hit ratio and a 1.92 factor to an 82% hit ratio and a 3.73 is a chasm. And I know this goes against our two previous presenters, but I'm just going to say try not to oversimplify your approach. There's a reason that professional traders don't trade straight gaps. They don't use. I mean, using one or two things as a factor is nice. It's attractive. It may sell, but is it really the most effective? And if it is, then generate the reports and show that it is, right? That's the key, not showing a few trades. Our first method to improve results, and I'm going to show you that this is true, is you don't have to do anything at all. The conviction studies don't include dividends, which would greatly increase your returns. Studies show that 40% of the total return of the S&P 500 are dividends. That was our studies group. Performance was only measured on price appreciation. Also keep this in mind. When you add back in the dividend amounts, not only would this increase returns, but many of the conviction systems reported small losses, as you can see here in the last column sorted would turn into gains, increasing your hit rate. Now, we don't want to lose 15% of the time, but as you can see, many of those are very small percentage amounts when we do. An advantage of having multiple exit strategies. Number two, there's no market timing mechanism, which is absurd, right? These systems take or show entries even in obviously bad times. Don't do this. Don't fight the tide. In fact, we have a market timing mechanism coming out with MetaStock in the fall that can be overlaid with any system. Here in the Great Recession, you can see where you get in and where you get out and where you got back in. And this is all automated. There's no subjective analysis needed. Our third way, other technical elements, of course. Scans are built from systems that are designed for research purposes to identify factors. From an execution standpoint, the scan's purpose is to identify securities that meet the system's criteria and to reduce a large number of securities down to a manageable size for further evaluation. Even someone with modest trading or technical analysis skills is going to be able to filter out the bad setups, improving performance results significantly using some of the great strategies of the two previous presenters. I mean, you have to use the signals are concrete, but it doesn't hurt to override some of these. Fourth, these systems do not incorporate fundamentals. And anyone who gets the conviction package will also get a complimentary one-year membership to AAII, and that includes some excellent fundamental scan tools, as you can see here. These scans are based on the philosophies of some of the world's all-time greatest investors. And my favorite scan right here is called the My Screen scan, and this shows you the individual stocks that appear in the largest number of fundamental scan systems. For some investors, the integration of fundamental stock selections at some level may be an area that could improve your returns and your performance. Number 5 out of 7, compounded returns on the profit factor system and do well over 40%. Well over 40% if you want to compound the results on the profit factor system. But for professionals that want to be more aggressive, integrating options is a consideration, as these systems target very quick, high probability executions. Obviously, the effectiveness of this method is dependent on the skill of the investor, but I would not rule out using or overlaying options if you're experienced and comfortable using them, especially with the LT system. Number 6, money management. We did not even compound returns here for the system. We didn't invest the returns. If you question how much the effect of compound interest is, just go online and try a calculator. This would have really increased returns. Additionally, with money management, by incorporating money management techniques like moving stop losses to assure profitability or scaling out of your positions, you can let some profits run, likely increasing overall returns. Here you can see 2 conviction trades where profits could have been extended by using the conviction tools and basic trend analysis. Leading us to number 7, which is similar, system adjustments, and this is specific to conviction. The ST and the LT systems entries are almost always identical. 99.9% of the time, they're going to be the same. So one way to attempt to get the best of both systems is to scale profits. For examples on entries with either system, because they're the same, you can consider taking a portion of your profits on the ST exit signal, which will always be first, and then your final profits on the LT exit. For more advanced investors, you could take a third on the ST, the same amount on the LT, and then let the rest ride if you're confident in your abilities with chart reading and trend analysis to get out on a downward trend. The key here is to move physical stops up on the final remaining shares after the ST and LT signals based on the technical landscape of the charts to assure overall position profitability minus gapping, which we can't control. Personally, I like to take 50% off the ST signal and then 25% off LT and let the other 25% ride to major resistance or a confirmed downtrend turn. I like to get in the money quickly, move my stops up, and then keep green screens for the future. That's it for conviction. In our next webinar, we're going to look at Prove, which we talked about earlier. I'm not going to market products. I'm a developer. I'm a trader. That's what I am. I'll leave that to the experts. My sincerest hope is that you learned something in this presentation that you can use to improve your trading and or investment return. For more information on AAI membership, the tools, the classes, or anything else, you can contact AAI. I thank you for your time, along with Jeff, Kelly, the MetaStock programmers, and the entire MetaStock staff for this opportunity. It's an absolute joy and pleasure to work with, and I've been in this business a long time. And before I forget, I have to get to the slide because I missed it the last 2 times, to see where my next events are, my next articles, or to place an appearance request, or even a one-on-one inquiry. And we do one-on-one work. If you're a conviction user, you can go to the AI website listed on the screen, and you'd be working with me. We have 3 web pages dedicated to this function, and that includes a library of my past articles and webinars. If you want to learn more about my methods, and you can also contact me directly for technical information or anything directly related to conviction or the tools, and my contact information is listed here. That's it. Jeff, it's all yours.
I can't let you go until I ask a couple questions that I'd promised I'd ask.
Sure.
Okay. So
I don't want to bite into your time here. That's all.
Yeah. No, I appreciate that. Art wanted to know what you mean by profit factor. So could you define profit factor real quick?
I can define profit factor. So profit factor is the total profits divided by the total loss. So let's say you traded a system and your total profits were 10,000 and the total losses were 5,000. You would divide it out, you'd have a profit factor of 2 to 1. So the higher the profit factor, the better. That number can be, just so you know, I've been doing this a long time. I just want to point this out quickly. That number can be very misleading because some people will create systems that have just one little minor loss. And then because it's the denominator, it makes it look like the profit factor is 50. You know what I'm saying? Because, we only had one loss of $2. Well, yeah, we had one gain of 100. Well, you get a 50 profit factor. So that's why you got to look into that a little deeper. That's a trick that a lot of people use.
Okay. Big friend of MetaStock, William Annabelle, wants to know, do you compare your results against buy and hold?
I can and I should. The problem with that there's a problem with that. I'm going to try to explain this quickly. Buy and hold, I think we would agree, is concrete. I have $10,000. I'm allocating it. You're buying and holding 10,000 through it, right? With a system, you maybe only have a couple $100 in the market at a time, or $2,000 at market at a time. So it's almost impossible to compare them. Do you understand what I'm saying? Because you don't know how much of your money you're going to have in. The only way we can really project it is to say, how much is the average trade making on a percentage basis? and how long does it take me to make that percentage amount in the dollar amount, and then you would extrapolate it out. That's a problem with doing these type of studies. You can't compare it one-to-one because you're not fully vested in the system. And you always need to have money left over.
All right. And then I think the last one we have time for is also from William. He wants to know, can we get, is there a public version of the spreadsheets available? And I know we're working on that. I don't know if they're available yet, but they are coming. So maybe you could kind of talk a little bit about that.
Yeah, the answer to that is there may be like a one-page summary of the key elements, but we probably wouldn't be releasing. I mean, some of these are probably over 100 pages because they list every trade. Mm-hmm. So we probably wouldn't be releasing those to that amount of detail, until somebody's a conviction user.
Okay. Let's see. I think that's all we have time for, Ray. Great job. Thank you for coming in. I appreciate it. And I do want to talk a little bit about how easy this is to use and how the scans work, but really appreciate all the work you've put into this. I appreciate your time in coming in here today. And thank you for coming.
Okay, Jeff, and just to reiterate, I agree with you that these are complex models, but in the end, guys, you're clicking a buy and a sell button. The execution in the end is easy, but they are somewhat complex. Thank you, Jeff.
You bet. Thank you, Ray. And that's actually one of the areas that I wanted to hit on. I'm going to go ahead and kind of make me the presenter real quick. And I know we're running a little bit behind. That's not uncommon. It's not unusual. It's not something that we're unaware of. But one of the things that I like is kind of the amount of, work that goes into kind of getting these ready and the results and just how transparent everything is at the end of things. And but in general, let's kind of jump in. I've got a scan that I've run, and you should be able to share my screen. I'm sure Greg will pound on the desk if you can't. But let me kind of just go in here and just kind of go through everything. So first of all, we're very, very happy to be associated with the AAII. I've known Ray for a number of years, and the fact that he made these for MetaStock and has worked so closely with us, I take as a real compliment. I certainly appreciate that. But in addition to that, I like the way he explains and accounts for in this research that he does, volume, volatility, up-down variations, price and conviction divergences. There are really, really unique indicators that take into account a lot of the fact that we're in a new market. Certainly, it's a much more volatile market than it was even just before Corona, right? And so this kind of takes advantage of that and takes it anyway, there's three indicators in here. There's optimized balance conviction, kinetic conviction, and relative conviction momentum. And those are very unique indicators that Ray talked a little bit about the design of them. But I like them all. With optimized balance conviction, you can use it to measure if a trend is likely to continue or if it's likely to diverge and reverse. And very, very good job of doing that with it. You get kinetic conviction along with that. And in addition, you get the relative conviction momentum. So in addition to the indicators, he's really good at trading systems and creating fine-tuned systems. One of the things that they take very, very seriously at AAII is not only having profitable systems, but also having highly reliable systems that work out over years. And the system testing that Ray does spans a decade, on all the S&P 500 stocks. So the methods that he's included with this as part of the package is the LT, the ST, and the PT system. And the LT is going to have an average trade length of 82 days. You're going to have in that 10-year test period, he did about 1,725 trades over the whole S&P and had that profit factor, that win-loss ratio of 2.7%. His hit rate, his number of profitable, unprofitable, was 75%. So very, very good returns on that. His ST has an average, is more of a shorter term system. It's 35 bars. And here's kind of the same statistics for that. 1,700 trades, 75% hit rate, and a 2.48 profit ratio. And then, of course, you get the PT, which is, I think it's the preferred. It's more for scanning. It takes advantage of the MetaStock scanner because you can run a scan for the PC and you don't get a lot of hits. In fact, you'll be able to see that on the next slide. But you had 27 bars for your average trade length, so it holds for about 27 days. But in the 10 years of testing that Ray did over the S&P 500 stocks, he only had 375 trades. So we were starting to get really, really selective. The hit rate was 80%. So 8 out of 10 trades were profitable. And the profit factor went all the way up to 3.3. So for every dollar on average that you lost, you got 3.33 back. So very, very, very good systems. And they do come with complete scanning. So I did run a scan earlier and it came up with this chub. But when you come in here and you run a scan, it's going to show you all the recent signals. And the reason that we show all of the recent signals is it'll show up to 4 to 6 to 7 days ago. But the reason we show the recent signals is that you won't get necessarily results every day. And I figure that's a good thing. For me, I'd much rather step over. I have a limited funds, you know what I mean? I'd much rather step over less profitable trades and save my money for those more profitable trades. And I think that's one of the things Ray's system really, really excels at, is kind of just weeding out and allowing focus and allowing you to focus on. And when when you get signals from Ray, it's very, very detailed. You can get in here and with the expert commentary, it's going to spell everything out. But the bottom line is also you're going to get a very, very clear visual indication of when to buy. You're going to get a very, very visual indication of when to sell. You're going to understand what your profit target is. Those things are all built into it. So as you're learning, you can go back and you can look at signals historically. You can kind of see where they came in, see where they went out. Very, very well balanced system. Ray did a really good job with it. So we appreciate that. So in total, with the Conviction Plus, there's 7 indicators, 4 explorations, 6 expert advisors, and 7 different templates. So it includes I can hear a microphone. Just so you know, somebody's live. Be quiet. There's a complete system that's available. We also include detailed training courses. You're going to get 1 year of AAII membership as part of it. And you're going to get access to all of the learning research portals that are available as part of this. So there you go. Brand new product. First one we've created with the AAII and by the Active Investors, Ray Rondeau. So the Active Investor Division. Anyway, normally this would be $14.97. It's a one-time cost. We're doing a launch special. We just launched it not too long ago. It's $9.97. We do back it with a 30-day money-back guarantee, so you can try it, you can play with it, you can see what's going on. You can give us a call, 800-882-3040. You can visit us online at metastock.com/conviction or metastock.com/saleschat. So there you go. And it is part of our big bundle that we're doing today as well. Well, you can get Steve Bigalow's CPS 3. You can get the Momentum Strategy number 4. You can get the AAII Conviction Plus. Our Adrian Manz is around the horn. Oscar Carboni is coming right up, but we did some trainings on trendline and position management that was awesome, and it's included in this package, as well as Unleash the Power of MetaStock, 3 months of subscription to learnmetastock.com. All of it's available for $2,344. So to take advantage of that, give us a call, 800-882-3040. Chat online with us at metastock.com/saleschat or visit us online at metastock.com/summitdeal. And as I start saying that, Greg, behind me today, will be actually typing those into the chats for us. So there you go. All right, there we go. Do want to say thank you to AAII for supporting, sponsoring us today, as well as Stocks and Commodities. We're MetaStock. I'm going to talk right about after Oscar. There is a big demand in the room for Oscar right now. So I'm sorry we're starting him just a little bit late, but let's go ahead and bring him on. Oscar is a force of nature. He is he's entertaining, he's passionate, he likes to talk about kind of positions. When he listens, I take notes. Great presenter. Let's go ahead and get him started. Oscar, how are you doing?
I'm doing very well. Jeff, how are you? And is my camera on?
Let's see. Not it's coming.
Oh, yeah, we've got camera.
I'm sorry we're starting you late. I'm going to get right out of the way. It's your turn.
No worries. Jeff, thank you. Hey, I've got nothing to sell this crowd, but if I did, you'd be my salesman, Jeff. Thank you for everything. Traders, let me just fix this screen so I can see you. All right, that works for me. So let me start with this. Good morning, good afternoon, and good evening, traders from across the globe. Thank you for tuning in. MetaStock, thank you for having me. Fantastic presenters before me, and I hope there'll be some great presenters after me. So I've got a series of charts that I'd like to show you. I'm not going to try to sell you a system here. What I'm going to do is sell you on the fact that when I called the bottom in the beginning of this year in a MetaStock webinar, then continued to call the bottom. And in fact, if you'd like, you can check out these videos. I put out a YouTube video just about every night. On Jan 5th of 2022, I put out a video. Jan 5th of 2022 is this date right here, right in that circle right here. And in that video, I basically said the top is in. There are reasons why. Okay, that's great. Well, since then, I've been calling top is in, market's going to crash, market's going to crash. The beginning of this year, I put in the lows are in, the bottom is in, did a bunch of videos, a series of videos. Of course, you can always go back and see them. I'll show you the dates, even though it doesn't really matter unless you want to look them up. But there are videos that will show you just about everything I'm calling. So this is how stock market bottoms are born, 2/7/23. And then I did a webinar about a week later, basically called The Market Has Bottomed, More Proof, 2/15/23. So the market has bottomed. I'm going to show you that. I'm going to show you that you should be positioning for more upside, how it bottomed, why it bottomed, and where it should go next in a series of very simple charts that you should be able to understand. Before we get started, please know that this is a very risky game. You cannot trade anything out there from crypto to options to anything in between without serious risk. So put your stops in and put them in before you ever put on a position. Quickly about me, if you don't know who I am, I started in this business. I am Oscar Carboni. Started on the trading floor in 1982. Spent my entire adult life there until they closed down the exchanges in around 2006-07. We went electronic. During my stay, I started on the exchange floors in Manhattan, and I was holding charts, point and figure charts with pencil on graph paper, literally. I helped the exchanges get charting off of graph paper onto computers. As time passed, I revolutionized that. I helped the exchanges get trading off of yelling and screaming and open outcry, which is what I did for most of my life, onto the internet. But while I helped them do that, it also ended my career, right? They gave me a laptop one day with everyone else and said, well, it's over now. You helped us get electronic. Good job. Now go home. All that did for me was allow me to do this from another location, no longer having to go to the trade centers. During my life, I have become probably the best chart analyst on this planet. I am not just tooting my horn here. You follow anything I've done. Every one of my year-end projections turn out to be correct. This year-end projection was for over 5,000 S&P. But when I put out the projection, we were trading at 3,800. All right, Oscar, you're crazy. Of course I'm crazy, but I follow charts. I don't think about this at all. Chart said we're going there. Well, guess where we are now? We went from 38 to 44 on our way to 5,000. We will get there. Let me start to explain. There's a lot of things that we can talk about, but I'd rather just show this to you in charts. One of the things I will say is this. If you like this presentation that you're about to see, I sit live in a trading room on camera and microphone, like 20 hours a day. You can just join my free site. Come to this live trading room where you'll find me on camera. I usually have two cameras, not just the one I'm pointing at, but one right in front of me, like the one you're looking at now. And if I am going to trade, I tell you about those trades, and you can get in and out with me. Last month, following my Omni system, we made about $9,900 per person, one lot trades only. I can't guarantee we're going to win like that every month. The month before we made 5,200. So I do send trading signals. When I'm going to trade, I let you know. You can find those at livewithoscar.com. It's a very simple site. It doesn't even require a credit card. Put in a name, username, password. Check your spam for email. You'll receive an email from me. Join the site. Literally, you will click join Oscar's chat room, and boom, you'll be in that chat room with me. That's what I will offer to you if you like what you see in this presentation. Come join me in my trading room where I can help you out further. It's free, by the way. All right, so what are we looking at? E-mini S&P, I'm telling you right now, kids, welcome to the AI revolution. It is exactly what I've seen. Now, remember, I've been doing this since I'm 18, paying attention on Wall Street to everything. When the computer age hit, we had this massive run. When we got a little past that into cell phones, we had this massive run. The internet came out, we had this massive run. This is the AI run, and I will show that to you. This is happening, kids. What you are looking at is the E-mini S&P daily bar. Now, when last year started, 2022, we were making a series of highs and lows, right? So you have a high here, and you have a low. And then up here, you put in a lower high. It's lower than this high. And a lower low. You rally back up. You put in a lower high. You drop to a lower low. That is absolutely confirmed bear market. Lower highs and lower lows confirm a bear market. Simple, right? Simple. Well, we reached the point where we put in a low, which was September last year, 2022. And we put a high in, but this high was a little lower than that high. However, this low runs to a high. The next low that comes in is a higher low than the low before. Complexion has changed. Absolutely right there. Within 2 weeks of that, I put out the bottom is in videos. Series of videos, and I've been showing you the bottom is in since. Now look what happens. We put in a low, we put in a high. We put in a low, we put in a higher high. Interesting. We come down and put in a higher low. Look, this low is here, that low is higher. And now up into a bull flag, up into a higher high, and in a bullish channel. So I do not care how many bears are out there. And boy, up until about 10 days ago, everyone was bearish. In fact, the last 2 webinars I did, I was the only person bullish in the entire series. Ask anyone who watched the last 2 webinars. Here I am trying to call the bottom in the middle of an avalanche. I use technical analysis. I do not think I'm smarter than the market. The analysis said, look what's happening, Oscar. You see you're in this big red channel moving down and below this 200 ball moving average right here. All right, so this is simple stuff. You're below the 200 ball moving average. You're building a series of lower highs, lower lows, lower highs, lower lows. Bear market. Well, now look at the channels. Now we can get rid of, you are above this red channel, right? So we can make that pretty thin, almost out of the way. And we're putting in higher highs, higher lows, higher highs, higher lows, bull flag. It catches above the 200 ball moving average right about here. And away we start to go. Welcome to the AI revolution. Now, this is the E-mini S&P. You see this green line right here, which I'm going to darken in for you? This green line represents all-time highs, the highest we've ever been. Look at how close we are to that. And I've got people telling me we're in a bear market still. What do you think of that? Let me continue to show you more proof. There is no shot we're still in a bear market. Next, the NASDAQ. Let's go back and look at this. And now, by the way, many of these charts are going to have tips, tricks, and techniques that you should write down. Get yourself a piece of paper and a pen or a pencil, or type it up. You're going to want to write some of this down. I'll show you. The NASDAQ was working, last webinar we did, the NASDAQ was working on 150 ball moving average, and it was working perfectly. Every time you got to the 150, something dramatic happened. So it was working perfectly, and you had a channel moving lower, NASDAQ getting destroyed, everybody's bearish, and right about here, we start to notice the market is changing complexion when we started to do videos about the complexion change, and we start to move higher. Well, the tip that I'm going to show you on NASDAQ NASDAQ is in strong bullish channels right now, opposed to the downside, which we used to have below the 150. We're now above the 150 moving average, and we're holding. That's different, right? So sell here. When you get up to the 150 ball moving average, you can sell. When you get up to the 150 ball moving average, you can sell. Well, it becomes different here. Things change. Complexion is changing. And we start to move higher. You hold on to the 150 and start creating these channels moving higher. You had the big green channel, which has morphed into this black channel, but look what's happening now. Now you're really starting to get into some upward trajectory channels here. Look at this purple thing here. All right, so now you're in this upward trajectory, and in fact, it's building another one. Look at this. You've got another channel building right here. At least you've got a good support line building. This is showing us it just wants to continue higher, even if it pulls back. Nothing goes straight up, as you can see. Up, pull back, up, pull back, up, pull back, up, pull back. Nothing will go straight up. But we are geared for the upside here, kids. Now, here's the tip on this chart. We have switched from the 150 ball moving average to the 18 ball moving average. Let me show it to you and I'll blow it up. This is what I want you to use to time the NASDAQ for the next week or two until it changes. The 18 ball moving average has become Wall Street's darling. Look at it. They decided to just attach to it, and they're buying it at every instance they get. If it gets under, they'll sell. When it gets back above, they'll buy it again. So we have morphed from the 150 to the 18 ball moving average on your NASDAQ, and that is the tip on this chart I'd like to offer to you. So in our last webinar, it was the 150 that did us really well in the NASDAQ. No longer. Now we are looking at the 18 ball, much closer, but use that to time your NASDAQ. All right, let's go find another chart. The Dow Jones Transportation Average. Look at this bad boy. There's so much on here. There's just so much on these charts. All right, so in our last presentation, we had a few things that we discussed. Let me pull this back down here. I'm probably going to need this at some point. Let's leave this out. So the golden cross happened. Well, let's go back. We talked about while we were in this downward leg, things are going to happen to get us out of trouble. The golden cross has to happen, which is the 50 and the 200 crossing one another. And that did happen right about here. We needed to get above this red resistance line. We did about here. It turned into a bull flag. Bottom was in. We called bottom. And let's see where we're going to go next. After the bull flag rallied, market rallied up, came back down. But basically now it's just testing this green support. But here's the important thing about what's going on. Top day right now. You can basically get long every time you get to the bottom of this channel in the transportation average. Not only that, we're using simple support resistance here, kids. Simple. Check this out. You're also now getting above major trend lines. And I tell you right now, whether you know this or not, every algorithm on Wall Street's got this stuff programmed in. An algorithm is nothing more than the information that happened on this chart that gets put into the algorithm. The difference is the information people are programming into that algorithm. It's only as good as the trader doing the programming. You know what I'm saying? Not everybody's really good at trading. I want you to know that right now. Don't always believe in algorithms. They're written by humans. All right, so anyway, look at this resistance line right here. And we are now above the resistance line. You see that? This is the important thing, though. You are going to just keep working this channel until you fall out of it. It is a perfect channel. And while you're in this channel, you can just refer to it and buy the dips in your transportation average. Even though we don't trade the transportation average, but you can trade stocks that are in it. Look at how well it's working. And this is one of the leaders of U.S. indices. So forget about this downward move, kids. Forget about another leg. Forget about all of that. You may get dips. The bottom is in, and I've got plenty of charts to prove this to you. You'll see. Let's move to the Russell 2000. Let's take a look at this bad boy, what it's done and where it's going. If you remember these very charts, by the way, I'm using the exact same charts I used in my last webinar. You go back and look at the last MetaStock webinar. You will find every single one of these charts I've just allowed the future to continue on, and we're looking to see if we were right or wrong when we made assessments on these charts in our last webinar. So Russell 2000 daily bar started off the massive drop in 2023 with a head and shoulders, right? Classic head and shoulders, drops into a bear flag, classic stuff, drops down, hits this triple bottom, and starts moving into this blue channel, moving higher. The interesting thing is that it starts to get above the 200 ball moving average, which has kept it in check for the whole down move. So we're above the 200 ball moving average. We're above the red resistance line. New channels are pointing higher. Here's your tip on this chart. If you hold right here at the 200 ball moving average, you can buy it again. Wait for it to test the 200 ball moving average right here. You buy Russell again if it gets there. The worst that's going to happen is you're going to get down to this channel, bounce off of it, and head right back up again. So we are in an upward trajectory. Nothing goes straight up, but that is what's going on here. The bottom is in, kids. By the time we're done with this video, you will be convinced. The bottom is in. We are heading higher. Nothing goes straight up. Remember that, but we are heading higher. Lots of charts to show you. What else was in our last webinar? A crude chart. The tip in that webinar is the exact same tip I'm going to give you today. It's working perfectly. Check this out. Simple, effective. The 100 ball moving average. Now, the algorithms are written on different markets. Believe me, they incorporate these averages. Look at how you can just see this. You don't need an algorithm to see what's going on here. Crude, first of all, crude below 77 will help to buoy the stock market. The stock market's been going up since about February. Yeah, really, Jan and Feb, it started to go up. You know when crude got below 77? In the same month that the S&P started to go up. These things really work. But that's not the tip on this chart. The tip on this chart is this. Look at this insane 100 ball moving average and how well it works. Look here. Let me darken that in for us so it'll give me a little bit better tool to work with. Check this out. Look what happens every single time you get up to this average. Right? Hit it, done. Hit it, done. Hit it, done. Hit it, down. Spends a little time above the average and breaks back down. Up to the average, breaks back down. Well, look where we are right now, top day at the average. Use that for your trigger, kids. On crude oil, 100 bar simple moving average is your trigger. It will change. These averages do not last. You cannot count on this next week, maybe. However, looking at this, you've been able to count on it for about a year. Eventually, the 100 will stop working. It is working now. Use that to time crude. Remember, I'm just here to show you some tips, tricks, and techniques that I know absolutely work. I am a Wall Street pro. I'm very good at this. I promise you these will work for you. Just use them going forward. So that's crude oil. Let's go to another one. Oh, I love this one. Look at Bitcoin. We're going to 85,000. 2 years, 11 months, kids. You heard it from Uncle Oscar. Anyway, left shoulder, head, right shoulder. We know we started this mess with the head and shoulders. Big drop down. Right about here, I start doing webinars to say it's becoming promising now. It's getting better. Look at Bitcoin getting better. Well, you know what? It is getting better. And there's a little gift on this chart, too. Wait until you see what they're using on this crazy thing. Little gift on here is the 11 bar moving average. That has become Wall Street's darling. Under it, you're short. Above it, you're long. That is your Bitcoin. Write that one down. I've done the research, kids. These are working right now. You don't have to do the research again. Take my word for this. So, but there's more. I have a better Bitcoin chart. I have one a little more blown up than that. Check this out. This is that very same chart with the truth in it. Look at what's going on here. So you know if I put the 18 bar average on here, you'll see it's right there. The 50 was in vogue. That's the big one. Now it's the 18. On this Bitcoin chart, what you're seeing is, of course, you had the downward channel, gets above the 50, and puts in a bull flag. Bull flags are like every other formation that we look at. They do work. Nothing works 100% of the time. That, of course, you can gyrate up and down inside that flag, but it is a bull flag, and in the end, Bitcoin should work its way higher. So again, if we just switch this to an 18 bar average, you'll see how well that's working right now. It was the 50 and it has gone 18 on us. I'll even make it orange so it looks just like the one I showed you. So we are looking at, I'm sorry, I didn't change it. All right, very good. So we're looking here at coming down to maybe that average. I don't think you're going to get through the flag. I love the way Bitcoin is starting to work its way higher. Simple charts, simple proof that these things are coming our way. Now, a lot of what's going on is, of course, the Fed stopped raising rates. The market goes right back to where it was before they started raising rates. But now we're looking at a bond chart, kids. This one's a little bit scary. Looking at the 30-year bond chart right here, one thing you need to know is that when bond futures go down, interest rates go up. See this little teeter-totter, little seesaw? Let's say you're out in the park. Well, the big heavy kid is the bonds right now. It makes interest rates go up. Rates rise when T-bond futures drop. So T-bond futures were dropping the whole time the Fed was raising rates. And it stopped cold at the 150 ball moving average, except for one brief period. That 150 comes back into play. But when I showed you this chart last, I put this very chart in front of your eyes, and I said this is a must-hold situation. If you break this trend line, rates are going to go up again. Well, kids, we broke the trend line, and I think they're going to end up raising rates again, because when bonds go down, by the way, rates are going up. Whether the Fed says a single word out of their mouth does not matter. Traders can raise rates by pushing down 30-year T-bonds, 10-year notes. Inherently, it pushes up the actual rate, even though the Fed hasn't said a word. Traders themselves make rate changes, even if the Fed doesn't get involved, just by moving bonds around. So bonds broke through the must-hold area. That's not good for interest rates. It means the Fed may have to raise rates again, which will give us another pullback in the stock market. And it'll pull back to all of those trend lines I just showed you and then head back up again. That's what those trend lines are for. They're there to let you know when you get to them, you can react. So what you're seeing right now is the bonds broke again, that 150 ball moving average. It got really exciting right about here, because for the first time in 2 years you got above the 150 right here. All right, so finally bonds are getting above the 150 ball moving average. This is a wonderful thing. But look, back below, and it did not hold my must-hold support area. Bonds will continue to drop, driving interest rates up, which does put some weight on the stock market. So nothing goes straight up. Stock market is in a bull market. If they raise rates, it'll jigger-jag it a little, but it will continue higher. Tip on this chart, use the 150 ball moving average to decide your T-bond direction, which is clearly the short side right now. If it does not hold the must-hold area, rates will go higher. It did break the must-hold area, and you can see what's starting to happen. So we're just going over the same charts we went over in our last webinar. I hope these are clear and simple for you. What's next? No, not yet. We'll come back to you. You can't be there yet. Let's see what else we have. We have the euro. There's a tip on this euro. Europeans, if you're watching, we've migrated away from, in your euro currency, I'm just going to show you the quick tip on here. We were using the 70 ball moving average, the black average. It was working like magic, just like magic. Well, it has morphed, and we are now using the 100. I'm going to cut the 70 out of the way. Well, that took away too many things. Let's put that back. I will just make it lighter so that it disappears for us. And this way nothing gets cut when I cut it out of the way. We are now going to go with the 100. The 70 is no longer in vogue. If you are a euro trader, start using the 100 ball moving average as your key. Look at how well and how smoothly it works. All right, so right about here, we shifted from the 70. Right about here, the 100 bar simple moving average enters the arena, if you will, and starts to become what Wall Street is keying off of. And if you ask me, that's a bull flag right there, and it should take your euro higher. At least looks like a bull flag to me. So use the 100 ball moving average, simple moving average to time your euro. I think you will find that an appetizing average at this point in time to help you gauge which way euro should go. Again, this being a bull flag tells us it wants to go higher, should go higher. What I mean by the bull flag is if we just drew it in, you know, you got a flag, like you can go like this and call that a flag and make it simple. We'll create a parallel trend line of that, drop it down. So now we know we have a parallel flag in here somewhere, right? So you've got some flag looking thing here. You can drop a little pole right here if you want to call that a flag pole, whatever. It looks flaggy sort of to me. It looks bullish. The key is that it's holding the average. It held that average smartly and started to break out towards the upside. So again, that's euro. I hope this will help. Give you another tip or trick that you could use moving forward in the next week or two. I've got a few more out there for you I'd like to share. More windows, please. So who can we work with next? How about the dollar index? Okay, another tip on here I noticed. By the way, I don't build these webinars until the night before. I literally built this webinar until about 1:30 a.m. last night. I put these charts together. I like to use the most fresh data that we can come up with. This way I know what I'm going to do next week, and hopefully you know what you're going to do next week. So US dollar interest, which average or algorithm are they into now? Algo, average, doesn't make a difference. It's what they add into their algorithms. It's so easy to spot. Anyway, the dollar index was using a 70-bar moving average, and it worked like magic. It's this green average, works like magic, stays inside the channel, behaves like it should. Everything's fantastic. Well, right about here, we dropped below the 70-bar moving average. We got out of the channel. New channel starts forming. New average comes into play. Wall Street's latest algorithm, 109. Check this out. Simple, easy to use, effective. It's the 109 SMA on your dollar. Let me blow it up for you a little bit. And that is your timing mechanism right now. This one we are no longer going to use unless it comes back in play. We'll just turn it white for now so it's there, but missing. You will be keying off of the 109 if you are a dollar trader. I've already showed you the opposite side of that. In euro, use either of the two. So it dropped below the 70-bar moving average. Channels are pointing lower. Tip on this chart, use the 109 simple moving average to time your dollars. And of course, we are in this downward projection, and it probably should continue. Now, interestingly enough, you had a bull flag in euro right at an average. You've got a bear flag in dollar right at an average, as it should be. So some of the things I'm showing you, of course, seem simple, and I am keeping it that way on purpose. I get much more intricate when I'm getting in and out of the markets, when I'm using my Omni method to figure out where I'm going to buy and sell. The thing is, I would never dare show my Omni method in this free webinar. So I'm not going to do that, kids. That's real. That works. I can kill the markets with Omni, as I've done for years, but I don't just give that out to the public because, God forbid, it ever gets in public hands. I'd rather just teach it to a few people that I bring into Las Vegas. Every now and then, I teach them my Omni techniques here in my home office. I am going to experiment the beginning of next month and actually do an Omni camp on the road, Rockland County. Can't wait to see you guys. I'll let you know how that goes. If I like going on the road, maybe I'll go on the road more. But I'm going to do my first Omni camp on the road. I'm so excited at the end of the month. Anyway, so you got a bear flag here. Right? The pole, of course, gets bigger. Let me just expand that pole for you. So you've got a bear flag. It's working. It's below the 109. It's dropping. Dollar moving down is a good sign that euro is probably moving up. They work opposite one another. I hope that will help you if you are a euro trader. What else can I help you guys out with? Oh, my goodness. Where are we? We're going to leave that NASDAQ alone. Oh, yes. Welcome to the AI revolution. I get to say it again. This is so exciting. All right. So NVIDIA, big piece of the AI revolution, right? NVIDIA working on a 90-bar moving average. Let's go back. Look at how well NVIDIA and the 90-bar moving average is working. Trey, does anybody remember this in my last webinar, the knock-knock technique? You guys must remember this. It's not it's probably not your average trader that comes out with some silly thing that says knock, knock, right? You must remember this. You cannot knock on a stock door this many times without it opening, right? So I was showing you the knock, knock technique. Knock, 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 boom, it opens. All right. The 90-ball moving average is what's important here. See how well that 90-ball moving average is keeping NVIDIA in check? Well, just watch it. Keeps it in check. Keeps it in check. Wonderful, right? What a great average. Keeps it in check. Now it gets above that average, and it gets away from it. Goodbye. It has gotten away from the average. NVIDIA wants to move higher. NVIDIA is a buyer of dips. NVIDIA requires, if you want to time NVIDIA, that you use the 21-bar moving average. It is perfect right now. It is ridiculously perfect on NVIDIA. Let me move some of this out of the way so you can see what I'm getting at. So the tip on this chart, if I can move this, I will, is to use the 21-day simple moving average to time NVIDIA. Look at how well it works. 1, 2, 3, 4, 5, 6, 7. Then it gets underneath and stays underneath. Look at how well. I mean, wow. When I found out, I went, oh, dear, thank you, Wall Street. I thought I'd share that with you cats as well. It's also forming a new channel. Look. Check this out. So I kid you not, I don't think any of this. I'm not making any of this up. I am pointing out factual analysis to you that will happen. This is not a guessing game for me. I'm 43 years deep. I promise you, these things work out almost all the time. You just have to know how to spot them. You're in a strong bull channel. You got away from the 90-ball moving average, got into a smaller one, exploded, had a massive gap right here. This is an earnings report gap, by the way. And what mostly this is, if you ask me, in fact, let's just draw a little gap here. In between these two blue lines, massive gap, earnings happened, and this is your AI revolution. I mean, NVIDIA is making a fortune off AI. We are in a huge AI revolution bull market. NVIDIA looks like a fantastic buy off of the 21-ball moving average, or simply buy it at the bottom of this channel. It is working. It will work for you. Great trade, great stock, and great indications off of it. So welcome to the AI revolution. I promise you, we're in it, and we are going for quite some time. So for you bears out there, have I convinced any of you yet that you're wrong? I mean, have any of you started thinking that maybe you're wrong about this? The charts don't lie. You know what does lie? Crazy opinions that get stuck in your head. Those lie. Charts don't lie. All right, what else do we have? We just did the dollar. Let's go look at the Dow Jones Industrial Average. Here you go. There's another pretty chart. So the Dow's all-time high is right here. So that's where the all-time high is, right? And we've had a big crash, and everyone says that this is just a wave before the next shoe drops. And maybe they're right. I don't know if they're right or not. I promise I'll be the first one to call the downside. But looking at this right now, let's just see if I can show you what's going on. We were using a different average, but look at this one. The beauty of this chart is the averages I've found that work so well. Look at this 60-ball moving average right here. It works like magic. I mean, wow. So I figured, all right, we'll start using the 60-ball moving average for timing. But bigger than that is the fact that we are close to all-time highs as opposed to all-time lows. And this wedge or pennant, if you will, is forcing the market higher, pointing upwards. It's trajecting the market higher. So the likelihood is that we will break out of this towards the upside. And what I want you to recognize is if you are going to trade it, go with the 60-ball moving average right now. It seems to be magical. Whatever reason, I could care less. I don't try to reinvent the wheel. I try to spot the best wheel that works for my car, so to speak. Slam it on the car, go very fast with it. I don't try to reinvent the wheels. I just want to make sure I use them properly. So the wheel has been invented. Whatever the 60-bar average is, it is. Wall Street loves it on this particular model called the Dow Jones Industrial Average. So do I. And I noticed that when it does get through, here's what's key for this week coming. Pay attention. When it does get through, it doesn't last long. It just hits the bottom of the pennant and bounces back up. So what I mean is look inside this rectangle. Okay, you see it did get through, hit the bottom of the pennant, went back up. Well, we are in the same situation right now. Maybe it gets through and hits the bottom of the pennant. So what? That's what it does. Keep your eyes on that. If it hits the bottom of the pennant, comes back above the 60, long you get to go. Keep that in mind for next week. The tip is that Wall Street is king off the 60-ball moving average and your Dow Jones Industrial Average. What else is out there? Oh, we're going to start to look at weeklies, huh? All right, I think it's time to go start to look at weeklies. There should be, well, this one says massive head and shoulders. Does anybody see a head and shoulders? Ah, there we go, same chart. I was wondering why it was there. Here's what another reason why I want you to recognize we are now showing signs of bull market, not bear market. I don't care what your fund managers tell you. The Dow Jones Industrial Average started off with a head and shoulders, left shoulder, head, right shoulder, 2022, January 5th. That's the high right there. And then it cracks. So it cracks down. Let me move some of this out of the way so we can read it. Get back over here. It cracks down. So the Dow Jones agrees. It's a massive head and shoulders. 2022, we go down, gets under the 200-ball moving average. Red line resistance. Here, gets above the resistance, gets above the average. Whoa, interesting. Comes down, tests the 200-ball moving average, holds it, gets back above, and here's what's interesting. If the down move started with an upright head and shoulders, we've got an inverted head and shoulders starting the up move. Doesn't that make sense? Doesn't that show you that, yes, this is probably the other side coming now, aside from everything else I've shown you? All right, so an inverted head and shoulders above the 200-ball moving average. That's this. It's built above the red resistance. That's this. The tip is buying will pick up as soon as we get above this inverted head and shoulders, and that's represented by this little line right here. I'll make it darker for you. Buying will pick up as soon as we get above that. That's where all the stops are going to be above the market to take it higher. Right now, all the stops are being put in above that blue line. We are going to take those out at some point and move higher. It's what the market's indicating right now. Nothing goes straight up, so you could come all the way back to the 200 first. But that is the eventual this year. That's what will happen is the upside. Let's see what else we've got prepared. Now, remember, every one of these charts are the same things we looked at last webinar where I called bottom. I'm just moving it forward for you now. So we just looked at the Dow Jones weekly, right? DJI. Let's look at the DJT weekly. This one's another pretty chart and simple, simple, simple. When I say simple, look at how simple this chart is. Let me just move some of this out of the way. All right, so stair-stepping higher. Now, there's a word that I'm going to use that you've heard from everyone else, and they're wrong. They don't know how to see. Many people don't know how to see market rotation, sector rotation. So what they are saying is that this rally has happened without wide breadth. Stair-stepping higher is a sign of a healthy, wide breadth market rally. What does stair-stepping mean? See these dotted lines, which I could start to make deeper if you need me to. I think you could see them, but this is just stair-stepping higher, right? It steps up here, and then it steps down, it steps up, it steps back down, it steps back up in a nice broad fashion. It's stepping up and stepping down. It's bringing the other stocks with it. This is a healthy market. Up, down, up to a higher high, down to a higher low. The first chart I showed you was this exact thing. So let me show you why it's absolute. You go up to a high, down to a low. You go up to a higher high. You go down to a low, up to a higher high. And I'm not really going to count that little zigzag. You're going to watch this one instead. Watch this. This is going to take us to a much higher high. So high, low, high, we're waiting. We expect it up here. Probably will end up taking out the double top. That's what you'd expect in this long, steady stair step higher. As the market moves inside of this channel, eventually you'll end up there. And that's part of the steps that is showing you that this is a wide breadth move. It's not just a difference. If it was going straight up, That shows you that it's very narrow breadth. It's a few stocks. When it's going up like this, it's taking everything with it. And then we've got a really pretty chart. Well, we'll do one more. This was here. We have the weekly. Let's go with this one. We did that already, right? We showed the head and shoulders. Let me show you. There's one really pretty chart that we'll look at. So now we're all big S&P traders, right? The S&P has broken above this red resistance line on a weekly chart. Now we're looking at a weekly. Each one of these red bars or green bars represents 5 full days of trading. So the S&P is in a tailspin and everyone's bearish except for that. Why would you be bearish when you are in trajectory channels moving higher and it's different than it used to be? What do I mean by that? Well, here you basically rallied up, hit the red trend line, resistance, dropped. Hit it again, same reaction, dropped. Hit it again, same reaction, dropped. What happened here? Well, that's different, right? And what we do, we've gone into a series of upward channels now. All right, now you have this channel, the blue one. Make it a little darker for you. So you got the blue channel moving higher. You've got the green channel moving higher. And the market is moving higher. And the beauty of all of it is, check this out, it all happened when it bounced off of the 200 bar moving average sitting right here. Let me just make this circle a little bigger if I can grab it. Right there is where it all started to change. Got above the 200, trajectory is moving higher. Wall Street is watching, buy dips down to the bottom of this green channel is my tip for you in the S&P. And then there's another chart that I think you're really going to appreciate. Many of you have seen this before, and it is absolutely worth taking a look at. And it is my NASDAQ chart. Let's just pull that bad boy. Oh, there's one more. I got a prettier chart than this for you. There's just so many charts I've gone over. I got to make sure I can pull the right one. That's a daily. Yeah, and we'll do it like this. All right, so this chart is my absolute favorite chart, and it is the chart that will convince you whether or not any of the other charts I showed you convince you that we're in a bull market versus a bear. This one will. Follow me. NASDAQ weekly chart. The tip is that the NASDAQ chart is our indicator. It is telling us everything, and I'll explain that to you. You're going to use this chart for your sense of direction. If you like what you've seen in this, please join me at livewithoscar.com when we're done. Now check this out. You're looking at the 200 bar moving average, this green average right here. It goes across the entire chart. So we're going to go back and look at this 200 bar moving average. Just follow me on this. The 200 bar moving average never gets pierced. It just never gets pierced. Look, let's pull this out of the way. Maybe I should pull it down here. It never gets pierced at all. It's the 200 bar moving average on the weekly NASDAQ. It's above 2008-9. The only time you could pierce this was the crash of 2008. And by 2009, we were back above. Now follow me on this. NASDAQ weekly. What happens after the NASDAQ gets above the 200 bar moving average or comes down to it and hits it? A massive rally ensues. Massive. Look at the size of that rally. So you got to the average and a massive rally ensues. And what does it do? It just continues on. And it continues on. But look, somehow gets close to the average and a massive rally ensues. This is 2016. Let's move along now. Look at here. 2000, which one was this? 2018. We dropped down, almost hit the average, and a massive rally ensues. And here's where it gets interesting. The market during COVID could not take out the 200 bar moving average. During the COVID crash, it stopped cold at the 200. But what did it do once it got there? Like it did here. Massive rally ensued. Gets here. Massive rally ensues. Now you have to realize this is a weekly. This might look small. We're talking about the price of 5,800 NASDAQ, the beginning of this little rally. And after hitting the 200, it goes all the way to 97. From 58 to 9,700, the NASDAQ went after getting close to the 200. Then it actually hits the 200. And you know where it goes from? 6,600 to 17,000. All right. So we got something here, don't we? Then it starts to run into resistance. Boom, boom, boom. Every time it hits that, it fails. But here, things change. And here, things get happier. Now, you get above the 200 ball moving average. What do you think is going to happen, kids? An extended rally is what will happen. That's it. There is no question. That's what happens if you get to the 200. An extended rally. So if you are still bearish out there and you are a 401k manager, shame on you for using your opinion over your eyes. You've got customers that need their money in the market right now, and you've got them in bonds at 5.5% interest instead of in the stock market where you belong, because most fund managers believe in what they think, not what they see. You give a fund manager a couple of bonuses because he's using other people's money and he gets a 2% or 1% management fee. Next thing you know, his pockets are full and his brain thinks he was born for this. So he starts to say, I know fundamentals, this thing's going down, I know better, I've made money doing this, on other people's money, of course. And they get stuck in this mode, and then you show them a chart and go, you are wrong, but they don't know how to get out of that mode. Why? They think they were born for this. I know better. I am a messenger of charts. I read a chart, I send the message out to other people, and I trade what I read. I do not think I'm smarter than the market. And these charts are a simple roadmap to everything that's going to happen next. And that is about all I had to show you, kids. I just wanted to make sure that you are in tune. Nothing goes straight up. We are in a bull market. These projections are working. Don't listen to the crazies out there. Use your eyes. Jeff, all yours.
You got time for a second or a couple questions, I mean?
Sure, I'm here.
So is it www.livewithoscar or live with Oscar?
Listen, it is live with Oscar because I'm here 24 hours a day. If I'm eating, you're eating with me. If I'm swimming, you're swimming with me. It is live with Oscar, baby. It's what I do. You want to join me? Come on down.
We had a couple questions that are around the same thing. Anise and Amit wanted to know how you figure out what moving average you're using on a certain chart.
Well, you know, it's basically trial and error. You start using different averages until you find one that's smooth and stays out of the market's way, but hits key spots only, like this 200. And when you see that, you must realize that it's being programmed into every algorithm. That's all they have. Algorithms, unless you want to make things up, by the way, unless you want to make up variables that you think are part of the market, an algorithm has to be based on what it sees in the past. It has to be. Oh, or you're adding stuff in that didn't happen. So if it's based on what happened in the past and the market stops at that average every time, the algorithm has it programmed in. We just have to find what average stops at those turning points, and I promise you it'll be in a Wall Street algorithm. Trial and error is your best bet. Just keep snapping them on until you get one that fits.
All right, one more question from Julian. Julian wanted to know, when you're looking at the EU, is it implied that the EU is going to move higher?
It is. Let me see if I can pull that chart for you again.
Not a guarantee, just for legal reasons.
Do that, but let's see. Is my Euro chart? Do you see the Euro chart? I'm sure it's right before my eyes.
Oh, I'm blind in both eyes. I can't see out of this one, and I can't see out of the other.
How about we just do it a better way? It's the 6E, right? Oh, it's right in here, baby. I got you. Euro. So I've got so many charts. All right. So this is indicating that the market absolutely does want to go higher. It is in an upward trajectory channel. It's bouncing off the 100 bar moving average, and it's just breaking out of a bull flag. So yes, short term certainly wants to go higher, and long term it looks the same to me.
All right. Very cool. Oscar, a couple comments for you. These are straight from the YouTubes.
Okay.
Great overview of the markets. Truly invaluable information. Sandy wants to know that Oscar writes the charts, and she put one exclamation point there. And then let's see. Do you have any? So just great job is what I was saying. A lot of people, a lot of really good comments. We love you. You do such a great job when you come in here.
Thank you.
So,
I hope it was clear, simple. I was just trying to offer some tips that people can use next week, next month, going forward.
Here's a quick one. I know I said it was the last one, but like this is, I promise, the last one. Jim wants to know if you think Russell actually catch up, because it's been kind of lagging the other major indices over the last several years.
Sure.
I think that's a great question. That's why I asked it.
Fantastic question, actually. So the Russell 2000 is made up of smaller cap stocks. And what we call sector rotation is when you see Wall Street buying the, let's say, the larger brick and mortar stocks, and the Dow starts to go up. And then they'll switch to the NASDAQ stocks, which are high tech, and NASDAQ will take the lead, and then Russell will take the lead. Well, 3 weeks ago, Russell 2000 was in the driver's seat. It was taking everything higher. There's been sector rotation now. Looks like it's moved into S&P a little bit and NASDAQ. But yes, Russell will catch up. It's just right now, especially with the window dressing, which you see at the end of a quarter, it's always smarter to get the large, expensive stocks up higher than the smaller stocks. I think in this next quarter, you'll start to see the Russell catch up.
I love that question. I think that wins the question of the day.
Yeah, great question. But Russell tends to lead sometimes. It's not the leader at the moment.
All right. Again, Live with Oscar or Live with Oscar, it's spelled the same either way. You can say it how you want, but you should go join, hang out with Oscar. He does such a great job. I love having Oscar on. Thank you for coming in with us today, Oscar.
It's simple. If you do join, work your way to the chat room, and I will literally be here on camera to hang out with you. Probably not today. I could use a day off, but you'll see me here from Sunday night until next Friday night.
All right. Very good. Thank you again, Oscar.
Thank you very much. Thanks for having me. Good luck, everybody.
All right. Very good. Let me go ahead and do this. We do have some training that we recorded with Oscar, and I want to talk a little bit about that. And let me go ahead and make me the presenter again, and we're just kind of, because he does such a really good job. And like Sandy says, Oscar rocks the charts. So should be able to see my screen. I'm going to go ahead and turn on my camera for a little bit. And we'll just talk a little bit about the masterclass that we recorded with Oscar. I think we recorded this in 2022. If I remember right. So he did a class. We sat down and we did 3 hours of recorded instructions. And one of the things Oscar does a really good job on is trend lines, technical formations. And really what he kind of does is he spent 3 hours just talking about how to mock up a chart, how to put trend lines on there, how to do support and resistance levels. I'm tangled up under here with this thing. Okay. And how to do technical formations, all that kind of stuff. Did such a good job. 3 hours of instruction on just how to do that. And so it's a recorded class, one of the only classes Oscar has available that's not part of his camp. And we offer that as a one-time cost of $349. Well, normally it's $499. Here at the Summit, it's $349. So he did such a great job with it too. We really appreciate it. So you can take advantage of that by giving us a call at 800-882-3040. Or you can visit us at metastock.com/saleschat. So, and if you're liking today, if you're impressed, I think everybody's done such a great job. But it is part of that bundle package. It includes the AI Conviction Plus, Steve Primo's Momentum Strategy #4, and all the training that comes along with that. The Steve Bigalow Candle Profit Systems 3.0. It'll also include Adrian Manz. He's going to talk in just about an hour. He's got some really good patterns around the horn. You get 3 months of learnmetastock.com, which is a really good website. I brought a new sales guy on just a few weeks ago, and I had him just to kind of help him come up to speed. Had him go through videos with Learn MetaStock all week long. All of the videos that are on learnmetastock.com have little quizzes at the end that you can take if you want to make sure you're learning. There's hundreds of hours of instructions. And this package will include 3 months access to learnmetastock.com. It'll also include Unleash the Power of MetaStock, which is a normal $99 value. So normally, like all of these add-ons for MetaStock, if you bought them separately off of our website, would be $3,987. Here at the event today, we're going to offer them to you for $2,344. So you can do that by going to metastock.com/summit deal. If you have questions, you can call us at 882-3040, or you can get online with us at metastock.com/saleschat. This is a great collection of stuff. The Conviction Plus, I've known Raymond for a number of years. He does such a good job with kind of designing indicators that are unique and creating systems that do well. Steve Bigalow, his add-on, we just updated it to 3.0. His add-on's been one of our most successful selling add-ons of all time. And you can get the new version that we just shipped out yesterday. All of that, normally $3,987. Here today, $2,344. So I encourage you to take advantage of that. That's a more than 50% discount, or almost 50% discount. Metastock.com/summit deal, 800-882-3040, or metastock.com/saleschat. Jim, that was a really, really good question. Van says, Jeff, where do you anticipate the metals are going for the next 6 months? I don't look at metals, so sorry. I don't have any type of a projection for metals. And nor do I really feel comfortable about projections in general, just because I don't know. Since I generally tend to be wrong, but I don't know that that's necessarily true anyway. But for the certainly not metals, I don't have really any advice for you on that. But you could go, like if you like tell Oscar, you go to www.livewithoscar.com and join his chat room and ask him. That might be a good way to. He's better than I am. So there you go. Anyway, yeah. Metastock.com/summit deal, 800-882-3040, or metastock.com/saleschat. So any of those. Another question. Okay. Before I get to your question, Jim, and I didn't forget about your other question. I like your question a lot. I'm going to answer you. I do want to say thank you to our sponsors, AAII. You can find out about AAII at aai.com. It's a very, very well-reputed, well-respected organization. We're happy to be partnered with them and their lead technician, Rondeau, who spoke a little bit earlier. But it's a great organization. If you want to check it out, it's a nonprofit. You can go to aai.com. So in addition, I really appreciate Stocks and Commodities Magazine. Great art magazine. They've done publishing in a magazine since 1982. They've got 1.3 million subscribers and a 17,000 article trading archive, which is yours if you have a membership. So the other thing that I like about Stocks and Commodities, and you probably know that, is that because you're here on a Saturday, I'm just going to assume that you think it's important that you kind of learn about the markets and that you can kind of continue your education around the markets. And I always think that's important because even like if I don't dramatically change my trading strategy, the more I learn about the markets, the more I kind of understand kind of what I'm doing. And I like to continually, I think just in general, you're either getting better at something or you're getting worse at something. There isn't anything, especially in trading or life in general, where you're just in neutral. You're either improving or you're falling away, right? And I think just by getting a magazine, I've been getting the AA or the Stocks and Commodities magazine since I started here, and really appreciate them sponsoring the events. They've been sponsors a long time. But if you don't have a subscription to Stocks and Commodities, and you go to metastock.com/traders-summit today or tomorrow, you can sign up and you can get a free issue sent to you. You should do that. So, and thank you again to Stocks and Commodities to supporting the event. So there you go. And they've been supporting us for a number of years. We're, of course, MetaStock. I'm going to talk a little bit about MetaStock today, right now, actually. And I know we're running a little bit late, so I might have to prune down my presentation a little bit, but I'm definitely going to talk a little bit about MetaStock. And I'm going to do that in just a second. Greg, are you trying to talk to me?
Yes, I am trying to talk to you.
I can hear you only through the wall, though.
How come my so I'm trying this a whole new way. I put my webcam on my computer, but it's just showing black. Why is it doing that? I don't understand.
I don't know. You're the tech guy.
Yeah, I guess I am. I'm doing this a whole different way so that I'll just dispense with any sort of picture of myself. But I did want to take a second to introduce our very own Jeff Gibby.
Okay.
Who just doesn't get enough credit around here for the fantastic work he does. And he's been here for 365 years.
Yeah, that's right.
You wouldn't even know
checks.
that he's 95 years old, but he's really, really, how shall we say, knowledgeable on trading in general and MetaStock, and you should listen to every single thing he says. But Jeff, you do need to kind of fix your hair sticking up a little bit. Just kind of.
I'm going for the mad scientist look today.
Is that it? Okay.
Yeah. It's the headset. It messes with my hair.
Is that what?
So,
Okay.
Yeah.
Anyway, I didn't want to take away too much from the presentation, but break a leg, and again, am I forgetting anything? I was forgetting. Like, I feel like I should say, in all reality, you've been with the company for what, 30 years?
I think it's 27 in March, but I have to check my LinkedIn anymore.
If you had to guess, how many presentations, how many webinars do you think you've done?
Thousands.
Easily, right?
I can tell you for a fact I've read this presentation, I read this disclaimer so many times that I can recite it while I'm asleep.
Well, I'll let you go ahead and, okay, I want you to close your eyes right now and do the disclaimer.
Okay. No, I'm not going to. I'll just read it.
Okay, I'll let you go.
Today's demonstration. Go ahead.
In all seriousness, give a good listen to Jeff. He's a great
Yeah.
presenter and very knowledgeable, and he has great things to tell you.
All right,
And I'll
cool.
bet you he offers you some super great deal at the end of his presentation.
Sounds good. Thank you, Greg. Your sound is a little bit low, and I'm getting that in, but since you're going to be quiet now, I wouldn't worry about it too much.
All right.
Is my sound low, Amit?
Yours sounds beautiful, but it's technical, but I'm coming at you from a couple different directions. I think the people on GoToWebinar might not hear me that great, but the people on YouTube are hearing me just fine. But it doesn't really matter because what's important is you, and you sound like an angel.
All right. Very cool. And okay. Cool. Thank you, Greg. Greg does a great job too. He does everything, so many things. So, and he's also been here for a while. But let's we would certainly appreciate him. He's in our studio right now, tweaking things. So, thank you, Greg. All right, very cool. Let me see if I can recite this legal disclaimer without thinking about it. Today's demonstration is designed to instruct you on using MetaStock and the accompanying plugins and add-ons. It's not a recommendation to buy or sell, but rather guidelines to using specific indicators and features within the software. I had to check. The information, software, and techniques presented today should only be used by investors who are aware of the risk in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So there you go. I really appreciate Greg and his introduction. I'm going to let you read this slide. MetaStock's been around for a long time. I actually started it was 2007. So I know that, no, it was 1997. Because Reuters had been owned MetaStock for 2 years when I started. So in 1997 is when I started. It's a company that started in 1982. And I started in inside sales. And I loved that job. A lot of times if you had questions about your trading, you'd call, and there's a good chance you'd talk to me, and we'd talk about what you're looking to improve about your trading, whether it was finding better securities or having a better trading strategy, or just understanding the markets a little bit better. And the thing that was nice about kind of having questions like that, or being able to do that, was because those are things that very much MetaStock has always been really good at addressing, finding the right strategy at the right time. So I really very much enjoyed working in sales, and I did it for about 10 years. For the next 10 years, I did, it was, and yes, I measure once you get to about 30 years, you measure them in decades, I guess. But like for about the next 10 years or so, I was totally in charge of all of our US-based partnerships and a lot of our education partnerships worldwide. And I've worked with everybody that's talked here today, Steve Bigalow, Dr. Elder, Ray Rondeau, Oscar Carboni. I've had the ability then to really kind of talk to people about their trading strategies and understand, really good traders, way better traders than I am, and understand really kind of the mechanics of what makes a good trading methodology. And I've learned just a lot doing that, and that's been always fun. For the last, 6 or so years, I've still handled all of our online events and all of our US-based partners But then in addition to that, I actually kind of help our sales team and I have a lot of responsibilities depending on what day it is. Greg actually the other day just kind of, we were talking about how many different things we end up doing when you work for a company that's kind of dynamic and small and agile, and that's a lot. So I will say a couple of things about working for MetaStock, and maybe that gives you some insight. And maybe it was too long. It was probably too long. I should have abbreviated it, but it's a great company to work for. I've loved working here. It's a lot of fun. Every day is something a little bit different. And then the other thing that I just really enjoy is the fact that it's been such a useful software for me. Personally, I trade with it. And I use it. I trade with it every day, unless it is like 2:30 here in Utah and I forgot to look at my charts. I try to get in there and look at my charts every day, but I love the fact with MetaStock, it's so easy to kind of make these decisions and run these explorations. And I can usually squeeze a whole day of my trading activity with how much I'm trading in about 15 to 20 minutes right before the market closes. I just run my scans, I look at any positions that I've got, and it works really, really well for me. So the other thing I like to talk about is how MetaStock's been rated #1 in its price category, and it's done that for 30 years in a row. And so we're very, very happy with that as well. We had William a little bit earlier in our YouTube chat saying, I've been using MetaStock for 25 years. A lot of our customers have used us for decades. We were looking at some survey statistics the other day, and it's amazing how long people just stay using MetaStock. Once they get started, once they get going with it, the retention rates are really, really good. And for any of you that have been using MetaStock for decades, thank you. I appreciate that. It allows me to continue to work here and have a job that we enjoy and just love. So 30 years in a row. And that's what I'm going to say about that. So we did have a question from Jim that I promised not to forget, and I almost forgot anyway, but that's not unusual. Jim wanted to know when the recordings are available. Right now, we're streaming straight to YouTube. So thank you for the question. When I get that question, I actually really like that question because it makes me feel like you're enjoying the session if you want to watch it again, or you want to come back and review things. So we are streaming this directly to YouTube. If you're watching us in GoToWebinar like you are, Jim, you will get an email from GoToWebinar in 1 hour. And 1 hour, not 1 hour from now, 1 hour after we stop, it's already set up. It'll just send you the YouTube link. So thank you. I hope you're enjoying today's event. A lot of work goes into putting these events together, and I just like it when they go well. And I think everybody's done a really good job today. Steve, the other Steve, Ray, Oscar always does such a good job. So my thank you to all the presenters so far, and all the presenters here, and everybody that's watching. So, okay. Today, I'm not going to talk very much about, I'm not going to certainly spend an hour just because there's about 30 minutes late, but I do want to kind of highlight some things that are in MetaStock. And so this particular class, when I come in and I start talking about MetaStock to an audience like this, I usually will come in and I'll talk a lot about like the advantages of being able to test a trading idea before you put it in the market. And MetaStock does a really good job of that. Has a lot of trading systems. You can test different ideas against different stocks, and it has, in my humble, totally unbiased opinion of somebody that's an employee for 30 years, almost rounded, it has one of the best testers in the market. It also has one of the best available collections of systems that you can just test out of the box. And I think that's one of the things that we really do. And usually I'll talk a lot about kind of that we call the power tool of MetaStock. I also really like scanning, and so we'll usually talk a lot about scanning. But once in a while, I'll just kind of like, okay, well, we've talked about scanning a lot today, and I certainly love scanning. But this particular class I like because I'm going to talk about with MetaStock. You just keep it in mind if we kind of go back. We've been working on MetaStock since the 80s, right? And there's a lot of things that have been added in the software that you just may not even be aware of. And so today I'm gonna talk briefly about 3 things in MetaStock that you should be aware of and may want to look at, just in case. So So let's go ahead and just kind of get into exactly what they are. If you have a stock you want to look at, go ahead and type it in the comments, or the ticker particularly, and I'll look at your stocks as we have a chance. Hello, Abdullah. Thanks for saying hi in the YouTube chat. If you have questions as we go, type them in. I'll look at them. I'll kind of look over there from time to time. Van wants to know, is MetaStock available as a cloud product? That's a good question, Van. It is not. And there's a very, very specific reason it isn't. We just didn't feel like, so we did a lot of testing, especially when we created the new charting engine about data delivery in particular for charts. And we decided that where HTML5 was, we didn't want to be delivering data for real-time charts, for real-time stocks through HTML5. That might change in the future, but for now, we were not happy with the performance that we were getting. And if you look at any chart applications that's developed in HTML5, if you end up refreshing the browser so you can get new data, you know exactly what I'm talking about. So not right now is the question. And when the technology matures a little bit more, maybe. But no, not for now. So Amit says, do you want to talk about scanning? I will. Okay. In fact, we're going to talk about breakouts. So I'll talk about scanning in a little bit in a second. One of the things that, in fact, I think MetaStock is one of the things that it does best is scanning. And what I'm going to do is talk about scanning as a way to identify breakouts. So in any case, let's kind of just talk a little bit about finding breakouts. Finding breakouts of support, resistance, breakouts above trend lines. Oscar talks a lot about kind of support breakouts. One of the most famous trading strategies of all time happens to do with like the turtle traders. That's finding breakouts. And a lot of times, like even if you listen to like Vince Vora talk, he likes to talk about like finding stocks that have hit an all-time high and have passed that all-time high. And because the way he explains it is better than I can explain it, so I'm going to use his words, not mine. But once you beat an all-time high, there's no more resistance. In other words, that thing generally can tend to move a lot higher. So one of the things that we get questions about all the time is, can I find breakouts? Can I find stocks that are breaking through support, down through resistance? I mean, up through support and down through resistance, right? Or up above trend lines and all that kind of stuff. And I want to show you how to do that in MetaStock. Right now we're looking at Chubb. Because Ed wants to look at John Deere, let's go ahead and just jump symbols real quick, and we'll look at John Deere. And what I'm going to do is I'm going to show you a template. I'm going to kind of walk you through that template of exactly what it does. So let me go ahead and apply the template. This is a template that we started including with MetaStock because I had actually built it for myself. And then I started showing it at seminars, and then I'd be like, and send me an email if you want the template, and here's my email address, and you're welcome to email me. But I was just like, let's just include this for free because these are really, really cool tools, and I want you to be able to just apply them and kind of look at them the same way that I look at them. So if you have like a 16, I think, or 17 or later, you'll have this. And to get them all applied, all I did is I right-clicked on the chart. I went to Apply Template, and the name of the template is just Dynamic Trading Tools. Okay. And as soon as I put that template on the chart, a lot of lines appeared. And for the purpose of just showing you the lines, I'm going to make them all just a little bit fatter, just so you can kind of see them. Okay. Here we go. Okay, make that quite a bit fatter. They're just a little bit for internet use. You might not be able to see them so clear. And so all I'm doing, if you want to change stuff in MetaStock, you just double click on it. And that'll bring you to the properties dialog box. And all I'm doing is just kind of making these lines a lot more visible on the internet. Okay. I'm going to scroll out a little bit just so you can kind of see these. And then I'm going to kind of make a couple of these lines a little bit thicker too. So bear with me while I do this. It'll only take me a second. I thought I had done this and saved it, so I didn't have to do this every time, but apparently I didn't save it in here. So in any case, there we go. We have a little bit bigger lines. You should be able to see those very clearly. Now, one thing I'll say about these lines, they're dynamic. They're automatically drawn, and where the MetaStock algorithm decided that it was long-term support or resistance based on kind of looking at a number of factors that they look in that I wouldn't pretend to be able to explain. But you can see right here with this thicker green line, this is what they would call a longer-term resistance level. Okay, it's been penetrated a few times on this particular chart. This right here would be what we would consider a shorter-term resistance level, and so that'll move a little bit quicker. Here you've got your longer-term support and your shorter-term support. So those are just automatic levels that are drawn on the chart for you. Going to zoom back in a little bit. You'll notice right here you've got a descending trend line that we just penetrated a few days ago as it popped up above that. And then it popped up above what we're seeing as the long-term support right there. Okay. So this is all kind of fairly visual. Okay. And right here is where we popped up above that trend line and we've popped up above that support level. Here we came up to an ascending trend line. You can see that right here. Almost got support, but it held. Okay. So recently, if we're just looking at support and resistance, we can say that we broke up above this trend line. I'm trying another line, don't mean to. And then we also broke through here. And in addition to that shorter term, we're kind of on this shorter term resistance area. I wouldn't say that it's broke. It's tried, came back, and it's kind of playing around with that level for the shorter term level. Okay. But usually, like if you're looking to find breakouts in a market, what you're going to be looking for is you're going to look for penetrations of these trend lines, or you're going to be looking for penetrations of these resistance areas and these support levels. And it's that simple. Now, what I like about this is it's fully automatic. It's put on there. So the thing that I like to remove about any of the trading I'm doing is subjectivity. So since this is all kind of driven by a computer algorithm, it's completely objective. Also, it's scannable. So when you say, well, can you talk about how to scan a meet? If I wanted to find a stock that's breaking up through longer term resistance as it did right here, if I wanted to find stocks that did that, I can scan for it. Okay. And so for me, where I'm a very, where I like to be able to kind of condense all my trading into just a really quick session because I'm a very busy professional during the day. The ability to scan and identify these very, very quickly is something that allows me to not have to look at thousands of charts to identify the opportunity. So let's talk about how we find these in charts. What I'm going to do is I'm going to open up our Power Console right here. Okay. And what I'm going to do, I'm going to go ahead and kind of just unselect these. And these are built into MetaStock. So, and they're just called DT. DT stands for Dynamic Trend. And all I'm going to do, I love the fact that I can just type in DT and it'll find all the stocks that have DT in them, or all the scans that have DT in them. A new thing that they added to 19. But what I'm going to do right now is just run an exploration. And what I'm going to say is I want you to find all of the stocks that have broken up through resistance or down through support recently. And now there's a couple of different flavors of these just because I have different lines on here. There's a longer term and a shorter term. Let's find anything that's broken through recently a longer term resistance and support area. So that's the scan I'm going to use. If you're using MetaStock, I also like the trendline breakouts. You can play with the shorter term ones if you want. Generally, I'm using the longer term breakouts for trend lines and the longer term resistance areas. And the idea here is I want to find stocks that are breaking out. Okay. In terms of being able to scan, so I've got one exploration selected up here. In terms of being able to actually do the scan, what I'm actually going to do is I'm just going to select the universe that I want. And it doesn't matter what universe that I select. Okay, because one of the things that we have is a good relationship with Refinitiv. We're no longer owned by Refinitiv. We bought ourselves back a few years ago, but Refinitiv used to be Reuters. They sold it to Blackstone Consulting, and now it's owned by the London Stock Exchange. But they're one of the most well-respected providers of data in the market. Okay, and as being such, there's a good chance. If you're a hedge fund, you actually play with Refinitiv or Bloomberg, one of those two. They're the two people out there. But we offer really good news through the Refinitiv service. But in addition, we have a great market breadth of data. What I mean by that is if you're joining us from a different country like London or India or Singapore or Australia or you name it, the data that we get from Refinitiv spans hundreds of exchanges. Like I counted it up one time. I don't remember the exact number, but it was between 200 and 300 different exchanges. So regardless of what you want to do, if you want to apply any of the methods we talked about, whether it's like Steve Bigelow's method or this breakout method or Ray Rondeau's method, no matter what you want to do, you're going to be able to get that data. And in addition, because it is institutional quality data as well. So anyway, in any case, I think this is probably the main tool I'm going to show just because I'm looking at the time. And I'm going to try and actually do a little bit of Armo, maybe two, real quickly. Okay, so if I want to find any of the breakouts, I'm going to go ahead and choose this DT support and resistance long term. And what I've just done is I've selected the Dow Jones Industrials, the NASDAQ 100 and the S&P 500. I'm going to go ahead and start that as a scan. And what it's going to do is it's actually going to go through all of those 500 stocks. And it's going to go in and tell me exactly which ones have broken through longer term support and resistance and how many bars ago did that happen. So, I mean, hopefully this is helpful in terms of asking the question about scanning and how does scanning work in MetaStock. Hopefully that's helpful. Hopefully this kind of gives you a good idea of how it works. But the thing is, while it's finishing, you can scan just about anything you want to. You can scan for MACD buy signals. You can scan for breakouts. Another scan I like quite a bit is performance. Like another thing you might want to be looking for is stocks that are moving up when compared to other stocks. And so there's actually a performance scan that'll do that. But you can do just about any instrument lists that you want or any stock list that you want against any idea that you might have. And you can create your own ideas too. That's actually fairly easy to do in MetaStock and a little bit beyond. We're not getting into how to create scans today just because we don't have time. I've actually, on our YouTube channel, youtube.com/MetaStock, I talk about how easy it is to set up. I do a Formula 101 class, and I actually show you how to set up scans that just say closes between this value, and the volume is this much. And so youtube.com/MetaStock, you can search Formula 101 and find that video. Okay. So the scan's done. You'll notice that went through 500 stocks, 274 came back with a reject rate of about 252. Okay. Right here you have a column that lists the close price, whether it broke up or broke down or both, and then on how much volume as a percent. So what on the bar that it broke up, how much percentage of the volume was it of normal. Okay. And then if I sort this column, so I'm going to sort on the breakup. Let's say we're looking for stocks that broke up recently. Right now, the one this was very recently, because this number 806 means that Rockwell broke above its long-term resistance 800 bars ago, which is multiple years ago. So I'm going to ignore that one. And what I'm going to do is just scroll down a little bit because I kind of want it to be more within like a week or two, not like a year or two. So let's kind of go scroll down. But let's say that we wanted to find stocks that have been breaking up within the last week or 5 trading days. Iron Mountain broke up on 9% less volume. Simon Proposition, 8% less volume. EQ Resident broke up 4 days ago, and it had plus 50%, more than 50% more volume than normal on that particular day. So we can go ahead and open it up. Go ahead and click on it. And if we kind of look at that, let me apply that template again. It's called the Dynamic Trading Tools template. It will show us right here, 4 days ago, is when it broke up above its longer term support level or resistance level. So that's a really, really cool tool in MetaStock. It's called the Dynamic Trading Tools. And if you have MetaStock, play with it. It's great. I don't think I'm going to have time to look at a couple of other charts, but we do have a lot of training videos that are in here that kind of talk a little bit about these methods and that are on the YouTube channel, youtube.com/MetaStock. Another of the methods that I kind of just want to highlight a little bit. We won't even try to show any charts because if you have MetaStock, you can just play with this. But several years ago, I think almost maybe a decade ago, I was down in Australia and I met a gentleman by the name of Gary Burton. And we designed, well, actually, I shouldn't say we. I was running a booth at the Australian trade show in Sydney, and next to me, or a couple booths down, was a booth, and it said ATAA up above it. And I wasn't sure what that was, but I went up and I just asked him, "Hey, what is the ATAA?" And it stood for the Australian Technical Analysis Association. I think it's ataa.com.au. And I'm like, "Well, what do you do for ATAA?" And he told me that he teaches people how to trade. And I was like, "Oh, that's cool." And I had him we talked a little bit more. And one of the things that he specifically talked about was a method that was developed by Seiki Shimizu called the Haguro method. I didn't mean to do that. Let me go ahead and go back. And I actually spent a little bit of time. I had him send me his PowerPoints, and we kind of put together a very unique method that you should play with if you have MetaStock, called the Haguro method. And I was really, really liking this idea. I actually ended up programming this for MetaStock, and I liked it so much I sent it over to Dennis Peterson, who does a lot of, he looks at a lot of stuff he did. The late Dennis Peterson, I should say it that way. He really liked this methodology. And he did 2 reviews on it. And in one of them, he just talked about the code that I put together for MetaStock, and he complimented my programming skills, which I just love because I'm not really a programmer. But anyway, this is designed for weeklies. It's included with MetaStock, and it's designed to help you understand where support and resistance are. It's also designed to help you look at key turning lines or key candles and when those change. So, and if you want to apply that to a chart, that gives you a pretty good idea of what to expect for the upcoming week. So if you want to look at it on the chart and you have MetaStock, I think we added it maybe in 13. I'm trying to remember back. It was a while ago, but it's been included in every version of MetaStock since then. What you'll do is you'll go here to Apply Template. And what you'll do is you'll go to the Haguro model. Okay, I'm going to go ahead and apply that to the chart here. And you want to do this on a weekly. It was developed for a weekly chart, but you'll notice that you've got a midpoint line, which gives you an idea of where the support and resistance is. Right now, we're trading above it on a weekly basis, so you'll treat it as support. All of these lines are actually labeled, with 3 and 15 being the more significant ones. Okay. And I'm not going to go into the definition of each meeting. Here's a little graphic that actually talks about how the look of each candle and their relationship to the midpoint. But if you open this up, it's part of MetaStock. You can actually go into the commentary. I'm going to go view another of my favorite features of MetaStock, and it'll tell you what the candles mean. So right now, for EQR, we have a midpoint of 64.15 and a candle line 2. And if I read this out loud, you'd understand what a candle 2 is and exactly what that meant. Okay, so that's about what I have time for, just kind of looking at things. This is a really cool method. I really appreciate the work that Gary put into actually helping me create this, and Seiki Shimizu for the method and putting it together. In any case, the whole idea, the significant events that happen with a Haguro is if you have a midpoint cross or a candle 3 or a candle 15. So if I go back to this chart, when you cross down below a midpoint, that's a significant event. But also when you get a candle 3, that's usually, that looks like a doji. That can be an overbought or that can be a reversal signal, especially when it's in an overbought or oversold area. So you see right here we had a 3 and the stock went up a little bit. That's because you had that number 3. Well, you had a 3 and it was in an oversold area. Okay. So that's a little bit of a view for it. Dennis Peterson did a review of the actual thing. I have a longer video on YouTube if you want to see it. Just search for Haguro on the YouTube channel. But I'd say it's one of the really cool things that I've been involved in. And you can do scanning for the 3, the 15th, and the midpoint cross as well. Oh, Philip, thank you. Philip went ahead and put in the website for the ATAA. Thank you for doing that. They're not sponsoring today's event or anything, but they've been long-term partners with MetaStock, great organization. We appreciate it. And it's ataa.asn.au. Thank you for that, Philip. You get bonus points for contributing. So in any case, Okay. The other thing, and is the RMO. And the whole point, the last thing, third thing that I'd talk about if I had time is the RMO. Armo has just such an interesting story, and you should play with it. This is actually the trading methodology that I first invested money in. Okay, it's a trend following strategy. It's 100% objective. It's easy to use, and I've probably talked about RMO in some form or another hundreds of times, like just over the years. And the thing I like about RMO is I can go into an audience, and it doesn't matter what country I'm in. Although I haven't done as much traveling after Corona as I did before Corona, but you could go in and say, what symbols are you interested in? The whole point of RMO is to kind of give you an idea of what the trend is designed to do. It's designed to help you trade with the trend, give you an idea of what the trend is doing, and it's completely objective. There's some reasons that I like to show it to people, and I'll just kind of highlight what those are. It's objective, it's easy, it uses stops. It tells you where to put your stops if you understand the rules. Works on a lot of different time frames. So if you have MetaStock and you haven't played with RMO, I'm probably not going to actually even show a chart of RMO. You should. It's a really, really good, well-rounded method. I've shown it hundreds and hundreds of times. And the whole idea for it is to help you identify and understand the trend and what the trend is doing. It's 100% objective. And I'll go in and I'll be, give me a bunch of stock symbols, and people will. And we'll pull up charts, and it just works really, really well. So if you haven't played with it, you should play with it. You shouldn't play with it, though, until you actually go watch a video on how to use it. But we appreciate with Rahul and all the work that he's done. He's such a great technician. He's been doing classes for as long as I've been an employee of MetaStock, using MetaStock, teaching people in India how to trade. And the whole thing is how to identify the long-term trend, the medium-term trend, the short-term trend. How do you identify buy signals? Where do you put in stop losses? And it's super simple. It'll help you. It's one of my favorite features in MetaStock. The story of it is actually kind of interesting too, because Rahul was in the office. He come before Corona, and he would come. He hasn't been since Corona, but before Rona, he'd come into the office every year. You're right. My hair did get messed up, Greg, by the headphones. But he'd come into the office every year, and he would talk. One year, we actually said, Rahul, show us what you're teaching people, because he's a really well-known trader in India. He does stuff on CNN. He's got like 5 or 6 offices, and his real sole business is teaching people how to trade. This is a method that when he showed it to us, we're like, we need this in MetaStock. We want to provide it to all of our users. And we've included it in every version of MetaStock since MetaStock 10. And it's great. You should play with it. Watch a video on how to use it. It's included. And there's just so many things like that with MetaStock. This hidden gem strategy is this hidden gems of MetaStock is meant to be a series. Over the years, we've put so many things into MetaStock. But one of the things I love about MetaStock is it's not a software you're going to grow out of fast, right? There's so many softwares that they plug together, and they like just a software that's delivered through a website, and there's a few strategies in there, but it's all very limited at the core. One of the things I love about MetaStock is the more you learn about the markets, the more that you learn about MetaStock. You can do as much as you want, but it's not going to be something that you outgrow. And I think that, and the fact that it helps make traders more successful, is why so many of our traders have been with us for decades. So anyway, try out Armo if you haven't before. If I wanted to kind of sum up things, which I do want to do, so that we can kind of get back into time, I really think there's a reason that MetaStock has been rated #1 in its price category for 30 years in a row. I think there's reasons that it's the tool. I don't trade without opening my MetaStock and running a scan. It's so helpful for me to be able to just ignore all. If you're an options trader in the US, you've got 4,500 different instruments that you can look at. Some of those are going to have opportunities, some of them aren't. Some of them are going to have little opportunities, and some of them are going to be able to have big opportunities. And one of the things I like about MetaStock most, and Price Headley says this a lot in the work that he does, but he wants to find the stocks with the best opportunities, and he wants to focus on trading those. And I think that just like the engine that we've developed with MetaStock is mature. It's not new. It's not something you're going to go out. But most of all, it's something that's designed to help you as a trader find better trades, find the best methodology that works best for you. That's another classic idea. And it's an engine that we keep evolving and iterating, but there's a reason that it's been rated #1 for 30 years in a row. And for everybody that votes for it every year, thank you. I appreciate that too. So I'd encourage you to give it a try. So, and what I'm going to do is we do have an extended trial. So let's talk a little bit about how much MetaStock costs. We do have a real-time version. With the real-time version, you have MetaStock RT, and you also have a product that we call Zenith. That's a very similar product to Bloomberg, which is about $1,300 a month, I believe, minimum. We have a very institutional quality news. So if you're into news and market data, the Zenith product that we have does a really good job. And so MetaStock real-time and that news and that data and the stuff that you need is $265 per month, okay? Which is way cheaper than if you're a hedge fund buying it, by the way. And that would include MetaStock. It would include the data, everything, okay? We also have an end-of-day version of the program, which includes everything that we kind of talked about today, as well as like, well, not all the add-ons, but like MetaStock. It's only $69 a month and includes all the data and MetaStock and the scanning engine and the testing engine and the forecaster. What we're going to do for you today is what we call an extended trial. So what we're going to say is if you buy a month, we will give you a second and third month for free. So if you start today, you'll be running until October 8th. Yeah, I was doing the math. That's why I was counting on my fingers. So yeah, October 8th, you'll be running well into the fall, okay? And what we're going to do is if you just have to pay for a month. So if you pay $69 a month, you'll get the second and third month for free. That means your cost would be $23 a month. Okay, so for $23 a month, you can try the software that's been rated #1 in its price category for 30 years in a row. Okay, now we want you to be a part of MetaStock for a long time going forward. And so we're going to do some investment in you if you do that. So what that'll include is that'll include MetaStock 18, include the data for the region of your choice. We also have a program that we call white glove installation support. And this is optional. But if you want to, we'll actually sit one of our technicians down with you. We'll give them a 2-hour block, and they will actually walk you through any questions you have about MetaStock. If you don't have any specific questions, they'll show you around the program and make sure that you're comfortable with it. Okay, and I think that's awesome. I had somebody ask me one time, well, is it hard to install MetaStock? Is that why there's a support rep? No, it's actually really easy to install MetaStock. It's easier than it's been in forever. But like there are a lot of things. It's a toolbox. You're subscribing to a toolbox. And just like any toolbox, if you understand how a screwdriver works, you'll get better use of it than if you don't, right? Except for like, we don't have a screwdriver, we've got a drill, and we've got a power screwdriver. And so we're gonna make sure that you understand as much as possible about how MetaStock can help you. In addition to that, that's not just your only shot with MetaStock. One of the things I like about MetaStock, one of the things that I think is an advantage for MetaStock is our people. If you have a question about MetaStock, you can call us, you can chat in line with us, you can visit us online. But if you have a question about MetaStock, give us you can call our support team and they will take care of you. And one of the things I love about our support team, they're all over here, not today because it's Saturday, but every workday they're here. Everybody that contacts support gets a survey, and there's a lot of weeks where they'll get a perfect 100% satisfaction rating on that survey. So that's awesome. But I do think one of the best things about MetaStock is the people you get, the support. Because if you've ever had software can be frustrating if you don't understand to use it, and it's always nice if you can just call somebody and say, show me how to do this, and they just answer it. Or if you're running into a problem and you need to talk to them, it's really nice if you get somebody that's friendly on the phone that's helpful. That really, and I just think they do a great job. So you get that white glove installation. You'll have unlimited access to support if you need it. We'll also include a training video that's called Unleash Your Power of MetaStock. It's a collection of videos. I think there's about 8 of them. It comes with a workbook. And you can get that and go through it as you're going through your trial. So you can sign up for that. You can give us a call at 800-882-3040. You can visit us online at metastock.com/saleschat. You can also do that at metastock.com/Traders Summit 3-for-1. We'll put all those links in the chat in just a second. So there you go. You can also do that if you're new to MetaStock. You can, of course, do that with the Traders Summit Action Pack. Today, I just feel like we've had such a great collection of speakers. So our bundle package today is the Bigelow's Candle Profit Systems, Steve Primo's Momentum Strategy #4, the AAII Conviction Plus with Ray Rondeau. Adrian Manz is around the horn. He's going to talk in just a second. 3 months of a subscription to learnmetastock.com, which is how we train our sales guys and support guys when they're brand new. It's how we get them up to speed with MetaStock, as well as that Unleash the Power of MetaStock. So you can do that. If you want to try out MetaStock again, or if you want to try out the bundle offer, give us a call, 800-882-3040, metastock.com/saleschat, metastock.com/summit deal. If you don't do anything else, try the 3-month trial. I tell you, there's a reason it's been rated #1 30 years in a row. And if it's something that you don't like, or if you don't feel like it's helpful, you can just cancel. And you'll be out whatever you paid for this subscription. But then you know. Okay. So the risk reward ratio is, I wish I got it on all of my trades. So the Summit deal is amazing too, with the all of the stuff that it offers in there. The discount, normally it's about $4,000. Here today it's $2,344. So metastock.com/summit deal, 800-882-3040, or metastock.com/saleschat. So there you go. I can go ahead and plug in my headphone here. Wow, I'm on time. Well, I'm only on time because I skipped half my presentation at least. But, we're back on time, which is great. So I do want to say thank you to AAII.com for sponsoring. We really are happy with the partnership. Been a great company to work for. And Stocks and Commodities Magazine has been supporting us and helping us with this event since we started doing it 11 years ago. Or I guess it's almost 11 years ago. I think our first one was January, and that'll be 11 years ago in January. So there you go. Thank you again for the support that you've done. So if you're watching us on YouTube, you can go to metastock.com/traders-summit. You can sign up to get a free issue. There's a lot of freebies that are available from all of our presenters today. If you're watching us on YouTube, make sure you go and register for the event so you can sign up and get your free Stocks and Commodities bonus or any of the free offers that are available from any of our speakers today. So there you go. Of course, we're MetaStock. I just got to talking about MetaStock for about 30 minutes or so. So there's the link. You can get that 3-for-1. If you just want to do the 3-for-1, metastock.com/traders-summit 3-for-1. So there you go. All right. Our next presenter is Adrian Manz, and I'm going to slide out of you for just a second. Well, I get this book off of my shelf over here, and then I'm going to slide back into view. So Adrian Manz has been a partner of MetaStock for a number of years. I've got a physical copy of his book that's called Around the Horn. It's right here. You can see it. But it's great. I love this book. It talks about all the patterns that Adrian actually uses in the trading, and he's going to talk about a couple of them today. This is a great book, and Adrian's been a friend of MetaStock for a number of years. He's going to be another great speaker. He always is. So let's go ahead and get you started, Adrian. How are you doing?
Here we go. I'm good. I'm good. How are you?
Good. I can hear you. You're coming through.
All right. Perfect.
Let me go ahead and make you the presenter so you can share your screen. And I'll make sure we can see it. Okay. So I am seeing your GoToWebinar login screen.
Hold on a second.
And now I can see trading by the numbers, strategy, and discipline of the master trader.
There we go. It's nothing without a hiccup, right?
No, I think you're doing fine. I can see it.
And then just.
All right, and we can see you too. Cool. So we can see you, we can hear you, and we can see your screen. So that's my cue to get out of your way. Your turn.
All right. So welcome, everybody. So these are always great events. I think guys at MetaStock do a fantastic job with this thing. I listened to the last couple seconds of Jeff's presentation there. I'm going to tell you, take advantage of the white glove installation thing that they do, because that software is so robust that even after, geez, that must be 20 years now that we've been working with MetaStock, I learn something new every single time that I talk to those guys. So take advantage of it. Today, I'm going to keep going with this sort of trading by the numbers paradigm, and I'm going to do something. So last time that we were here, we talked about trading the triple Qs, and a bunch of you are you're actually getting that live stream that we do every day. You signed up through this event. It's free, right? So it's I didn't put a link up, but I guess Jeff can put a link into the chat. It's just traderinsight.com/live-stream, live-stream. And that's just where we talk about the Qs. And that's what I talked about last time that I was here, was trading the, so I actually trade the NQ, right? So I'm trading the future, but I'm using the triple Q as my trigger event for that. This time I'm going to talk about trading individual stocks. So Julie and I have been trading stocks. Primarily, we traded NYSE listed securities for a long, long time. And then we moved on and started trading NASDAQ stuff as well. That happened when NASDAQ became less of a Wild West kind of a trading place and more of an exchange. So a lot of you guys are probably too young to remember what it was like in the 1990s, the mid 1990s. We, however, remember it well. So that's Julie. When I said Julie, and that's me, of course. You can see me now, much older, but still doing this. And so we started trading long time ago, and the momentum for us to get into trading was that we were both graduate students in the late 1990s, and there's a lot of number crunching that we wanted to do. And you're trying to put together models, and you're trying to develop ideas that are predictive, that have predictive validity, all this stuff, and put together statistical models. And in grad school, we were both working on PhDs in, mine's organizational behavior. Julie is social psychology, so the same realm. And what we were looking at as we were doing these things was, is market behavior predictable, right? So as an organization, as a social psychologist, what can you say about the way that people behave in the world of finance? So there's this whole realm of behavioral finance that we got involved in. And one of the things that we did was went down to the New York Stock Exchange quite a bit and worked sort of one-on-one trying to figure out, what is it that makes this guy tick? What is it that makes it? Because remember, the NYSE at that time especially was a marketplace where it was one specialist in charge for a particular stock. So if you were trading Harley Davidson, if you were trading GM, if you were trading Ford, you're always on the other side of the table from this one guy. And it didn't have to be an adversarial relationship. What you really wanted it to be was something that was mutually beneficial. And the way that we came around to doing that was you have to understand the personality of every stock. So we spent a lot of time down there. We had a little Trader Insight Day down there about a year ago, and we've been back and forth to the exchange probably 20 times, 30 times over the years, and we love it, right? So we still love it down there. Very different place today than it was when we started, but still something that we really cherish as part of our past, is that we were able to go through, do all these multivariate statistics and figure out sort of, how it is that you handicap what's happening in the market, how it is that you go find pockets of order flow, and then take those pockets of order flow and structure your trading around them so that you're cooperating with the market, you're not trying to beat it. Now, I've got to give you the shameless plug, although it's been pushed off into next year. In 2024 now, because of the writer's strike, we've got a weekly television show called Trader Nation that we do. It does a psychology deep dive. So we're both psychologists, right? So I've got an MBA in international business and finance, and I've got a PhD in psychology. And Julie has a master's degree as well, and it's in public policy, and she's got a PhD in psychology. So what really fascinates us about trading in general, right, and about trader education stuff that we do is all the people who are involved. So you can't really see it very well there, the giant backlit screen that we're in front of for our show. Those are all faces, right? The whole Trader Nation thing is about all these different human beings and the different psychologies that go into making a market in securities. And we go through and, we talk to top traders, try to talk to them about their psychology. What is it that makes them tick? How did they overcome things? I'm going to talk about that a lot today. Sort of the things that you need to get in tune with in your trading, right? Because the war is not with the market. The war is between your ears, and it's the things that make you tick that make you succeed or fail when you're trading. And we talk to people who do alternative investments and sort of, what's their psychology. We talk market strategy. What's it take to put together a strategy that's going to fit your psychology? And then we also have a segment called America Asks. You are free to submit something for that even now. You just take a video on your iPhone and send it off to us, with a question about the markets or a question about how to handle something that you're going through with the markets. And then we will answer it live. And if we answer your question, of course, you get a coffee cup or something. But we spend a lot of time down there. So we live in Pacific Palisades, California. So we're all the way out as far into the west as we can possibly be, right, without falling into the water. But we love getting back to New York. We love taking our son Connor with us on all these things. The thing that trading has done for us is made our life flexible enough that we can sort of semi-homeschool him. He goes 2 days a week. He goes to a school and does project-based learning, and the rest of the time we travel. We travel as much as we can. Love traveling. We've been all over the world with him 6-7 times. When we get there, we trade, and we try to get speaking gigs and speak for the exchanges and things. But the big thing is, once we are where we are, we can settle in for a couple of weeks and we can trade the markets. That's the life that we were after when we started doing this. We also publish. It's been a while since I've done magazine articles or journal articles, but I enjoy doing them. This is part of what we were trained to do. People always ask questions like, well, if you're trading, then why are you speaking, or why are you teaching, or why are you? Well, it's because that's what trading did. It gave me the freedom to do what I really wanted to do. The reason I went and got a PhD was I want to be able to talk to people. I want to be able to educate people, and I want to write, and I want to get my ideas out there in front of people. And it's really been a great vehicle for that. So you can find lots of stuff that we've done over the years in financial publications. I've also, as Jeff pointed out, I've done some books, quite a few books actually. And the one that it all keys off of, it's not in print right now. It'll be back in print later this year, a revised edition. We're up to sixth edition of that. Is Around the Horn, a Trader's Guide to Consistently Scoring in the Markets. So that's the one that MetaStock has a great plugin for. And I'll tell you that there's a lot of companies over the years that licensed those patterns for scanners and things that they did. And what I will say for sure is the only one that I'll use myself, and the only one that I would ever recommend to anyone else at this point, is the MetaStock scanner, because it is just dead on accurate in picking up those patterns. So those patterns were originally, the whole book was originally called A Multivariate Analysis of Covariance in the United States Equities Markets, which, as you can imagine, my publisher said no. And he just said it's not gonna be a book that sells. It's not gonna be a book that interests people. They don't want a book that's real heavy on statistics. They want a book that gives them ideas. We took the whole thing and wrote it around the analogy of baseball. So you can't see them, right? I've got 50 signed baseballs over here. We're big Dodgers fans, always have been, and we took the ideas that we used in our trading. This is back in 1997, and really nothing's changed. We still use all those core patterns in what we're doing today. This all goes back to the stuff that we did when we were analyzing data that we were receiving from from the exchanges, and it just takes it and makes it easier to understand. So fast vol is an expansion of range and volume, and it goes and it looks at the idea of range expansion, if you will, in the markets against the backdrop of the covariates, the other things that are happening in the markets. Is there news? Is there, is there something driving the markets? Is the sector in rotation, right? The whole book sort of works around the idea of markets are cyclical, and you have to be in touch with the cyclicality in order to understand what's going on. So you have the big picture that you have to look at. You have the psychology component you have to look at, right? Every trip to the plate. The reason it's baseball and not football is, every trip to the plate has to be a fresh start. So you can't think about the last time, the time you struck out. You can't think about the time you hit the home run. You just have to walk up, no good days, no bad days, just days, swing at the ball. And, the other books that are up there are different. So Trade Secrets is really it takes one of the strategies in that book and develops it then across multiple time frames, because Around the Horn was really written with the idea of you do your analysis the way that MetaStock does it is exactly right. You go and you do your analyses on daily charts. You can change the time compression. You can go in MetaStock and do weekly charts and do bigger swing trades. But the way that I use it is daily charts for intraday trades. Those are like intraday swing trades. And then in Trade Secrets, I just got tired of people saying, well, I'm not a day trader and I don't understand, why you're focusing on intraday trading. In Trade Secrets, I took it and I just said, here's a way to take one of the patterns, move it into multiple time frames, now do it with all the other patterns. So those are the ideas that we developed. The other ones are international versions of, that's Harriman House publishes those ones on the right over there, Beat the Street, and the other Trade Secrets version, and then World Cup Trading is the Italian version of Around the Horn. We also do a lot of teaching. I love teaching. We don't do as much of it anymore as we used to. We have the online components for all of the live education that we do. We love doing the live education. We do it small group. It's very small group stuff. It's based on I'll only work with enough people over the course of a year so that I can work with them one-on-one as time goes on, right? So when we do this, for instance, this income trading boot camp that we've been doing for, well, I think we're on number 20. I think it's been 10 years now, 11 years, 12 years, I guess, that we've been doing those. And we do one a year or two a year. For a while, we were doing them twice, and that was before COVID, of course. And now we're sort of slowed down to, we'll take 20 people and we work with them. And it's geared towards adult learning. So it's as if you're working with two college professors, oddly enough, right, who happen to be professional traders and have never held a job outside of the world of trading, which, was much to the horror of our parents. But we took what we learned and we applied it to the markets. And now we take what we've applied to the markets and we help other people to learn it. So it's a year-long program. People come to us. You look around that table there. The fascinating thing is, so you can see me there in the black shirt on the end. The guy I'm talking to, okay, he was a medical equipment engineer, and then you go right around the table there, and you've got a guy who's a cop. You've got a guy who was a real estate developer. In the group up top there, you've got a guy who's 80-something years old. He was a pilot, and you have a fellow who was an engineer, lots of engineers. We've got lawyers, we've got farmers, we've got people from all walks of life. And the thing that has fascinated us about all of it is they're all smart people, and they all come into this with the expectation that they're going to succeed. And they're basing that expectation usually on the fact that they've succeeded in something else. And we tell them when they come in to work with us, and probably never worked with most or any of you. I'll probably never meet most of you guys, but what I would say to you in just the context of what this trading stuff is all about is you've got to get to know yourself and understand your relationship with a bunch of different components of yourself before you're going to be able to succeed in trading. Because it's not just about pushing a button. It's not just about analyzing the market, finding a pattern, and then firing off a trade. It's about understanding how you're going to handle the trade and what handling the trade is going to do to your psychology. So we'll talk about that in a minute here. But let me get into some of the strategy stuff, and just say that most of what we do is pretty simple. And as I said, we've been doing it for 27 years the same way. And it's been great for us. We're in here every day trading. We run our office. We've worked on hedge funds. I'm working on a hedge fund now. But ultimately, what we see in ourselves and in everybody we work with is there's some stuff that you have to overcome. So when you're putting together a trading strategy, you have to ask yourself, like, how many times do I fail to pull the trigger when a setup is right in front of me? There's no end to this, right? So every day, a bunch of you are on my live stream, and here you go. This is free information, right? And you guys show up, and we've got hundreds of people who tune into that thing every day. And I'm saying, here's where I'm going to enter these triple Qs or the NQs today. This is where I'm going to get into my position. And I'm long or I'm short. Here's the rationale. Here's everything that overlaps. Here's all the reasons that I'm going to take this trade. And when it hits this level, count on it, I'm getting in. And then later I'll talk to people and they'll say, well, it did exactly what you said it was going to do. And I'll say, how'd you do with it? And they say, well, I didn't take the trade. Okay, well, why didn't you take it, right? This is one of these things that you have to get in front of with your own psychology is when something comes in and your first opportunity is, generally speaking, going to be the best opportunity, right? So if you're going to take that trade, you should be taking it the first time that it triggers, not the second time, not the third time. Those aren't your first entries. First entry is the best. Second entry is usually pretty good. Third entry is generally speaking a dud. And when I talk to these guys, what they'll say is, well, I did what you said not to do. The first one hit, it went to the target. Oh, geez, went without me. Look at this, I didn't take it. The second one goes, I got into it late, right? So now your risk reward ratio is out of whack. You have a late entry. Now the spot that I would be getting out at break even would be a spot for you to get out at a stop loss, right? So now you're just hoping that it goes and hits the target. Now you made a little bit of money on the second one. Well, the third one, I'm going to take that for sure. And the third test of those levels winds up being the one that fails. And now when something else sets up, what you're reminded of, right? You don't step up and say, I don't care what happened the last time, right? It's all about, did I knock the cover off the ball? Did I strike out? That's the thing it's called the recency effect in psychology. Remember this last thing that happened to you, it happened to you. It doesn't feel like something that happened because of something you did. It feels like it's something that happened to you. So you miss out on that next trade. Same thing happens when people let losers run or they cut winners short. So a lot of what goes on here is it feels really good to win. It feels really bad to lose. We're a sports-driven, look at the, around the horn. We are sort of a sports-driven culture. And whether you're playing golf or you're playing football or baseball or whatever, it's really been a case of if you win, it's a good outcome. If you lose, it's a bad outcome. I try to tell people, use whether or not you traded according to the parameters of your trading plan, use that as your measure of success. Don't look at made money, lost money. Look at, did I do it right? And when people let losing trades run, it's always for the same reason. It's, well, it's going against me, but now I see this other level down here. And, maybe this level will be support. And if that's support, then it'll bounce. And if it bounces, then, I'll get out at break even. And then it gets to break even. And they say, well, I don't want to lose money on this deal. So let's see if we can get 40 cents out of it. Let's see if we can get 50 cents out of it. Because 50 cents is a lot of money on 1,000 shares. And what'll inevitably happen is, it'll turn around and it'll wind up, going even beyond where they should have stopped out the first time. So then what they do is, I've got nothing but experiences with people who will tell me they got out of one of those Q trades, for example. They took them on the triple Qs, not on the futures. They got out with a 10-cent gain, a 15-cent gain, a 20-cent gain. Well, why'd you do that? Well, because, I wanted to book a winner. And I'll say, but it went 70 cents, and the trade that you lost money on you know, that one went 40 cents against you. So now if you're only taking 10 on the winners and you're taking 40 cents on the losers, you know, you've got a business plan that's not going to be sustainable, not going to be viable in the long haul. And that's hard stuff to get over psychologically. And it's just something you have to get in touch with. And, you know, there's other things here, you know, morning profits, afternoon losses. I'll say that comes from sort of the gambler's fallacy. We've got lots of guys who have a predilection to gamble. And, you know, we've worked with them over the years. And I just always tell them the same thing. You know, if you're going to gamble, go to Vegas. You know, at least you get some free drinks while you're there. But if you make money in the morning and then you look at that as house money in the afternoon, then I can already guarantee you that what's going to happen is you're not going to follow your plan, and your psychology is going to start wrapping around this idea of, you know, this is money that, you know, has no impact on my account. If you're a gambler, right, this is money that, you know, it's here for me to, I'm gonna really put it all out there and see if I can, you know, hit the home run. It's not a good way to trade. And it really puts you in a weird position going forward. The other thing is, you know, reducing position size after losses. This is something that I see with a lot of traders, especially, you know, guys who really sort of haven't assessed what their relationship with money is. And, you know, they'll lose money on a trade. And then what it boils down to is they have this feeling of they know what they could have done with that money, or they know how hard they worked for that money. And that's all okay. But if it makes you take your strategy and reduce the size because, you know, well, next time I don't want to take a chance that I'm going to lose that much, then what happens is next one comes around, you make money on that trade, and you made far less money than you would have made. So the next time around, you jack the share size up again, and you wind up losing even more, right? Because it's just, you know, winning trade, losing trade, winning trade, losing trade. There's no rhyme or reason sometimes to the order that they come to you in. And when you break your discipline because of losses, or you break your discipline because of gains, you put yourself in a position of you know, having a hard time staying in front of the opportunities. So there was an article about me in there was a magazine called SFO a number of years back where they said, you know, Adrian's a trapper. I can't remember the title of the article, but it had trapper in the title. And they said, you know, some traders hunt and other traders trap. Adrian waits for the opportunities to come to him, waits for the setup to come to him. And that's very true then, and it's still very true today. So I've got these different strategies that I trade. I've got 4 sort of core strategies that I trade over the course of the day. And one of them we're going to talk about today. I'm going to show you how, this time, like I said, instead of looking at the broader market, we're going to look at a single stock. We're going to look at Tesla and how I go through and set up that trade, and then how we go and capitalize on the opportunity when it comes to us, as opposed to trying to jump in front of the moving train. And, you know, so I've got these trades that are set up as scalps. I've got trades that are set up as opening gap trades. So we scan for opening gaps. That's an Excel driven spreadsheet there that goes through, and every morning in our first hour trading pit, we've got the guys who went to boot camp. Most of them trade with us over the first hour or so of the day. We evaluate opening gaps based on a statistical model that looks for 2 standard deviation moves in terms of volatility, right? So like Bollinger's stuff, he looks for 2 standard deviations of price. We look for 2 standard deviations in terms of how volatile the stock is on the morning. So we evaluate gaps that way. And then what we do is we go through and we're looking for the probability of a mean reversion. And I've done that here at MetaStock a number of times, so you guys can go through and look at some of their archives, and you'll see that there's a whole hour on just how I trade those opening gaps. Then I've got an algorithmic trade that takes one of those around the horn patterns, that fastball pattern that I told you about, and it goes and applies it to the NASDAQ, and it says, all right, well, you know, what is it about the buying and the selling that created this expansion of range and volume? And, you know, how high is the probability that it's going to go and trigger and get an extension the following day based on institutional trading activity? So I drive those with the MetaStock scanner, and then I refine them with some alternative data feeds that I look at, and, you know, those are set them and forget them. So they're either going to trigger or they're not going to trigger. But again, I'm looking to trap them. I'm not looking to jump in front of momentum or jump onto the momentum. I'm looking for a certain threshold level to get me in. Same thing holds for the around the horn trades, right? So everything around the horn, as I said, I wrote it all around this baseball metaphor. I rewrote it around this baseball metaphor. MetaStock scans for it, goes through, looks for the statistic to be valid, and tries to figure out, where are the entry opportunities. You have to go through with the scans and identify where you're going to put the stops. So it's not a total set it and forget it kind of a scanner, which I think it makes it better, right? It makes it sort of a better thing because you're interacting with it. There's really good, robust explanation. You don't need to buy the book. You can look on the MetaStock site. There's really robust explanations of what each one of the patterns are and how you go through and find intraday support and resistance levels, and then how you go through and define targets based on the daily bars. So everything is there. It's just you have to do a little bit of the work. And then what you do is you refine this thing. So this is my trading plan. If you guys would like access to this, I don't have a special offer on this or anything. You can just send me an email, Adrian, Adrian, @traderinsight.com. And, I can give you 4 weeks of the trading plans. You guys can just look over our shoulders and sort of see how this stuff works. If you're using the MetaStock scanner, it's cool because then what you can do is you scan it in your software and then you go and compare it to the trades that I set up. So if you look at this, like on Friday, we had APH, so Amphenol is APH, CC, the chemicals, and my eyes aren't so good there. I'm looking at the last one. Is that Skechers? Is that, well, anyways, it's, SKX. So you can see that what I've done is I take and I'll look through the list of stocks that I've generated, and then I'll find the ones that I think have the best reward to risk based on where the stop loss is, based on where the target is. And I set those up. So every single day I put together that plan that you see on the right. There's multiple pages. So in this case, there'd be 5 pages of the big sheet, right? The detail sheet that goes through and shows me in the morning. I'm up at 6 o'clock in the morning trading this stuff, right? So I don't want to think too much. So I do my thinking after the market closes. I put together that trading plan. And then on the left there, that's my gouge sheet, right? So if you're an old floor guy, then you always had a gouge sheet with you, right? You knew what it was that there were a lot of these floating around, back 15, 20 years ago on the exchange, because we had, Vandermolen was a client of ours that was a Dutch market making firm and or a Dutch specialist firm. They were a client. I had a bunch of clients who were using these things, and that's where I came up with the gouge sheet, because they said they need it when you can't have this big book of just trades every day. But this is how organized it is, right? So I structure everything so that I'm going to know exactly what's my entry, what's my stop, what's my target. And then 50%, you can see there is the column in yellow. That's 50% of the distance to the target. That's where I have my trading software then go. And so I port my MetaStock analysis into my trading platform, and my trading platform goes and jockeys the stops around, and at 50% to target, we move the stop to break even. And all the data gets then imported into this spreadsheet here. So you can see this is just for the around the horn portion of what we trade. And it goes through and it figures out over the course of the year, how many times did the patterns come up? So how many times did we see a fastball, an infield fly, a line drive, a 3-2 pitch? How many times? That's that first pie up there. The second one is how many times did each of the patterns that came out of our scanning, came out of our analysis, actually trigger? And the reason that I've got the comparison up there is I want to know, as a psychologist and a trader, I want to know, did I introduce selection bias into my trading? Like, did I pick a lot of fastball setups just because I like trading that expansion of range and volume pattern? Most people, that's going to be their favorite. I'll tell you right now, they come to boot camp, they're all excited because they're making a bunch of money with the fastball. The important thing is not whether or not it's making money. The important thing is, are you skewing the way that you're looking at the market in a way that you're only looking for one thing and you're ignoring the cyclicality of the market? So that triggered pattern distribution there, that tells me, right, did I introduce selection bias? And I just want those two pies to look relatively similar, right? As long as things there are similar, then I know that things are playing out as per the market, rather as per what I think I should be seeing in the market. Same thing with the long to shorts, right? You want to look at your long to short skew. How many times am I picking long trades? How many times am I picking short trades? Look at the long to short profitability. Are the lion's share, like here on this one, the lion's share of the profits are on the long side, but there were actually more short setups. That's more of an indication to me of what's coming, right? So there's more short setups, but I'm getting more triggers on the longs. Well, and I've got more winners on the longs, and I can see, where's my pattern profitability coming from? And when I put all these pieces of the puzzle together, it sort of tells me where's my head and what's coming in the next months or in the next year, right? So that's last year. And now, whoa, look at this year, right? We had that skew in the long to short for last year, but fewer triggers on the short side. But it told me ahead of time, there's a very high probability, right, that we're going to get a lot of short side action, that the markets are starting to rotate, that we're starting to get this cyclical move, cyclical dynamic in the markets, and that once that happens, we're likely then to see those shorts pop up. So all of this is to say, analyze the heck out of your data, but make sure you put yourself in front of the potential for profit. So this is all about strategy, discipline, and psychology, and the way that these things interact. I'll talk through these things quickly here because I'm going to run short on time, I think, and then we'll get right into the strategies. But what I want you to know is all those trading plans that I showed you, that's stuff I'm doing every day. And the way that I get in front of those things every day is Julie and I we work together, right? And I am blessed to have the person by my side that I do, because we never argue about this stuff. It's a very collaborative office here. The two of us, we don't, they wanted to do a reality show about us at one point, and they were watching us, and they said, man, you're moving all this money around and stuff. Does it ever get hot in here? Does she ever go nuts and hit you, or, you get crazy and start yelling and screaming? No, it's not really like that. We've got things compartmentalized. We've got things structured in a way that I think you have to do it if you're going to keep your sanity as a trader. So what I know is I can divide my day into these 4 parts. The first 3 are going to be the most active in terms of, where's stuff going on. So in the pre-market, I'm loading up those program trades. I'm loading up the ALGs. I've got those around the horn New York Stock Exchange based trades that I need to get entered into my software. When I'm putting out a lot of conditional orders, I'm putting out a lot of bracket orders. I'm building orders out that are going to take care of themselves at the opening bell. At the opening bell, I shift my strategy. Right now, I'm looking at those of you who are here and are boot camp alumni. The first thing that we do in the morning generally is look at Apple. So for the first 5 minutes, we've got a whole methodology that's based around what's going on in the options markets and sort of what the options market makers are doing to, sort of hedge their bets before the open and after the open, right? And we go and we structure an opening trade in Apple that's got a huge positive expectancy, and it's got a return, that generally speaking is just very, very consistent over time. It's that's like a 4 out of 5 kind of a trade, but it's a trade that I need total focus for right at the open. At the 5-minute mark, I shift over to those 2 standard deviation opening gaps, right? That Baltimore chop trade, I called it, but it's, everybody tells me I should have called it Manz, but I don't like the sound of it. So we go and we do those opening gaps. That takes us through the end of the first half hour. I take a break, come back after the first hour. I look at what's going on with those triple Qs. That's where you guys get the live stream from me every day, right? If you're hopping on, I see a lot of you are watching it on the replay. Don't watch the replay. That's 10 minutes late. Just go and click onto the live stream. It's on your phone. That's where you should be getting the alerts. Just make sure that if you opted into that thing that you replied yes when the first text came out so that you keep getting them. And then come in and see it, and you'll see exactly what it is that I'm going to do over the course of the next couple hours on those triple Qs and the NQ. So, you know, if you are looking at your workflow, as I said, you get strategy, discipline, psychology. And your strategy, you know, for me, my strategies are all about automated opening continuation trades, that 2SD trade, super cap, volatility band trades. This is where we're going to get, number 3 is what we're going to focus on today. The discipline, you know, you need to plan the trade, get precise entries based on the prior price action. Don't go in there and shoot from the hip ever, is what I would tell you. You know, you need to have even our volatility-based trades, our scalp trades. I mean, those things are all planned out ahead of time. We're always waiting for price to come to us. We're never chasing. And this gives you the logic, right, to get in front of these trades with confidence. You've got the courage of your convictions. You've got logical stops. You've got logical targets. Everything is based on support and resistance and on prior key inflections. So you know what happened last time. What's the best predictor of human behavior? Prior behavior. Right? Whatever somebody did last is going to be the best indication of what they're going to do. You guys know this. If you've ever tried to change something about yourself, change something about your kid, whatever it is, the most likely thing that's going to happen next time around is what happened before. Markets are driven by human beings. Even programmed logic is programmed by human beings. So if you go through and you base everything on the logic of what's been happening in the markets rather than your gut feeling is always going to betray you. Even 27 years later, I'll tell you, I've never had a good trade based on what my gut told me to do. Go through, follow the logic, have objective money management rules. It's not about how much you're willing to lose or how much you want to make, right? Market doesn't care how much you want to make or what you're willing to lose. Never going to matter. It's all about, are you putting things in the places that logic is telling you to put it? And then, right, plan the trade, trade the plan. Enter only at the planned level. If you miss it, you miss it. Don't chase. If you didn't take it, ask yourself why you didn't take it. And make sure that you put together orders that control what's going to happen. Put that order structure out there in a way that's going to control slippage and is going to get you in exactly where you want to get in and out exactly where you want to get out. Don't play the blame game, right? Because there's a lot of coulda, woulda, shoulda that goes on with the guys we work with. And I'm going to tell you, automate as much as you can. Take yourself out of the equation so that you know that everything that you did was based on the trading plan that you had in front of you. All right. And then your psychology, this is where, you know, things tend to get away from people because it's not the case now as much as it was, you know, back 20 years ago. So when we started teaching, so you guys and I speak a lot at live events and big live events and things that, and I talk about psychology and people roll their eyes. Today, when we get invited to speak somewhere, hey, could you do a 4-hour presentation and could you do like an hour and a half of that at least on the psychology of trading? And we're, you know, where's this coming from? Well, all of a sudden people are much more in touch with how much their personal psychology is affecting what they're doing when they get into these trades. Think about it, your relationship with money. Right? So Julie and I didn't grow up rich. You know, we knew our parents worked really hard, and you know, we went to Claremont. We went to a very expensive graduate school. We went to expensive undergrad. A lot of student loans. We were paying for that stuff, and it puts you in a position of every time you do something, you think about, well, you know, what else could I do with that money, or how hard did I know just how hard my dad worked for that money? I know the value of a buck, right? And that stuff gets into your head. Or you could be a gambler, right? We've got guys, like I said, who work with us who are just, they're hardcore, man. They'll go to Vegas and 20, 30,000 bucks down the drain doesn't bother them at all. You need to evaluate that, right? You need to ask yourself, what's money really mean to you? And then try to figure out how to get that out of your trading so your trading can stay totally rational. How about, you know, your ability to follow through? Do you follow through on your plan? So if you go, again, it's not really easy to navigate to. So if you send us an email, this time send the email to julie@traderinsight.com. Tell her you want to take the psych inventories that we have. They're free. And they just give you immediate feedback on what it is that makes you suitable or not suitable for trading, just at the surface, right? You can always change these things. One of them is your follow through, right? How much do you finish the things that you say you're going to finish, right? The things that you start. How much time do you spend actually on the task versus, you know, how easy is it for you just to, you know, I'm sick of this, and you walk away from it. What's your comfort with risk? So there's going to be risk in every single trade you ever take. Excuse me. Always going to be risk. And you have to figure out, you know, if when things get out there, you immediately get so uncomfortable that you're just trying to figure out an exit strategy, right? How am I going to get out of this thing? You know, I'm just going to get out of break even because it's going a couple pennies against. Well, this is something you have to think about, and you again have to bring into your trading business and say, I've got to mitigate my psychology. I have to work to take my risk tolerance, let's say, out of this equation and just go and focus on the equation, focus on the math. Your ability to deal with boredom. This is a big one, right? So how do you deal with it when are you firing off trades all day long because you can, or because you're tired of sitting there staring at a screen? It goes back to morning profits, afternoon losses, right? We see a lot of guys who just, by the time the end of the day rolls around, they've had 300 trades. And we'll say, how's that even possible? Because I had 4 or I had 5, and you're supposed to be trading the same trading plans that I am. Well, you know, I got tired of just sitting there, and, you know, I just wanted to see, I wanted to try something. I want to try this. I want to try that. Big part of the day, best use of your hands is as a deep fisher. So this strategy here that I'm going to talk about is, you know, it's easy to talk about. It's sort of in a 15 minutes or so. It goes and identifies institutional order flow, and that identification is going to be done by you. So you're going to go through and look at a chart and figure out, where are the institutions buyers, where are they sellers? And, you know, most trading now is done by institutions. Most of it is done by machines. The machines are just going through and doing what people tell them to do. So when they're programming this stuff up, what are they looking for? What are you looking for? And how do you go and capitalize on those footprints that you see, right? The footprints of money as it moves through the market. So you're going to identify where the order flow was yesterday. You're going to find the trend, figure out, am I looking at something that's generally trending up? Am I looking at something that's trending down? I heard Jeff talking about that earlier, right? It's important to be able to identify trend. And I think it's very important to be able to just look at a chart and eyeball it and say, you know, here's what's happening right now. And once you've found where you think the institutional order flow sits, and you've identified which direction that order flow is trending, where does it favor an entry on the long side, where does it favor an entry on the short side, if you can find the confluence over the course of the day between those things, between support and resistance, trend, volume weighted average prices, anchored volume weighted average prices, you know, tick by tick order flow, right? All these things come together to tell you, here's the place that you have the best opportunity for an entry. And when you find those, what you're going to do is you plan each and every entry, each and every exit. And if you want to be a successful trader, I'm just going to tell you, I know there's people who think they can just find, I've never met anybody, not a floor trader, not a pit trader, not anybody who could just sit there and fire them up. They have to plan where they're going to get in, where they're going to get out in order to be successful. So you want to make sure that once your strategy's in place, you can stay disciplined about it. Go through, confirm all of the opportunities. Make sure that you double check and triple check where you think those levels should be, because the next day you're not going to reevaluate it. Go through, set up conditional orders, set up, as you know, the bracket orders. Make sure that everything is set up to go off exactly the way that you want it to go off. You don't have anybody to blame afterwards. The only thing you're looking at is, did my plan happen? Did the entry threshold come around? And did my orders go off the way that I programmed them to go off? That's your measure of success. When a trade's within allowable slippage, we enter, right? I tell guys, don't do market orders, right? You want to set up marketable limit orders. You know, even though Stop limits aren't really an order on the exchange anymore. There's still an order that's available in every piece of software that I know of. You want to go through, set the stop threshold for your activation threshold for the exact entry price you want. Set the limit for the worst possible price you're willing to accept. Right, that little spread there is where your order is a marketable limit order. You've limited the range that you can be executed in. And if it goes without you, it goes without you. But what you haven't done is put a big slip in, and then later you wind up looking at, oh my God, I slipped 40 cents on something, I slipped 30 cents on something. You don't want to be in that position. You want to be able to have a real objective view of here's where I'm getting in, here's where I'm getting out. And the other thing is set those orders up so that you're not catching a falling knife. You want to make sure that if you've got a conditional order set up, and price is coming, let's say it's a long, and price is coming down to your long entry price, well, then set the condition up so that it says, if last price is less than my long entry price, and you can use 8 cents, 10 cents, whatever, Julie and I use 12 because we're artifacts of when the market's traded in eighths and quarters, right? But whatever you're comfortable with, if it gets to that threshold level, then buy stop limit if I get back up through my long entry. So here's an example in Tesla of how I put one of these plans together. So what you're looking at is Thursday's trading data. And you go through and you mark up your chart. It's really this simple, right? You want to look at places. Where did I see that there was a fair amount of volume? Where did I see that there was a fair amount of support? Where do I see a fair amount of resistance? Look for tops, bottoms, highs, lows, right? Where all that stuff sort of clusters together. And then just draw lines. Because those are the places, when you see multiple inflections at the same price level, those are the places that institutions have orders resting. And given any random day of the week, I'm going to say the best opportunities for profits then come when price gets back into those levels. So everybody can see, right, sort of what I'm boxing up here. So I'm trying to find the places, the market, I call it the markets in the box, right? So when you're looking at those daily live streams that we do, and I talk about, QQQs are in the box, that just means they're trading in one of these ranges that we've identified. So you identify it, and this is intraday on a 5-minute chart that I'm looking at these. So that's my setup day. I plot them. Right? You can see here the logic for each one of these lines. What I do next is I transfer that stuff. Lo and behold, Adrian's got a trading plan, right, for Friday, where I go and I exactly plan what each one of my entries is going to be. Here's my entry. Here's my first target. Here's my alternate entry. Here's the target. Here's my next alternate entry. Here's my next target. That's all based on where those levels of support and resistance were on the chart. Then the next day, right, in this case Friday, I'm going to get into these positions based on price coming into those ranges in proper order, and in the right direction is all I'm saying. So it's coming from the right direction. So I'm looking at a short, as you saw in the plan, and I tell my guys, don't enter, when price is just bombing into one of those levels. You don't want to enter on that giant swing from the highs, because you're almost always going to get an inflection there. Because look at what happened the day before. So the day before, if you look back on that chart, just 6-7 bars to the left of the red line, you can see that was a place that price was bouncing, but it ultimately broke through that level. So, my criteria is, well, I want to see it come down from way up above there, come down, dip that line, move back to the upside, and then make the move lower. And when that happens, I've got what I consider to be a very logical entry, because I got in after, see that reversal there. So it came in, it tested the level that I was looking at, and then it reversed higher again. And then the next thing you know, right, I'm moving back down through that range. And, if you think that this and this are, doesn't represent a major position, right? Let's take a look back at, our trading plan. look at how much that's a $2.50 move we're capitalizing on, and we're not just doing it once, right? We've got our first entry that gets us all the way down to that target line. Then we have a move back up above, and we have another entry, right, that gets us down. So you're actually compounding it. You turn this into, it's going to be $3 a share on the trade, and you do it by waiting for price to come to you. You're never chasing. If you miss the first one, the second one was your opportunity. So, you missed that first entry and holy cow, it went without me. Well, then it goes and it inflects again, comes up, dips the line, as I say, stays shy of the line above, comes back down again, and gives you all that profit potential to the downside. So, that's that trade in a nutshell, right? So here's the psychology of it. Look at it. Can you do it? Right? Is this something that you've got the patience to do? Or when that first, 45 minutes, almost an hour, over an hour of trading go by, and you didn't have an entry opportunity, are you already not looking at this? Are you looking at something else because, this is boring me. I need to find something to do here. I need to make some, I'm at work, I need to make some money. Not how the markets work, right? The markets work by, you're going to make money if you're patient. You're going to make money if you've got a logic that works. You're not going to make money if you try to force it. And if you don't know that the best use for your hands sometimes is a seat cushion, you're gonna have a lot of trouble trading. But look at that pattern. You caught it at the beginning of the day, and then look at the end of the day. It happens again. So you got way up above, and then it came back down through, and you were able to capitalize on that entire move again. So on a day where Tesla had $5 a range, $6 a range, you actually managed to capitalize on all that range without being exposed to all the risk. You're in the market, your exposure to the market is relatively limited over the course of the day. So that's, I'll take questions here in a second. We did the, some of you from the last MetaStock thing showed up at the Las Vegas event. That one was sold out. That was the QQQ, the Super Vol Sunday event that we did. If you happen to be in Orlando, I know not everybody's going to be able to be in Orlando. We're going to be in Orlando on October 28th, right ahead of the Traders Expo down there. And we're going to do another one of these. The first one was sold out. We only have space at these for 20 people, and it's fun. So it's a full day event, and you'll have access to all the recordings of the live stream that we did from the Las Vegas thing ahead of time. If you want to join us, you can go check out, what it's all about there, traderinsight.com/Orlando. And the other thing is, like I said, if you want access to everything that we do for the next month or so, send an email to Adrian@traderinsight.com. I'll just hook you up. I'll give you like a full-on open house of the site. And if any of you have questions about what we talked about today, you can also shoot me a text, just 310-804-2248, and let me know. And then it's easiest just to do that on a phone call. I'm happy to talk to people about what I talk about. I really miss being just live everywhere with people. I like doing events with a ton of people in the room and see the faces and see whether or not it's resonating with people or not, making sense. All right, so that's it for me for today. Jeffrey, are there questions?
We do have one question that just came in from Murray Spaceho. He wants to know, how can a trader become profitable?
I'm going to say that it is, fully within the realm of possibility to be profitable. What you have to focus on is, number one, knowing yourself, right? Knowing your psychology and understanding, first off, if you're not profitable now, why are you not profitable? Is it something that, are you latching on to, one of the, I get these emails all the time, say, I made 1,000% in the market last year. My response is always, no, you didn't, right? Because I just know it. Maybe you made 1,000% on one options trade, but it's not, you have to separate yourself from the noise and say, just because I see a bunch of stuff that says 1,000% profits are out there to grab, that's marketing. It doesn't mean there's a reality based in that. The reality is trading is hard work, right? Everything I showed you is stuff you have to focus a lot of attention on and be very, very definitive in how you go and deploy what you're doing. Once you know you're in front of a strategy that works, you got to take your psychology and just say, can I do this? Does this make me a psychological train wreck every day? Do I get really nervous every time I look at this stuff? I had a guy tell me, before the market opens, he throws up every day. I said, you're in the wrong business. I don't care how much money you could make. If it makes you that nervous, you're in the wrong place. So just make sure that your psychology lines up with what it is you're trying to do.
Sounds like he's also taken too large of positions. Herbert wants to know. Yeah. It should be boring, I think. My opinion. Herbert wants to know, do you use options in your trading?
So I don't personally trade options. I have a lot of clients who trade options. Julie is actually affiliated with an options block trading firm in Chicago. I'm not an options trader primarily because intraday, the spreads, when volatility is high, volatility tends to become expensive. And a lot of the stuff that I trade is focusing on, you want to capture the volatility. You want to hop on board the volatility. So I do futures and I do equities, and I do have a lot of my guys do options, right? A lot of the traders that who we train will take these strategies and apply options to them. They're doing spreads. They're doing, a lot of them are just doing straight calls and puts on these things, and they do well, but it's not, figuring out the options ladder over the course of the day is not, that's not my forte.
Phil, I think we got time for just maybe two quick ones. Okay. For scanning, do you recommend end of day or real-time data? They will work with both, Philip, but I think some of them are specifically designed for real-time and some of them are specifically designed for DC. So I'm going to let Adrian take that one a little bit.
Yeah, if you're using the MetaStock scanner, then what I would say is it's good in any time frame that you're going to scan for. So if you want to scan on, you're doing big picture swing trades, and you're just going to knock out the time compression on the scanner, right? So you're going to look at, let's say, weekly charts, or you can use daily charts to set up swing trades too, right? If you want to find opportunities intraday, then you're going to need a real-time data feed. So like, let's say you're looking for pullbacks, because it does a real good job of identifying the fib ratio pullback that I call a switch hitter, right? If you want to find that intraday, you're going to need live data, because you're going to need to get in front of that opportunity pretty quickly. And if it's delayed a few minutes, it's not going to put you there.
William wants to know, do you trade the VIX?
I don't trade the VIX directly, but I trade based on VIX levels. So when the VIX is very extended, right? We've got strategies that that I teach these guys at the boot camp, where you're always looking at what's the VIX doing, how high is the VIX, right? What's my position sizing based on where the VIX is trading right now? Am I favoring long or short, right? How much fear does the VIX appear to be indicating in the market, and how sustained is that VIX level? So I do and I don't. Right? Like I said, I don't go and directly trade the instrument, but I use. I've got the VIX up on the top monitor over there all day, every day.
Okay, and then let's see. What calculation is used for two standard deviations?
So two standard deviations are very standard calculation. So what we're doing there is I'm using a 10-day look back period on volatility. And you don't have to, we used to use the implied volatility of the front month contract for every stock on the exchange. You can actually use true range as a proxy for volatility. So if you take the last 10 days true range, right, and plug that into the formula, into your 2SD formula. 2SD formula is just a very simple formula, right? You just, I'm not going to do it. It's the square root of the quantity X minus X bar squared divided by N minus 1. That's your formula. So now you can go back and listen to this a million times to figure it out. Multiply that by 2, and that gives you 2 standard deviations, right? That square root gives you 1 standard deviation. Multiply it by 2 standard deviations. Add that to your average true range for the stock, and that tells you if you gap by more than that value, you've got a 2 standard deviation move that has a 95% probability of a mean reversion. Ask Jeff. They've got it on the site somewhere, right? I've done whole sessions on that for MetaStock. There's whole videos, and if you can't find it, let me know. I've got a short course on it that I can set you up with for free. You just watch it.
All right. I know I threatened this 2 times ago, and maybe 3 or 4 questions ago, but this is the last question.
Okay.
Just because we're running out of time. But I like this one, and so I was going to sneak it in.
Okay.
If you were to give your advice to your younger self as a trader, what would it be giving your experience? That might be the new question of the day, Mario.
That's a pretty good one. I would say don't let it get in your head. This idea of there's no good days, no bad days, just days would be the don't let the fact that you had a big loser today or you had a couple losing days in a row cause you to go back and reevaluate everything that you're doing. Look at the big picture, right? Look at the gestalt of everything it is that you do and focus on that, and don't lose sleep over what it is you're doing. Because when we started doing this, there was a lot of just tension and nervousness and, boy, are we doing the right thing here? Is this and 27 years later, I can tell you, it's just, people come in and they're like, do you guys ever get emotional about this? And like Jeff said before, we're like, no, you just have to let it get boring. When it's boring, it's good.
So mine would be, my advice to my younger self is don't take that 3rd taser trade.
Yeah.
Easy. All right, Adrian, I really appreciate you coming in. Thanks for sharing some time with us. TraderInsight.com/Orlando. Thank you.
All right. See you soon.
All right. I'm going to do this. All right. We'll just, and so, we're kind of transitioning over for the recording. We've had a lot of people ask about the replay. And that makes me happy because it makes me know that you're enjoying this session enough to want to watch it again. So if you're watching on YouTube, just save the link. It's going to be available on YouTube forever. The vast majority of all of our replays are done after the event's over. So if you're watching on GoToWebinar like you are, Mario, an hour after we close up the session today, GoToWebinar will send you an email that will give you the link to the YouTube replay. So again, it's available. It'll be available. We have no plans on taking it down, and you can watch it as much as you want. So there you go. Thank you for that question. We do have these strategies are part of the Around the Horn. They're part of that book that I showed earlier. They're all coded into MetaStock. So you got fastball, you got line drive, you got backdoor slider, the double hitter, the infield fly, the 3-2 pitch, and then the switch hitter. All of those are kind of scans that you can run with MetaStock based on Adrian's strategies. And I ran a scan. We're not going to spend a lot of time on this just because we're going to move into the next presentation a little bit late. We're chronically late here, though, so it's okay, Melissa, if you also run late. But I just wanted to show you, this is a scan that we just ran in. This is for the fastball pattern. What you've got here is some really good sell signals. This is Zion Bank Corp. And right now, you're just getting a couple of back-to-back, what they call around the horn fastball scans. So we're not recommending that you buy this, but if you were to run this scan Friday afternoon or over the weekend and you can see this, and you read the commentary, it's going to say that the fastball pattern indicates a possible long entry. If you're interested in taking advantage of this trade, you should look to buy Zion at 27.93 or higher. Okay. If you're interested in taking advantage of this, you should put a stop in at a key level. You should also look to take profits in this position at a key resistance area. Generally, with this pattern, you should look for a stop on a smaller time frame and then a time frame that generates a pattern signal. Additional money management techniques can be found in the book. And then, so there you go. That's all of his patterns. It takes full advantage of MetaStock and its ability to scan. It gives you the entries and the exits, and it's great. I love the way that this has been designed and the way that it makes it easy to find the patterns. This is actually a very underpriced add-on. Normally it's $299. Here at the event it's $249, so we're going to do a little bit of a promotion on that. That'll include a trial to MetaStock if you need it, and it also includes our money-back guarantee. So you can take advantage of that if you call us at 800-882-3040. You can also add it to your MetaStock account if you go to metastock.com/saleschat. It is also part of our Trader Summit pack. With that, you can get the Steve Bigelow's Candle Profit Strategies, Steve Primo's Momentum Strategy #4, the AAII Ray Rondeau's Conviction Plus, Oscar Carboni's training, and then Around the Horn. And you'd also get 3 months of LearnMetaStock.com, which is a fantastic website to help you learn all about MetaStock. So normally the cost here would be $3,987. The special today is $2,344. So you can take advantage of that if you go to metastock.com/summit deal. You can give us a call at 800-882-3040, or you can visit us online at MetaStock DC. Philip, that's a really good question. He asks, can you compare the real-time and end-of-day versions of MetaStock? There's two really big differences. One is that one will look at intraday charts like 5 minutes, 30 minutes, 60-minute charts. It'll update all the time, and that would be, of course, the real time. The DC program is great for if you're just scanning after you come home from work every day and you want to look at charts, and it's only $69. So two key differences is one is full real time. The price point is another one, I guess. One is only end of day. That's the biggest difference. Also, if you're interested in news, that Zenith is included with real time, and it's not included with DC. But if you one of the best institutional news broad market platforms, powered by Reuters data, and that's available as part of MetaStock real time. It's not a part of DC. So, Philip, hopefully that answered your questions. And William says, Oscar is not a boring trade. No, definitely not. Okay, very cool. Well, I made that comment. That's a good point. I made that comment because, like, if you're throwing up because you're starting trading, something's off with your position sizing, or it shouldn't be that stressful. If you're going, there's old traders, there's bold traders, but there isn't any old bold traders. I just, I don't ever have a position that's big enough that it keeps me up at night. And maybe that's something that I learned from my taser trade that I was talking about a minute ago. But you shouldn't trade with money you can't afford to lose. It's really the bottom line. So, but yeah, I would definitely agree with you, Oscar, and most of the people that are talking today, all of them, except with maybe the exception of myself, have been very, very entertaining today. So there you go. A special thank you to Stocks and Commodities Magazine for sponsoring the event, and to AAII. And let's move straight on to Melissa. Melissa, I know we're starting you a little bit late. I don't want you to get too worried about that. You can take as long as you need. We're chronically late here at MetaStock. Let me introduce you, though. Melissa is our next presenter. She likes to talk about gaps, and she does a really, really good job. She's been featured on CNBC. I really enjoy having Melissa on, and that's why I bring her on so often. So, Melissa, let's go ahead and get you in here. How are you doing today?
Good afternoon. Can you hear me?
I can. Yeah, good. Let me go ahead and make you the presenter. How are you doing this afternoon?
Terrific. Let me see if you can see my slide. Can you see it?
Yep, I can see you and I can hear you. Let me turn off my camera, and it's all you.
Great. Thanks so much for having me, Jeff. Welcome, everyone. Beautiful day here in Manhattan. And I'm happy to be here today to talk to everybody about what I do, which is trade the stock market. So let's get going here. I'm here to talk to you today about gaps, like Jeff said, but particularly I'm here to talk to you about trading for a living. So, when I started trading, the reason that I started trading is I wanted a new career. I was doing mortgages, and at the time it was 2007, 2008. And the mortgage industry had started collapsing right under my feet. And I did mortgages for 17 years, and the industry changed. And, I was at a point where I really wanted to do something where I could make a lot of money. And lo and behold, I found out about the stock market. The interesting thing, though, about trading is you actually have to learn how to trade before you can make money in the market. It's not like you just go and you start a job Monday morning at 8 a.m. and all of a sudden you're making money. It's a skill. It's a skill set. So actually getting good at trading, actually making money trading means that you need a certain skill set. And more importantly, you actually need a strategy that consistently works in the market to be successful. So if you have any questions, you can plop them in the room. I'll see them as we go along here. You can also email me at melissa@thestockswoosh.com. You can call me at 929-3200-GAP. You can follow me on Twitter, Facebook, YouTube, and Skype. As Jeff said, I appear on national television. And I also have been putting YouTube videos, actually. I live in New York, along Central Park. I've been putting some park videos. I took a walk in the park today. I've been putting some nature videos on. So my YouTube is quite interesting. It's about the stock market. It's about TV clips. I have nature videos. So I try to make it fun. And I also try to put on Twitter whenever I'm on TV as well. Here I was talking with Neil Cavuto about the economy. You know, the economy has been up, down, up, down, up, down. We saw the market have a rally on Friday into the holiday week because we had some data out. And again, it's going to be a very interesting next 6 months. Why? Because the market started off pretty bullish this year. We've been rallying. We're up for the year so far, the QQQs and the SPY. But the question is, will it last? Will it last? So coming into this coming week, July 14th, which is this coming Friday, is the beginning of earnings season. Earnings season is important because it's the best time to make money trading in the stock market. So I think where the market goes for the remaining part of the summer and into the fall is really going to depend on how earnings turn out, particularly the banks and the financials, which have had a rough start to the year. As we all know, some banks went under this year. And of course, the banks have been rocked by interest rates continuing to go up. So I think we're going to know a lot more really in the next 10 days once we see how some of these large banks report their earnings getting into the beginning of this earnings season. So why are you here? If you're here today to listen to me, it's probably because you want to be successful. You want to be successful as a trader. Or maybe you're losing money trading, or maybe you're making money, but you're not making enough money. Or maybe you're new. Maybe you've never traded at all and you don't know where to start. Or you need a trading strategy. You're trading, but you just don't have a set thing to do every single solitary day that works consistently. So that's what we're going to talk about here today. And again, if you're going to be successful, you have to have a successful strategy. And particularly if you want to do this for a living, and whether it's part-time money or full-time money, the whole idea about trading is the stock market is only open from 9:30 to 4, and it's closed weekends, which is how I'm able to be with you here today. You know, when I had my mortgage job, I worked 7 days a week, 7 days a week. In fact, I think the end of the line for me was I had a customer call me actually on Christmas Day. Christmas Day was with my family, and I said, that's it. I've got to find a new career. So I think everybody gets to that point where they realize they want to make a big change in their life, a career change in their life. And, you know, we've seen that more and more, even with the work at home scenarios that many careers are having now, and really since COVID. But even if you like your career and you like your job, you can still make money on the side trading, and it's part-time hours. You know, I trade the morning. So I'm taking trades at 9:30 in the morning, right into the open, in the first half hour of the day. And you can make a couple $100 a day trading, and you don't even have to sit there for 6.5 hours. But my system that I trade, like I was saying earlier, is based on gaps. And you have to have a successful strategy in order to trade the market. And again, a lot of people want to buy dips. And while that can work in a bullish market, when things turn, it doesn't work. And you can't buy every dip and make money, even in a bullish market, even in a bullish stock. You saw that actually in NVIDIA. NVIDIA is a very, very strong stock, probably one of the strongest stocks in the market right now. And if you bought every pullback in that, you were not successful, okay? But that is something that I've been watching, particularly going into earnings season as well. So I put the May results here in the room for an average risk of $2,800 per trade. If you're in my live room in May, and I have June's next, with this type of risk, trading equities. Now, for those of you who don't know what equity trading is, it's when you take a trade on margin. So you have to have a margin account in order to day trade. So I run a live room every day, Monday through Friday, and I call the trades live. I call the entry, the stop, and the exit in the room. If you had risked $2,800 per trade for the month of May, you would have made $59,912 with me. And in the month of June, we had a good month in June too, you would have made $57,752. Now, I took off this past week for July 4th. I'm back on Monday. But overall, the last 2 months have been very solid. Now, those of you that don't know me, I focus on shorting. I will go long. We did actually go long NVIDIA, but I'm mostly short. And you may say, well, wait a minute, Melissa, if the market's bullish, why are you shorting? Because short moves happen as a result of panic. And panic comes in fast. And you can make a lot of money shorting if you know how and what to short and when. So I like the fast trades, particularly because I want to get in and out quickly. And then I don't have to worry about economic data or any Fed reports or anything else that happens to come out that could mess up your trade. So anyways, to get these kinds of results, okay, these good, solid results, what do you need? You need a consistent strategy that works under any market condition, bullish, bearish, sideways, whatever. You need a way to make the daily picks. You need a way to enter and exit the trades, and you need good money management. So, I mean, again, I say this and it sounds very simplistic, but there are a lot of people that are trading that don't have a set strategy, and they also don't have good money management. What do I mean? They don't get out when they're up, or they risk too much. You should be risking the same amount of money in every single trade that you take. So if you're risking $1,000 a trade, it's got to be close to that in every trade. Otherwise, you can't compare apples to apples, because you could have 5 winners where you're not risking the same amount, where you're risking less, and you get a 1 loser that could blow out the 5 winners. So you've got to have a consistent amount that you risk on every single trade in order to see consistent results too. So for me, like I said, I focus every single day on gaps. So for those of you that don't know what a gap is the difference between the close and the open. Simple. But can you trade every gap that happens in the market? No. Now, a lot of people do gap fills. I don't do gap fills. I'm actually looking to take the gap in the direction of the gap. So if I see a bullish gap up, I'm looking to go long if it rates for my system. If I see a bearish gap down, I'm looking to short based on my system. You can't go long every gap up, and you can't also short every gap up, and vice versa. Now, most stocks gap on every single day, and also the market. So like when I say the market, I mean the QQQs, the diamonds, which is the DIA ETF of the Dow, or the SPY, SPY, which is the ETF for the S&P. So I will trade the overall market sometimes. And nowadays, you can actually take daily options in the market. They have daily option expirations. That's not something I'm doing. I'm doing the weekly options when I trade them, but you can. You could actually day trade the market ETFs as options now and get in and get out quickly. Someone's asking about capital. No, these trades here, the results that I just showed you were in the live room. They were trades on margin. You do not trade options on margin. Options trades, you have to have the cash, whatever you pay for the cash. We will talk about options in a little bit here. But on a margin trade, you have to have a margin account, which means at a retail broker, you need more than $25,000. You can open up an account at a prop broker. Most places require a minimum of $5,000, and you can get 10-to-1 margin. At a retail place, you need 4-to-1 margin. Options trades are based on cash. Whatever you risk per the amount risked is what you have at risk. So it has nothing to do with necessarily, well, I shouldn't say that, because sometimes usually the cost of the stock as far as price per share equates with the option. But then again, I say this, and then I'm looking at the SPY options and some of the QQQ's options, and I think they're very reasonably priced. But typically, if you have an expensive stock, something like NVIDIA, you might have an expensive option. But it's still cheaper to trade options than it is more so than to do margin trades, okay? So I do options too, but the live room is equity trades, where I'm calling the equity trades. The options trades are newsletter trades, and we are going to go over some of them as well. In fact, I'm going to go over the last week of options trades that I called on the newsletter. But that is a subscription service. That is not the live room. Did I answer that question? I think so. Okay, so let's get back to talking about gaps. Again, you do not need a general overall broad-based view to make money in the market. You can read all the books in the world. It's not going to help you make money, okay? And tons of people have a lot of information about the market, and they fail, okay? Because they don't focus on one thing. For me, it is all about the focus on one thing, and even one trade per day. And I'm looking for institutional money in the price patterns and gaps. So what do you need? You have to have charts. You have to have charts, you have to have live data, you have to have pre-market data and post-market data, and you have to be able to see the gap, okay? Because again, you can have as much knowledge as you want, but if it's a general overall broad-based view of knowledge, it's not really going to help you make money. It's pinpointing the right thing to do. And if you find it and you get it, the timing right, and this is for day trades or options, you need to get the timing right. Before the big move comes in, then you can make money. So anyways, what is a gap? Let's take a look at it. This was the biggest trade of the week. It was Nike. This I did a put in, okay? And we'll talk about the options call in this later. But let's just go over what is a gap, okay? So Nike closed here, gap down. So a gap is the difference between the close and the open. So the stock closed here at this particular day, okay, it was the 29th. And then it opened at 9:30. U.S. stock market opens at 9:30 the next day at a different price. So it opened lower. Okay, so in this case here, it was a gap down, and then it fell. Now, I'm just going to go back in here. I did not play this, but this was a gap up, okay? Stock closed here, gapped up. So it closed at one price at 4 o'clock and opened at a different price at 9:30 and rallied, okay? So actually, you could have gone long this. I didn't on this particular day, but you could have. This, we bought puts in, and it fell. And you could have day traded this too. You could have shorted this as a day trade, and you could have done this as a swing trade, okay? So this is a gap. This is a gap down. This is a gap up, okay? And actually, you could have played those both. Here's another example of a gap. This was Baidu. We did this too. Stock closed here, gap down, fell. So again, Baidu closed at one price at 4 and opened at 9:30 lower at a lower price point. This is a daily chart, okay? So you could have shorted this. You could have shorted as a day trade, and you could have bought a put. Got in, got out. So it fell. The stock price fell on that particular day. Anyways, the number one key ingredient to becoming successful as a trader is having a specific system and strategy that can offer you reliable and consistent profits on a regular basis. Trading success and financial success in the market is by pure design. It is not by accident. What does it take to be successful? It takes having a niche. So for me, my niche is gaps. And it's actually the fast trades and shorting, okay? So those are the things that I specifically have a niche in. That I'm trading on the day trades, on the stats that I showed you earlier, the trades I do in the room, I'm trading on the 1 minute chart, So I am in and out on the 1 minute chart. Most day traders are not trading the 1 minute chart. They're waiting until after 10 o'clock to see what the market's doing or the stock to take a trade. I am usually in and out in 5 minutes, 10 minutes, 15 minutes, very, very quickly, okay? Again, let's go over what a gap is. A stock gap to the closing price is different than the opening price. Very simple. So gaps happen every day in the market. Are all gaps playable or what I call predictable? No. You need a correct way to find the best gap, and you have to know what direction to play it. So that is what is the crux, you know, what I figure out in the morning, and I'm figuring all of this out in the pre-market. So I know what I want to do. I know what I want to do, Nike or Mew or whatever I want to trade way before the stock market even opens, because I get up in the morning and I rate the gap using a checklist. If you come and take my class, I teach a class once a month on my method. This is what you will learn from me. You will learn how I make the picks, okay? So I go through it early. Whenever I get up, 6 a.m., 7 a.m. in the morning. And again, sometimes I see late gappers, but I usually know way ahead of time what I want to trade in the morning. So there are some people that are trading options with me that do not come in the day trading room, but they're trading options with me. They get the trades for the options newsletter to their email. They have a full-time job. They're not in the room. And when they get the trade, they put the trade on and they let it ride out and they put a sell order as soon as they buy it. I'm just buying puts and selling them, and I'm buying calls and selling them. I'm not doing complicated option strategies. My option strategies is based on my gap strategy. It's based on trading momentum. It's based on trading momentum to the upside, in which case I would go long or buy a call, or it's based on trading to the downside, in which case I would buy a put, like in Nike, where the stock price is falling, okay? So if you want to trade on this side, which I suggest for people until they decide this is something they really want to do full time, you can do that. But I suggest doing it in reference to focusing on options if you're doing something where you can't be in the live room every day. But success or failure, if you're trading, has everything to do with the quality of your system. And I'm never amazed whenever I do lectures or webinars or whenever people email me or they ask me questions or they call me on the phone and I have a conversation with someone and I get to know people. I'm surprised how many people risk money in the market and they don't have a system at all. They don't even have a system at all. They say something to me, which when they describe it to me is an entry. It's not a strategy or a system. So there's a difference. So I have a system that allows me to make the pick. Then I have a way I enter that pit. There's a difference, okay? I can't take an entry, even the way that I take them in every single thing that trades. It has to be a good gap, or what I call a golden gap that rates for my system, okay? Because you can't short everything and you can't go long everything. And again, even if you get it right with the market, and again, who's to say what the market does for the next 6 months? A lot of people are very, 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 very bullish right now. While the market could continue and it's getting close to the highs and we could go over the highs and rally, that may not happen. And if it does not, a lot of people are going to get pummeled that keep buying dips, because the next buy the dipper may fail in the market. So anyways, what I'm looking for is the rating system to tell me what to do, where, and when. And so that's what I figure out. All the work is done in the morning. So I make it easy for myself. If I find something that rates good, then I watch it on the open and then I do it. If I don't, then I don't do anything that day. Okay. So let's take a look at Baidu. Again, we were looking at this here. This is the daily chart. So again, Baidu closed here, gap down, fell. This was June 29th. I actually forget the reason for this gap. I don't remember now. It was like 2 weeks ago. But anyways, it fell and it rated good. So we did a short in this. We did a day trade in this. This was a trade on margin. You would need a margin account to take this trade if you wanted to do it. And again, I called this trade live in the room. The entry was 136.55. This is an advanced trader risk. What do I mean? It's anything over $1,000, $1,500 I consider advanced trader. The risk here with this is $28.50. This is my average risk. I did an add in this. Actually, it was close to the price. I doubled up on size. This is a sophisticated technique, but I do this and I call it in the room if you want to do it, where I see a second setup where I know it's going to go. So I added, and then it did. It dropped, and we got like $1.50 out of it. So it actually kept going though. So this was a good trade. Again, $1 or more is a good trade, even in something like Baidu, over $100 price per price per share. 136.56. Exit was 135.05. Profit was $9,060. Now getting back to margins. So if you wanted to take, say for example, 1,000 shares, just to make it easy, if the stock price was 136.5, you would have needed how much buying power? You would have needed $136,500 in buying power. Does that mean you would have needed $136,500 in cash? No. If you had a prop account, you would have needed 10 to 1, so like 13,650. If you have a margin account where you need 4 to 1, you would have needed like a little over 34,000. So again, the cost of something is not the same as the cash you need to take a trade. And if you don't have a margin account, or you have a retirement account and you can't do day trades, then guess what? You can buy a put. Again, I do puts too. I do puts and I buy calls, but I'm just showing you here an example that I called in the room that you could have not done this if you didn't want to. You could have bought a put, or you could have done both, or you could have done this, okay? So anyways, here was the call. So we were talking about the 1 minute chart. Stock closed here, gap down, drop, rallied, boom. We shorted it, added, got the drop, out, done. Kept going. You can see down here where it actually, and I think it actually went to 133 and change. So I had what I thought was a good exit in this at 135 or something. It was up a lot, but it actually ended up coming all the way down and ran down another $1 plus. So again, this is a fast trade. Time of the day in the open is 9:30, and you see the trade fell off a planet in the first 30 minutes of the day. So again, you do not have to sit all day and watch and wait for setups, and you do not have to wait to make money. When I was saying about institutional money and getting momentum move, this is what I'm talking about. Boom, that's it. Doom, out, done. I call it chunking it out. This makes day trading so much easier if you can figure it out and find this to play it in and out very, very quickly. Because otherwise, you are scalping if you're not getting to move like that to be able to make this type of profits. Any questions here about this or Baidu? So getting back to institutional money, gaps are created with large institutional money. That's what makes the gap. What do I mean by institutional money? I mean large hedge funds, banks, big professional traders with size, volume. Everything we do is with volume. Every stock that we trade, everyone we're talking about in here today, is a stock you're familiar with, or a company that you know, or you may even know the products that they sell or buy them yourself as a consumer. The professional gaps that happen and play out in stocks are formed by one thing and one thing only, large institutional money. Therefore, you need a way that will help you pick the correct direction to play the gap and then confirm that the large money will flow with it. And so that's what I'm looking at doing in the morning. So the 26-point rating system pinpoints the direction of the footprints of institutional money in gaps. And that is what you would come and learn from me. That is what I teach in the class, okay? How to know that Baidu would fall before the stock market even opens. How to know to short it on the 1-minute chart, okay? So gaps are an event. They create a sense of urgency, specifically shorting. And that's why I love to short. It's very, very quick. It's panic. That's an action is being forced by participants in the stock. This is why gap trading is incredibly powerful. Trading golden gaps is a powerful and profitable way to trade because you are trading on the side of power money. By having a formula to rate and qualify the gap, you get confirmation and conviction that the large institutional money is on your side, and then you play it. And so that's it. That's how it all comes down. And so you're looking for that in the morning. So what we learned from me, a way to pick the best gap to play each day. You only need one trade a day to make money. You can trade gaps as day trades or using options. And also you need a way to enter it and you need a way to exit it. So again, just going willy-nilly and saying, oh, the market's rallying today, I'm going to go long this. You can't do that with everything. You've got to hone it down what you want to do. Get in as early as you can before the big move happens. Otherwise, it's too late and you're chasing it and then you're missing the move. And again, or you're taking too much risk. Okay. So you want the volume. You want the early entry. The entry is the confirmation. The rating system tells you what's going to go and where is it's going to work. So we're going to go over, this was the trades for this week. Now I'm showing you beginner trader results. I risk more than $1,000 per trade, but I'm doing this because this is a good amount that anybody that's trading could risk. You can risk less if you want, but I'm using an average of $1,000 per trade. This was a trade from that expired on Friday. These were options trades for this week. There were 6 trades, 1 loser, 0 break-evens, and 5 winners. So the win ratio for the past week in the options newsletter, the options that we did was 83%. So if you risk $1,000 in every trade on average, we're going to go over them here, you could have made $9,215 this past week on the trades called in the options newsletter. Average return on investment was 152%. That includes the 1 loser. So this is an average week. There are some weeks that I do more than 6 options trades, some that I do 10 or 15. It depends how busy we are. But this was a particularly, average week to show 6. Again, there's 5 days in a week. I don't necessarily do a trade every day on the options newsletter. I may have one day I do nothing. Then I may have another day where I do 3 trades. With the day trades, I am trying to get 1 trade a day when I'm in the live room, when I'm trading, when I'm in and out in the morning. And again, the difference between doing day trades and options is purely something that you can decide yourself. Personally, I like doing both. One of the reasons I like doing options is because it can hold for an overnight move. I'm not doing that with my day trades. If the day trade doesn't go when I'm in it before 4 o'clock, I'm not holding it overnight as a swing trade. It would not be on margin. It would be on, or it would be 2-to-1 margin or on cash. I'll get out. I'll kill it with a loss. But I focus on day trade in the morning quick. So I like to do both. Again, I like the fast moves for the day trades, and I like to be able to hold overnight or get a larger move in an option. Okay. And also, options are easier to hold through wiggles and jiggles versus a day trade. All right. So let's look at the first one we did here. We did the Tesla 240 puts. Okay, we shorted this. So again, the expiration date was Friday, 7/7. I called this Monday in the morning on the 26th before the open. Okay, so you would have bought the put Tesla. If you were in the newsletter, you would have gotten this to your email. You don't do the trade until the market opens. Cost was $550, 2 contracts. Again, this is an average risk of $1,000. Risk was $1,100, sold at 10. Profit was $900. Return on investment, 82%. 82%. So again, this was a solid trade. And let's take a look at the chart. In this case here, this is again Tesla. What did it do? Stock closed here. This was on a Friday. Gap down on a Monday. Or no, I think that was that Tuesday? No, yeah, that was Monday. Gap down, rallied, dropped. So again, this fell. So we did a put because the price dropped. It was a gap down, fell. Take it over. See how it went. So again, I grabbed it to get it into the strike. Sometimes when I call it sometimes I'll call them at the money, sometimes I'll call them away from the money, and then the target is basically the strike. Now, CVS was another one that we did. This was a loser. This didn't go right this past week. I don't know why. There was something that wasn't right about the cost of it. Actually, I realized after I did it, but it was a good gap. 9:09 in the morning on Tuesday, I sent this out, the 68 CVS puts. It was a bust. It cost 90 cents. I thought that was strange. I felt like it should have cost more. Anyways, I sold out of it on Thursday, saved a little bit, but it was basically a bust. It never went right. So let's take a look at the chart. What happened on this one? This just didn't go. Stock closed here, gap down. This is something that normally will have a big move. You can see some of the red bars over here. And even the green bar is a big move here. This just kind of went sideways the whole week. So the second day, I thought it was going to go, and then it didn't. So this just never went really profitable for me. So CVS was the loser that week, this past week. Baidu, then we did the 135 strikes. I sent this out on Thursday the 29th, again, before the open. So you can get ready and you know what to watch and you know what to do. And again, this is an options trade. We did the puts. Cost was $225, which was very reasonable. 5 contracts was a risk of $11.25. Sold at $380. Profit $775. Return on investment 69%. So anyways, this goes in here. Stock closed here, gap down, dropped. Okay. So anyways, this in here was a short. You could have day traded it. You could have bought the put in it and made money. And again, I fell into the strike and down. So again, momentum, what's the momentum that's happening or happened on the 29th in the Baidu? It's sold off. It's sold off in the gap. Okay. Actually, you could have done this over here too, but I was off this past week, so I didn't do anything with that. The big winner for the week, though, that we did this past week, the biggest one that we've had in a while was Nike. We did the 109 puts in Nike that expired on Friday. You could have been in this till the last day. I was not, but you could have, and it's crazy to say that, but you could have. So on Friday the 30th, I saw this at 6:41 in the morning. Again, with my system, you can get up as early as you want. You can do it the night before if there's gaps the night before, which sometimes there is, and particularly in earnings season, there actually is gaps at night. You could have rate the gap at night, rate the gap when you get up in the morning, and then you know what you're doing. Like I knew this was going to work 3 hours before the open. Okay, so I sent the trade out to the list. Again, you can't do it to the open. This was the 109 puts in Nike. Part of the reason it was a good trade was the price was cheap, and it just fell straight down like a brick. So the cost was 75 cents, 15 contracts, again, an average risk of $1,000, $11.25, sold at $4.75. Profit was $6,000. Return on investment, 533%. And so the reality is that, will you have a trade go to a piggy target like this all the time? No, but you will have some trades go to piggy targets like this. You will have some trades where you can risk $1,000 and make $6,000 in this. This was an earnings trade. So it was a good trade. It was an earnings trade, and we're getting into earnings season. We will have other trades like this. Again, this gap rated extremely good. It was one of the trades where I call it, you can't screw this up. You can't screw this up. So this closed here, gap down, and just fell off the planet. And here it was. It actually was like at 104 on Friday, the last day. Again, I was out of it here, but you could have been in it at the last day and still made money. It was crazy. Absolutely, absolutely crazy. So a beautiful, sell-off. Again, panic sell-off, but this was a very good gap. So you should not hold every single trade to a monster target, but there will be some gaps that rate extremely well that will continue down, and you don't have to rush to get out of them. And again, the benefit of doing options is that you can capture overnight moves to get this type of a move. Okay. Any questions here so far? As I'm going through these. Then we did do one call. Again, these were mostly puts this week. We did the 425 NVIDIA calls. This actually rallied on Friday. I did not see what this is worth. I don't know if you could get out of this with money Friday, but I got out of it before Friday. But I called this on Friday, 6:30 at 10 in the morning. Cost was $6. 2 contracts, the risk was $1,200, sold at $950. The profit was $700. Return on investment was 58%. So
we have a ton of questions, Melissa, if you want some.
Sure, go ahead.
Oh, sure. Okay, let's see. Jim wanted to know if you're doing option trades. I think you've answered that one a little bit. He also was hoping you could talk more about your trade room, like how much it costs and how it works, etc.
Yeah, go ahead. The live trading room is open at 9 a.m. in the morning. If you want to join the trading room, you must take my class. So the class itself is a prerequisite to join the room. After you take the class, the room is $500 a month, but you have to take the class first. I am running the July 4th special still, which is going on through tomorrow, which includes the trading room free with the class for the month of July. Normally, it's $500 a month after the class. The options newsletter, there's no prerequisites. You can sign up. That's a subscription service. You do not have to take the class to get the options trades.
Herbert Herbert wants to know, how does volume play into your gaps?
It doesn't play any point in my decision making, if that's what you mean. It plays a point in where I'm not doing something if it doesn't have volume. So it's really just simple. I'm not trading penny stocks. I'm not doing any options that don't have any volume. I just flat out will not trade anything that doesn't have enough volume because it's not going to move. It's not being played with institutional money if it doesn't have any volume, and therefore I'm not going to get a big move in it.
What percentage of gaps reverse from William?
I don't play the reversals, so I don't know what percentage reverses. I'm not looking for that. I'm not looking for them to reverse. My rating system is looking to rate it based on whether or not it's going to continue the gap that is being set in the direction of that gap. So I have absolutely no idea what percentage reverse because I'm not playing those, because to me that's going against institutional money and I don't want to do that. I make more money playing with the gap. Again, you can't play every gap down. Going back here to Nike, you can't play every gap down short, just like you can't play every gap up long. I'm qualifying that. That's the genius in the system, but I don't know how many or what percentage reverse because I'm not doing those.
Tammy wants to know if you have a recommended time frame for looking at charts, like daily, weekly, etc.
As soon as if you mean the daily chart, the 1 minute, or what time of the day?
Yeah. I think she was asking about time frame. Do you look at daily, 60-minute, 30-minute?
Yeah, the daily. All the daily charts in here that I have in here, which you can get from Jeff.
Cool. And then last question, and you can get back to it. Actually, there's two. Do you look at volume-weighted average price from William?
No.
And are you looking for a significant gap? And can you quantify that?
No.
Okay. All right. Cool.
I'm trying to go back and see if these are all kind of little different ones here. I'm trying to see if there's any. These all look actually kind of the same this week, but if you mean big or small or medium, I do them all. There's no. Yeah.
I gotcha. That's cool. You're all caught up. You can proceed.
Okay, so anyways, Nike was a good one. Everybody made money with this. Again, if you wanted to take one contract, you could have done that. Again, you can take more risk than $1,000. I'm just showing you with an average of 1,000 what you could have made with this. So the NVIDIA one I did, and I got out of this. I think 50% is good in an option, but I was aware of a holiday. What happened with the NVIDIA was I did it here. Originally, I did it on the 30th, and I wanted it to pop that day. It went, but it didn't go really the way that I wanted it to go. It was up this day, but it didn't go big. Then we had the holiday, and then I had this move up here. This was green at the high end here, and I got out. So I got out of the NVIDIA here on this day, which was after the July 4th. Again, this was a call. I don't know exactly how this ended up closing on Friday or where this closed on Friday. But this was above 425 on Friday again, but I'm typically not holding something that I can get out of with profit before the last day because I think it's just too risky. It's just too risky to do that. The other big trade we had was Mu. So I actually even did this late. I did the 63 Mu puts. It expired on Friday. This is another one you could have been in it to the last day and still made money in it. But I actually did this trade late. I saw it late, and that's why I did it late. I said, this is still going to drop, so let's just do it. And then I did it. It was Friday around lunch. But anyways, you could have gotten it much cheaper. We could have paid half of this if you'd done it in the morning on that particular day, but it still worked. 12 contracts, risk was 1080, sold at 240. This was getting out on Thursday. This still fell Friday too. Profit was 1800, which was 167% return on investment. Now, again, I did here, but actually I did it, like I said, around lunch. So that's unusual for me. I'm just saying I didn't see it till then. but I knew it was still going to fall. And then it did. And it fell down. Actually, this did fall Friday. There it is. So again, this was, $2 plus through the strike on Friday. But I think you've got to get out of trades if you're up on them the Thursday before the expiration. And I'm usually doing the weeklies. So I'll usually do something out with a Friday expiration, unless it's a holiday or short week, then I will do it out for 2 weeks. But it doesn't mean I'm holding the trade, like I said, until the day of expiration. The whole point of trading, whether you're doing a day trade or an option or whatever you're doing, is to get the momentum and get out. Get the momentum and get out. On the 1 minute chart, when I'm doing a day trade, I get the move in a 1 minute, boom, and I'm out. In an option, I may get the move if I do a put in a fat red bar, and then I exit. Or if I don't get a fat red, okay, then I am looking for a gap down, a consecutive gap down the following day or another day the week that I'm in the trade. Because again, that's how you can get trades to be very profitable if you happen to be in them overnight and then it gaps in your direction. For example, say, I'm just making this up, this didn't happen, but say you did on this particular day on Friday, say you had done the 63 puts and new, say you had to get up Monday morning. Again, this did not happen. I'm just making this up to show an example because this does happen with some of the trades that I take. If you had gotten up Monday and it would have opened and gapped down at 60, well, you would have been up poof, as soon as you woke up. You would have been up a while. And what would you have done? You just get out. That's it. Done. So that is one of the reasons why I also like doing options, because you can make a lot of money by capturing that overnight move by already being in the trade. But you have to know what to look at to be in it. Okay. So anyways, getting back to what we were talking about here about trading and everything you have to do to get to this point. I come across this. I've been teaching now people, for a long time, 11 years. I've had the stock switch business. I've been trading for 15. I've talked to people from all walks of life and all over the place, all over the world. Very few people come to me that have never traded before. I think I've had like maybe less than 5 clients that have come to me in the time that I've taught people that have never traded. But most people have traded. And again, most people trade, they don't really get anywhere with it. And then as life goes on and they're trading and the years go by, they find they kind of lose steam and to continue to proceed to trade. Everything that you want to do in life, that's fabulous. Big goal, something where you can make a couple $1,000, a couple $100, sit at home for an hour a day, whatever that is. Anything that's a fabulous, fabulous goal that you have as a dream, it's going to take work. It's going to take work. It's going to take obstacles. Does that mean it's going to be so much work for the rest of your life? No. I know how to trade now. Okay. It doesn't mean that every day is easy, but I'm pretty much in a groove. I just do my thing. Occasionally I have a hard day, but then also the reward is some days I have fabulous days, like the Nike trade. Okay. So, but the bottom line is that every day, for the most part, is easy for me because I've been doing this for so long and I'm in a habit. It's just like when you get up in the morning and you brush your teeth kind of thing. So at the beginning, when you're learning, and there's a learning curve for everyone. When people come to me, the learning curve could be a day, could be a week, could be a month. I have no idea. I don't know you. But at the beginning, there's a cost involved to set up a trading account, to pay for a class, to go through the learning curve, but that doesn't last forever. The obstacles that you have to get to the point that you're at right now, to get to the next point, which is success, if you're not successful right now, whatever that takes is whatever it's going to take. And it is different for every single person. Okay. My journey is different than yours, and everybody here has a story. In fact, if I ever wrote a book, someone said, you write a book, Melissa. I said, no. If I ever wrote a book, it would be more of a motivational book, and it might be like my story and like lots of people's stories that I've encountered over the years of their stories about trading, because everyone has a story to get to that point. The difference is that not everybody actually achieves success. And so what is the difference between someone that's achieved success and someone that hasn't achieved success? It's very simple. If you quit, you definitely will not make it, and therefore you can't quit. So if you get to the point where you're not actually even trying to learn something new and you're trading and you know that it's not working what you're doing, but you don't want to spend any money on a class and you don't want to change what you're doing, you're not going to get anywhere. You're just stuck in a rut, okay? You must continue to overcome the obstacles to get ahead to the next point. And the sooner you do, the sooner you're going to get there, And of course, there's all these things involved with trading, the mentality of it, the risk amount of it. I said, listen, risk less money if you're in that much fear about the money situation. Risk $100. $100 a trade isn't going to break anyone, Okay. Get to the point where you learn it so you can get out of the fear bubble, because you're never going to get ahead and be able to make thousands and thousands and thousands of dollars until you understand what to do and you have it down. And then also there's a trust factor. You have to trust someone like me. If you're coming and you're learning from me, you have to trust me that A, I know what I'm doing, and B, I'm going to be here to help you. I had a man email me the other day. He said, I need some kind of reassurance. I said, what reassurance do you want from me? The reassurance that I can give you is that if you need help, that I will help you. That is the reassurance I can give you, because I'm not there pressing the buttons for you, taking the trades. You know, you're the one that's in your home and your office when you're doing it. You must be responsible for the decisions that you make and the trades that you take. But in order to become successful, you have to be serious. And that means learning from someone and taking direction. This type of market, and really any type of market, I don't think you should trade alone. I think having a mentor and someone to go to ask questions, to rely on, that will be there from you, is something that definitely sets myself apart, because you can pick up the phone and call me and I will answer the call, or I will call you back. That is unusual, and I have that for people. They've been taking my class 5 years ago. It's not. I will remember who you are. Okay. Any questions? I'm watching the time here, Jeff, but I know I started.
We do have more questions. Yeah.
Oh,
Let's see. Does this process work better with certain types of stocks, like growth versus value? From William.
Certain types of stocks, it depends if it gaps and the gap rate's good. So no, not necessarily. If you're asking me if you'd rather do this sector or that sector, again, if the stock gaps and rates per the 26-point rating system, if it rates good, I'll do it as long as it has volume and can be traded on the open market, even if it's spready. So it's not like I'm only doing the tech stocks, or I'm only doing the financials, or I'm only doing, gold or something like that. I'm just telling you that I'm not trading penny stocks. I'm typically not doing something at $1 or $2. Will I trade something at $5 a share? Maybe, again, if it has volume. But other than that, there's no other, set prerequisites.
Gotcha. Mike wants to know, under what conditions do you add, like you did in the first trade example? For example, I might have the market with me, so I know that it's going to go because I have the market's help to get it down. If the market's falling, for example, could be something like it sets up again. Could be the time of the day. So there's lots of factors that are involved with doing an ad like that. It's basically, just look at it like you're taking two trades. So instead of taking one trade, you're taking two trades because you're doubling up the risk. So it's basically like you're just taking two trades. And you can take 2 trades a day. You should give yourself at least 2 trades a day. Even though sometimes I'm only doing 1. I mean, I will allow myself 2 trades a day, maybe 3. Cool. William would like to know if you can quantify the extent of the follow-through price move.
Say that again?
Can you quantify the extent of the follow-through price move, is what it says. So when you get into a trade, I think he's saying you know how far it's going to go. Do you have an idea of how far it's going to go? Can you quantify it?
As far as target, if I have a gap, if I have a sliding scale, so it's 20 points or more as a cutoff for me. At 17, 18, 19, it's 50-50 chance of working or failing. So if I rate a gap, I mean, I don't get a perfect score every time for my system. If I rate a gap and it gets 25 points, that's a great gap. That gap's going to go. It's going to work. I'm going to do it as a day trade. I'm going to do it as an option. You can hold it down. So the higher the rating, the better the gap, the bigger the move, the bigger the target.
Mario wants to know if you how do you know how much to risk? Do you risk the same amount every time in terms of percent, or do you risk more if you like the signal more? Is there kind of rules behind how much you're going to risk?
Your risk should be different for every person because it's based on your cash. Your risk has to be based on your cash. You can't have $10,000 in a trading account and risk $5,000 on an option. I don't care how good it rates. You have to look at how much money you have in cash at your broker to be able to determine your risk. So for me, I risk an average of $2,800, $3,000 per trade in my day trades. So I'm risking more for my options, but we're not talking about advanced risk and options right now. But that is based on the cash in your account. If you're someone and you want to ask me, Melissa, I have this much money and what do you think I should be risking? I will tell you what I think. But again, I'm going to err on the side of conservative and caution if you're new and you had never traded my system before and you just did the class. If somebody has $30,000 in a margin account and they want to do day trades, I think you're fine risking $1,000, $1,500 at the most. I wouldn't risk $3,000, which is 10% of your cash balance in a day trade if you have 30 grand. Because if you take 2 trades and you're underwater, then you're going to have to refund the account to get back over 25,000 to keep your margin account intact. Make sense?
Mm-hmm. It does. Although you could risk half every time, it just wouldn't be recommended. So just because you can doesn't mean you should.
I've seen it all. I have found people that have smaller accounts, not I shouldn't say less, but people that have smaller accounts, and I don't know why this is, because they swing for the fences. They risk the farm, so to speak. People that have smaller accounts tend to be more aggressive and take more risks than people that have larger accounts. I don't know why that is, but I don't know if people just want to go hog wild, but it should be the opposite. People that have smaller accounts should be more careful with their risk than somebody with a larger account because they don't have a big margin for error.
A couple of people asking if we have gap scans in MetaStock, and it's an easy scan to put together. So yeah, absolutely. And then the last question that I see right here is, what makes you like this strategy above other strategies?
Well,
also, another firm, Mario.
Myself, so there's no other strategy that I do, another strategy that I made up. So I developed this specific strategy. This is the only one I know, and so it's the only one that I do, and luckily it works. But it took me 3 years to figure it out. When I started trading, I took one class. I didn't learn a million different strategies in that class. I learned different ways to enter trades, and I learned about technical analysis, but it wasn't the strategy. And soon after that, I traded the gap. It was a short, and I said, oh my God, I can make a lot of money shorting. It was really, really fast. And I had 1,000 shares or something. And I think I made like $1,500, and I made it like in 5 minutes. I said, wow, there's something to these gaps, and there's something to shorting. And that set me on the right course to actually go ahead and trade. But to me, I've never done anything else that's ever worked. So this is why I do it. And it took me 3 years to figure this out. So it wasn't like, oh, I just woke up one day and figured this out. It was a journey and a process to even figure out the 26 points. But one of the reasons that I don't buy dips is I am not a long-term investor. Okay, this is active trading. If you come to me, you're going to learn how to make money. You're in and out. Like I said, chunking it out. This is not buying the dip is great, well and good. If you're looking at, if someone said to me, Melissa, do you think the market's going to make a new high? I say, yeah, someday. I can't tell you exactly when. So why would I buy a call in the SPY or the Qs for, some day in September, October, November, or even January 2024? If I don't know the market's higher in the next 6 months, it could be lower in the next 6 months. We may not make new highs in the market until 2025. So long-term investing is not what I do, and it's very different. I would use a different strategy probably, or have a different look on things for long-term investing. But that being said, maybe I wouldn't. I'm in all cash in my retirement. I'm young, but I did not buy the market at the beginning of this year or the end of last year. And then I wondered if I'd missed the drop, and I said to myself, no, because there's a high probability or 50-50 probability that the market could drop again. And I would be upset with myself as someone that professionally trades, even to see my retirement, as young as I am, go down 25-30%. I would be angry with myself to sit and watch that. And that is exactly what's going to happen with people that went long the market. Even though you're up right now, and even though we're up in the market of the year, we could still fall and crash. One of the things, and I wrote talking points because I'm on Newsmax this coming week. 2 things that could screw up the market from making new highs. Number 1, any conflict that could happen with a war. That includes China, Taiwan, Russia, Ukraine, the U.S. could get involved with. And number 2, the Fed with interest rates. They're saying they're going to raise interest rates at half a point between now and the end of the year. I wouldn't bet my life on it. Because the fact is, they may raise them more. So 2 things that could affect the market and mean we don't continue higher, and you have to be aware of that. Is that everything for now?
Oh, one more question. Came in while you're talking. How do you know how much the gap will be before the opening price?
I don't. I see it in the pre-market. I don't know. I see it just like you do. But that's why you have to have, again, you could talk to Jeff about this. Jeff can do a little demo to show you pre-market candlesticks. I'm not predicting the gap is going to happen I'm seeing it on the chart, and then I rate it. Does that make sense?
Absolutely. And yeah, if you have real time, you can absolutely plot pre-market data easily. And then the last question, what is real estate versus trading in terms, what are the advantages of real estate versus trading in terms of making money? Which would you prefer?
Well, I prefer working for myself. When I was in real estate, I wasn't working for myself. I was at the mercy of banks that would approve loans or not approve loans. And I would never want to go back to that career. Look at the interest rate environment we're in right now. People want to buy houses and rates have gone up. Things cost more. Banks are getting stricter because they're going under and they're having all kinds of other problems with defaults. But the reality is I work for myself. Whether it's a stock swoosh business or if I decide to not do the business of the future and trade by myself, the only person I'm responsible for is myself. I would never want to go back to reporting to a boss. I would never want to go back in the office again. And I would not want my income to be dependent on someone else's decision. And the problem is, and one of the reasons I got frustrated with the mortgages in 2007, 2008, I had plenty of customers that wanted to come to me, wanted to buy houses. They were interested. It was difficult to get banks to approve loans. Banks were not wanting to approve loans when they were starting to go under, when mortgage companies were going under. So, you're having a similar situation now where banks are becoming it's harder to get loans approved and interest rates are higher and people qualify for less. So it's a difficult industry. I do not want to go back to that industry, and luckily I will never have to. Working for yourself, if you're a type A personality like I am, is a best case scenario. You have to be able to be at home and be responsible and be diligent and close the door in your office and just, sit and train for a half an hour a day. With mortgages, I was working 7 days a week, and I just never want to go back to that. So let's get into it here now. If we have any other questions, you can let me know. Let me try to get through this because I'm watching the time and seeing it's a little after 5. This was CCL. We did a nice short in the CCL, just showing you here. Stock closed here, gap down, fell. Okay, this was on the 26th. This was another day trade. Again, we did an ad. This was a lot cheaper though than Baidu. $14.45, shares were 5,000, risk was $32.50. Ad was $14.80, total shares was 10,000. That's a lot, I know, but again, this was a lot cheaper of a stock. Average price was $14.62. Exit was $13.95. I felt confident this would go to 14. We also did a put in CCL. You could have bought the put, or you could have done the short. Again, you would have needed a margin account for this. Profit was $6,700. And again, looking at this, just the whole concept of being able to take something like this in a 1 minute and to be able to make over $6,000 and be in and out so quickly is one of the reasons that I love to trade. So anyways, here's the move. Again, boom. That's it. This is a 1 minute chart. This is a 1 minute chart. You short it, get the drop. Short it, get the drop. Out. Nice move. And again, it was a gap. So anyways, just trying to get through the rest of this here while I'm answering some of your questions. You have to make good choices. You've got to find quality trades. The whole point of doing this is to make money. You do need good money management. We talked a little bit about that as far as having small accounts and big accounts and how much you risk. I use stops in my day trades. I do not use stops in my options because my stop is essentially my risk. So if I risk $7,000 in an option, I can't lose more than $7,000. The whole thing could go against me completely, like CVS, and I'm not going to lose more than that. So I do use stops, though, for my day trades because it's a limit order stop. It's going to hit me out. So I could get stopped. I want to get stopped if it's not going to work and it's going to go against me. Because, again, we're taking trades with the 1 minute chart, and things move fast in the 1 minute. And it's okay to take a stop. It's like the insurance. It's protecting you from having unlimited losses. You set your risk, whether it's 1,000, 2,000, 3,000. You set your risk, and just putting the stop in is setting it. Not saying, well, I'll kill it. No, put the stop in. But anyways, getting back to trading for a living, bottom line is you got to win more than you lose. It's the only way to consistently make profits. And then sometimes you will have a big winner. You will have a big winner sometimes, but you have to win more than you lose. We do have losers, okay? So the big winners cover the losers, and then the consistent winners mean you move ahead. And that's how you chunk it out. And you have to look at every day. Every day. I get up on Monday, I have no idea what I'm going to do Monday or Tuesday or Wednesday or Thursday or Friday. I get up in the morning and I scan and look for gaps. And again, that's something that you can talk to Jeff about after I'm done talking here, and he will help you find ways to scan gaps. But it's the disciplined behavior on trying to focus on what to do. It's about quality, not quantity when you're trading. And so for me, I was always very focused on making money. I was when I was doing mortgages too. I wanted to make as much money as I could. And for me, it's based on my risk. So I'm in a groove right now. And obviously, I'm running the room and I'm trading at the same time. So that's a lot. I'm able to handle it and do it. I have not upped my risk in a while. I might. The time to do it will be earnings season if I'm going to. I think once you get in a groove with trading and you're happy with your risk and what you're making, you can move forward and baby step it up it. So you could start out with the $500. Then you could up it to $750. Then you could up it to $1,000. Again, I'd rather see people learn the system and understand it than just go hog wild with their risk, even if they have the cash right away. But it is about consistency, okay, in the trade selection, and the focus on what you're doing and having the right strategy. So for me, it's about looking at the daily chart. I rate the gap in the morning with a checklist. This is what I teach in the class. I'm looking for the price of the stock to read the correct direction daily. That's telling me where the money is flowing, again, up or down. And it matters. It matters because if somebody is dumping a stock and you want to go long it to buy the dip, you're not going to make any money. You're going to lose. And you can keep going long and keep going long and keep going long it, but you're going to keep losing. So again, you have to be with institutional money to make money in any stock or the market, and you can short against even a bullish market. So what do you need to make trading work? You need a consistent strategy, which we've been talking about all day. You need to stick with one thing until you get good at it. And for me, it's even one direction. So I really stuck with nothing but shorts. So I got really good at shorting, and now I do longs too. But I mean, my focus for me really is shorting, buying puts and shorting. Here are results for the year so far, 2023. This is not the options. This is in the day trade room. Again, I was off for this past week because with an average risk of $2,800 per trade. All these trades are on margin. There's very few longs in here. Most of these trades are short since the beginning of the year. And again, looking at the stats for this year to be up over 332,000 with as bullish as the market was this year, knowing that most of these trades were shorts, you can tell I'm an expert in shorting. What will happen if we fall in the second part of the year? Will I then want to do the opposite and go long? No, I'm still going to focus on shorting because I really find, again, as teaching people as long as I've been doing this and as aggressive as I am with getting in shorts very quickly in the morning in the first couple minutes of the day, most traders don't know how to short. Most traders don't want to short. Most traders have no idea how to short, or if they short, they don't know what they're doing. So you really will have a niche if you decide to focus on shorting, whether you come to me or go with somebody else. For some reason, the idea of buying low and selling high and going long is something that more day traders, more retail traders prefer to do. But I'm telling you, if you can make a lot of money shorting, the moves go fast. And if you learn how to do it right, you can get in that niche. And then that sets you apart from, a lot of other people. And then you can get in the trades fast, like I said, and get out very, very quickly. So it's something you can do on the side. It's something that you can do full time. If you want to come and you want to learn from me, I would be your mentor in the class and in the live trading room. And then obviously you would learn my gap system. I think it's important. We're halfway through the year. I can't even believe it. It's hard to believe. Here it is, July. The year is half over for 2023. But you need to make a plan of action if you want to be in a different place financially by January 1st. Okay, so set goals for yourself. Set reasonable goals for yourself. The next 6 months, you want to be at this place, okay? Because if you don't set goals for yourself now, and you just keep letting time go by and you just keep sticking in a rut, you're never going to get anywhere. And all of a sudden it's going to be the holidays and you're not where you want to be by the end of the year. So if you want to come and learn from me, number one, you would trade only gaps. You would learn the system. You would take the entries in the room, or you would do the options and the day trades too, whichever one you want to do for yourself. And you create a money management plan for yourself to achieve your goals. I say 1-to-1. So most trades you're going to be looking for, if you risk 1,000, you're looking to make 1,000. I think that's a solid expectation to have when you're taking the trades. What will you learn in the class from me? You will learn a rating system to find gaps in the daily chart that have a high probability of directional bias for the entire trading day, a big move of the day, early confirmation of the bias and the move between 9:30 and 10 a.m. Eastern time, and precise entries with follow through and a good risk to reward target potential. And again, that's what I'm calling out in the room when I'm calling the trades, and I'm telling you where the entry is, and I'm also saying the targets. And in the options newsletter, I have the targets. Again, they go to your email. There's no prerequisites for that. I have the targets in the letter. So the class is called the Golden Gap course. If you want to sign up, the class is the end of July 22nd and 23rd. It is a 26-point professional bearish gap rating system. The purpose of this system is to help you evaluate which gap to trade each morning using a checklist. This checklist tells you what to trade when and in what direction. The 26-point checklist predicts directional bias in a stock. And so you'll learn the entries, you'll learn the exits, you'll learn how to read institutional positioning of the stocks, you'll learn how to day trade gaps if this is something you want to do. And I make the ratings for the options, and then I'm entering the options as if it's a day trade, but I'm just holding the options longer. So the class is July 22nd and 23rd, 9 a.m. to 5 p.m. Eastern time. Class is online. You can be anywhere in the world and take it. Again, I live in New York, so I'm not doing live classes yet in New York. I might. That's something I thought about for the future, but for now, I'm doing online classes. The class tuition is $69.99. If you want to sign up, you can email me. And as I was saying earlier, I've been running the July 4th special, just happened to have the webinar today. This is over tomorrow, though. If you want to sign up, you can sign up and get the trading room free for 1 year, and the gap options that are free for 1 year with the class. The deadline for that, though, is tomorrow. Any questions here?
Yes, real quickly. Mike wants to know, how long does it take to go through the 26-point process?
Well, obviously, I've been doing this a long time, so I can do it, in a minute, but I don't rush it. I mean, I'll sit down with a cup of coffee in the morning and I'll take my time rating the gap. I'll take, 10 minutes looking at something. If you're new, it's probably going to take you about 8 to 10 minutes looking at each stock.
Is volatility important with your strategy? From David.
Well, the volatility is the momentum. So yeah, you got to get volatility because that's the momentum. That's what you're playing on. And again, volatility can be up or down. But the whole point, you make money trading volatility if you can spot it. That is again, the whole way you want to make money as an individual trader. Otherwise, you're trading for pennies. I'm not trading for pennies. I'm trading for dollars. So volatility is good.
All right. Let's see. Mario wants to know, do I get a replay of the 2-day class?
No, the class is live. You must be there in person. But you can call me and email me if you have questions.
Mario wants to know if it includes a platform like MetaStock. It doesn't include MetaStock.
No, you would have to go to Jeff if you want charts, and Jeff is not a broker, so you would have to fund an account at a broker. If you want a referral, you can email me, but you can get charts from Jeff, and he can help you with scanning and finding the gaps, and then you have to go to a broker to fund your account.
All right. That's the end of the questions. Thank you, Melissa.
Thank you so much.
So again, if you want to find out about that, what a great opportunity. Good freedom special, if you would. Melissa at thestocksquish.com.
Thanks for having me. Have a good night.
All right. Thank you, Melissa. Thanks for coming.
Thank you.
All right. Let me do this. I'll go ahead and kind of make just a few changes here. Change myself to the presenter here. I want to say real quick, I know we're running a few minutes late, but we're also coming into the home stretch as well. So we've been chronically late today. We always are. Anyway, before we move on to our keynote or our final speaker for the day, I do want to say thank you to Stocks and Commodities Magazine for sponsoring the event. They do a great job. We really appreciate the support that they've done. I also want to say thank you to AAII.com. Now, if you're watching the event today on YouTube and you just kind of stumbled across the stream, or what you should do is you should go, if you are watching on YouTube and you haven't registered yet, go to metastock.com/trader summit. You can sign up for a free issue of Stocks and Commodities Magazine. You can sign up for a ton of other free bonuses from all the presenters today. So you should do that if you haven't. And there you go. Thank you, Stocks and Commodities. Also, thanks to AAII for their sponsorship as well. I do want to remind you before we go to the last speaker that we are running a Summit Freedom Pack today, or the Summit Traders Pack. If you want to take advantage of all of the great add-ons that we talked about for MetaStock, you can get Steve Bigelow's Candle Profit System number 3. You can get Steve Primo's Momentum Strategy number 4. You can get AAII Conviction Plus, Oscar Carboni's Trendlines course, Adrian Manz's Around the Horn, the 3-month subscription to learnmetastock.com, and Unleash the Power of MetaStock. All of those are some really, really good add-ons, some really, really good products, some really, really good training. Normally, if you buy them separately, it would be $3,987. Am I not sharing my screen? What are you trying to tell me, Greg?
Well, I just wanted to point out that
there's that fancy little Q code now on the screen that you can see on YouTube, and it does work. If you point your camera at it, it'll take you right to the website. It's just a new thing I did, and I just wanted people to know that it worked.
Okay, so if you're watching on YouTube, you can take a picture of that, and it'll take you straight to the order page. So thanks, Greg.
Sure.
Or if you just want to, you can go to metastock.com/summit-deal. You can give us a call at 800-882-3040, or you can go to metastock.com/sales-chat. So a big thank you to everybody so far today. It's going great. Greg is normally not in the office. He's been in here. He's making some really fancy changes to modernize our whole setup. So appreciate that as well. Our next guest is Dan Sugar. Dan is going to talk about trend lines. Remember how I talked about trend lines and breakouts and all that kind of stuff? He's going to talk for a whole hour about it. So he always does a really, really good job. We've had him on well, we've only had him once, but I've also seen him present a number of times, and he always does a good job. So we're going to go ahead and bring him in here, get him started. Dan, I know we're starting you a little bit late, but let's get you going. There you are.
Good afternoon. Welcome, everybody.
Welcome. Okay, let's make you the presenter. I don't want you to be too worried about time. I know we're starting you late, but you're literally the last person, so you can literally, close it up. We're not going to be worried about time after you're done. So, in any case, I can see your screen. I can see you. You're coming through loud and clear for me, so I'm going to get out of the way. It's your turn. Go.
Awesome. Thank you so much, Jeff. Great to be with everybody, and thanks to MetaStock and all the sponsors. I was thinking 15 or 20 years ago, I would have said something like they save the best for last, but the market humbles me every day, so I'm not going to say that. Anyway, I see a couple familiar folks that have received my education before. I think AJ Hasty's in the house and Doc McGinn, and I believe Mary Jo. There might be a couple others, but welcome, everybody. We'll dive right in, folks. We got a great presentation on trend following and trend lines. If you talk to any successful trader and ask them what do they do or what's a good thing to start with, and the trend is your friend, right? The trend is your friend until the bend at the end, and the bend at the end is also called the trend line break. So it's got a long history, many decades, actually 100 years. We're going to go through some of the history this afternoon, some of the application, the risk reward, how to draw them. I learned them from a very successful hedge fund trader, so I would definitely take some notes, take some screenshots. Some of you, this is your third or fourth or fifth presentation today. Get up and stretch your arms, stretch your legs, and get rocking and motivated for the last one, the final stretcher. But maybe this is only the only one you saw today. Great, but either way, we got some great information that'll be informational and definitely can be transformational. Definitely both. So buckle up and let's dive right in. There's my website. So we're going to go about 30 or 35 slides, folks. And then at the end, the last 10, 15 minutes, we'll do a combination of questions, Q&A, and I want to take a look at MetaStock and go to the charts. So I have a couple charts I want to show, and then you guys can type in a symbol, Apple, NVIDIA, Meta platforms. I was going to say MetaStock, Meta, Facebook platforms, etc. They just had the announcement about the new Twitter the application, so you guys can type in a symbol and we'll take a look at the trend and draw some trend lines, just so you know that I'm not piggybacking anything. We'll take a look at any symbol you want, stocks, futures, etc. Here's our government risk disclosure document, and trading can be risky. Don't risk capital you can't afford to lose. And my number one saying is, if you don't manage risk, you're not going to have any risk to manage. I always, in my emails to my database or my presentations or my videos, always say, good afternoon, risk managers, because the bottom line is the risk manager is your number one job in this trading and investing game. Risk management is super important. So there's my little ethos and tagline: integrity, transparency, performance. Quick 30 seconds about who I am. I'm the third generation Chicago floor trader. My father, my grandfather were both floor traders. My grandfather passed away before I was born. I'm the youngest of four, and my dad was the youngest of five. So Grandpa passed about 5 or 6 years before I was born. But he was at the Chicago Butter and Egg Board before there was S&Ps and Euro currency and T-bonds and soybeans. There was butter and eggs, and he traded butter and eggs on the floor 1900 to 1920 or so. And then my dad started at the Board of Trade in 1950 and retired in 1985, so about 35 years trading. And he was the largest spread broker in the 70s. He struggled in the 50s and 60s for a while. And then in the 70s, is the right place at the right time. The grain markets were seriously volatile. Soybeans, wheat, and corn. And again, him and his partner were the largest spread brokers in the soybean pit. And then he also traded. He was a spread scalper and spread broker. So I got my first job in 1980 with E.F. Hutton. Anybody that's been out there for a while remembers E.F. Hutton. There was the old saying, when E.F. Hutton talks, people listen, right? They were with Merrill Lynch as far as the number one, number two broker dealers at the time. There's some of my trading cards when I was learning how to trade in the early 80s. And the last presenter on the list was talking about interest rates. And, this is when interest rates were in the early 80s, 80, 81, 82. Your mortgage was 12.5 or 13 or 14%. T-bonds were trading in the 60s. Right now they're 135 or 140 or so. They got as high as like 170. But this is when bonds, there's an inverse relationship between price and yield. When price is at 60, yields are at 12.5 or 14%. And then when bonds are at 125 or 140, they're at 2.5, 3, 3.5, 4%. So I kept some of my cards for nostalgia. I'm learning how to trade at 16, 18 years old as a runner in the summer. So in case you've been watching 4 or 5 presentations, here's 3 little quick slides to light things up a little bit. But here's a federal court decision, and the defendant looks back at his attorney and says, "Don't worry, I've watched a lot of Law and Order. I got this. You're in good hands, right?" What? And then here's an aviation one. I've just finished a YouTube video on 747s. We'll be taking off shortly. Buckle your seatbelt, right? And the last one, there's this person on the surgery table looking in his surgeon's eyes. Of course I can remove your blood clot. I've got Wikipedia. And the moral is, you got to get some education, folks. You got to learn from somebody that's been through the trenches, and you got to get a mentor somewhere down the line and get some quality education. Here's a slide about if at first you don't succeed, try doing what your instructor told you the first time. But there's so many benefits. I was very fortunate. I had some great mentors in my trading days. On the floor, I had 2 or 3 guys that cleared their trades through the same firm I traded through, Shaq and Karlov, and I'd see them in the office in between, everyone had their own office. Every clearing firm had their own office. So you'd see a bunch of traders in the office. You'd see them on the floor in the pit. Then you'd see them in the office. And a couple of guys took me on the wing and noticed I was new. So I had some mentors there. And then I learned trend following from a very serious, successful hedge fund trader that I learned with from 2010 to 2013. He took $1 million hedge fund to $1 billion in 10 years. He worked for 10 years for JP Morgan on the Forex currency desk, learned how to trade from an institutional perspective. And then he always dreamed about opening up a hedge fund and trading. And so he opened up $1 million hedge fund in 1997. And by 2007, 10 years later, it was the net asset value was over $1 billion. So $1 million to $1 billion in 10 years, trading trend lines and some chart patterns. I wrote an ebook about 15 or 18 months ago, trend following and trend lines, how to accurately identify the macro trend and locate high probability interest to join it. We'll take a look at that a little bit later. So the theme and the topic is how to identify the macro trend and trade with it. The market, any market, currencies, crypto, individual stocks, stock index ETFs, stock index futures, gold, crude oil, they can either be going up, sideways, or down. So you got a 33% chance of picking, if you know absolutely nothing about trend, you got a 33% chance of getting it right. But once you get some knowledge and you can, look at a chart pretty quickly and identify the trend, that's a huge nugget to learn, to be able to look at a chart on a higher time frame, weekly, daily, and discern the trend and then draw an accurate trend line will be of great importance to everybody. One thing I want to mention too is a great way to become successful as an investor or an active trader or a day trader, swing trading, day trading. You want to define what kind of trader you are based on your time availability, your capital, your goals, etc. Know thyself, right? I forgot if it was Pluto or Plato or Socrates, one of those smart Greek philosophers or Greek gods. Know thyself. Pluto, not Plato, or Plato, not Pluto, excuse me. But really, in trading, you got to know yourself. So are you a day trader? Are you a short-term swing trader? Are you a longer-term position trader? Are you an investor? There's 4 styles, okay? And so you can do 2 of them. You can pick, you can do some day trading and some swing trading. You can do some swing trading and some investing, but, you don't want to try to master 3 or 4 of them. But to get really good at something, you want to master one strategy, right? Some people read a book or watch a webinar or pay for some education, and they'll do a couple trades and, have a couple losers. Oh, that doesn't work. And they give up on it. Then they go to the next, shiny object type of thing. But, you want to pick one strategy, back test it, and get really good at it. Get really good at it. Down the road, if you want to grab one more maybe and have a second one, okay. But the first, 5 years, learn and study one strategy. It might be gaps, like the last presenter. Those are awesome. Pro gaps and gap and goes, etc. It might be MACD or Bollinger Bands or divergence with RSI or Fibonacci. Or for me here tonight, it's going to be trend following. And again, I've been around the markets a long, long time. I'm not here to shame any other strategy, but trend following and trend lines has been around for 100 years, and you're going to see the history in a minute. And hedge funds, banks, institutions are all, I don't want to say all, but the majority of them are trend followers to some degree or another. If you're familiar with the Market Wizards, that series of 4 or 5 books from Jack Schwager, the majority of the Market Wizards interviewed floor traders, screen-based traders, institutional traders, prop traders, hedge fund traders, whatever. The majority of them mentioned trend following in some way, shape, or form. And then the Chicago Turtles, if you're familiar with that story, if you're not, Google Chicago Turtle trading. But some of you are familiar with that story already. The turtle traders, Richard Dennis, all of Richard Dennis's turtle traders were trend followers. So again, over 100 years of data. And so I can't find anything else that generates more low risk, above average reward, above average probability opportunities than trend following. Okay. And so you're here to learn more about it this afternoon. And so 5 things you must know for success. Okay. Absolutely. This is my little contribution that I came up with this years ago, but these 5 things for day trading, short-term swing trading, position trading, or investing. Number 1, you need a proven strategy with an edge and the discipline to follow it. That's like a 2-prong. You got to have a strategy with an edge that generates a lot of winners, and then the discipline to follow it. What good is having a strategy if you're not going to have the discipline to follow it? Self-control, discipline, of course, tantamount. Number 2, risk management. Small losing trades are okay. It's a cost of doing business. Some people have a stigma of losing money, but the great way to get over that is to think of your trading business as comprised of revenues and expenses. Your revenues are your winners, your profits, your expenses are your losses, and no business is going to stick around with larger expenses than revenue. So get over the stigma. Nobody bats 100%. If you're on a webinar or on YouTube and they say, I got a system that generates 100% winners, run the other way, and then you'll thank me later. But the good news is we're going to cover some math in a minute as well. You can be wrong half the time or more. You can be wrong as much as 2/3 of the time. If you have good risk management and you let some winners run, you can be wrong 2/3 of the time and make money. In other words, you can make 100 trades in a month or a quarter and lose on 67 of them and win on 33 of them and make money. If you have good risk management and you let some of those winners run, some of the winners, 3-1, 4-1, 5-1. So risk management, number 2. Number 3, proper position sizing. That's very, very important. Don't trade too large. Even if you're trading with a $250,000 IRA or $1 million IRA or a $200,000 cash account, don't trade 5,000 shares of Apple or 5,000 shares of Nvidia or 10 big ES minis, not the micros, but the regular ESs, or 10 crude oil. Start small, baby steps. Trade small, grow tall. We used to say on the floor, you can make good money trading 100 shares, 50 shares, one contract or a couple contracts in the micros. But position sizing is very, very important. Number 4, understanding the probabilities. Successful trading is a game of probabilities. If you're a good 5-card blackjack or 5-card poker player or 7-card Texas Hold'em or a blackjack player, that's not a bad thing. You understand risk reward and probabilities, and successful trading is all about probabilities. And the risk reward relationship. Risk 150 to make 450. That'll be a 3-to-1 risk reward ratio, right? Or risk 200 to make 600. Or risk 250 to make 1,000, 4-to-1. Okay, you can't risk, $200 to make 75, or you can't risk 250 to make 150. And I've been on webinars and I've seen people talk about it. You've got to be right 75, 80, 85% of the time if you're going to risk more than the reward is. And I've seen some people on like those prop trading firms, Top Step and Apex, blah, 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 in these chat rooms, that they risk, twice as much as the reward. I mean, that's insane, from my style and my humble opinion. But, as we used to say on the floor, and Doc has heard me say this, Mary Jo and AJ probably, but we used to say on the floor, you don't want to eat like a bird and poop like an elephant. Most people, new people, excuse my French, but most people let losses run and they cut their winners, right? Because of greed, fear, and everything in between. You got to do the opposite. Cut your losses, let your winners run. Cut your losers, let your profits run. You have to have a methodology that helps you do that. So very, very important. Risk reward and probabilities. And then the last thing, your edge starts in your head, a sound psychology and solid mindset. You can have all the knowledge in the world. You know your platform in and out, MetaStock. You know your platform. You know your brokerage firm for stop orders or market orders, limit orders. You know your charts, you know your strategy, but then it boils down to discipline, self-control, and your mindset. How are you going to bounce back from 3 losers in a row, or 3 small losses in a row, or 4 losers in a row? Good systems are going to have 4 or 5 losses in a row. How are you going to bounce back from that psychologically? Here's a good scenario. Let's say you have 4 small losses in a row: 150, 200, 1.25, 200. Now you're down 5.25. Let's say. That 5th trade is a great setup, perfectly that jives with your system and strategy. You don't pull the trigger because you're tentative, you're hesitant. And of course, that's the 5-to-1 winner. $600, you could have risked, 150 and made, let's say, 750, 5-to-1, but you didn't take it. And if you would have taken it, you would have made 750, and that would have erased all 4 of your other losses. Anybody been there, right? But that's part of the psychology you have to master. So a sound psychology and solid mindset, very, very important. So those are the 5 things you got to have to, I call it the five-legged table. If you miss one of them or 2 of them, you're not going to be successful. All right, so this is actually a screenshot from a webinar I was on, and I'm like, I got to grab that because this is like, how do you trade that? You got some Fibonacci lines, you got some trend lines, you got some moving averages, you got some Andrew's pitchfork or some other stuff. I don't even know. You got some pivots on there. That's a hodgepodge. By the time the trade sets up, you're going to miss it, and it's hard to. I like to keep things clean. Here's how my charts look. I'll show you my MetaStock charts as well towards the end there. But clean. I have my highs and lows, supply and demand, institutional zones, etc. Resistance or supply, demand, resistance or support are used interchangeably, and I have my trend lines and patterns. And I love the KISS method. You've probably heard about it. Keep it simple, students, right? Right, Doc? Mary Jo, keep it simple, students, right? But if you want to have your charts look like that, that's up to you, but you're not going to make money, in my humble opinion. Keep it simple. So if you've been around the game for a while, you've heard of John J. Murphy. He wrote a couple great books in the 70s, Technical Analysis of the Financial Markets. He started, or one of the original partners of stockcharts.com. But he wrote, the trend line is perhaps the simplest and most valuable tool available to the chartist/trader. Simple and most valuable. 2 great things in my book, right? So very, very important. He also says the violation of a trend line is often the best warning of a change in trend, from an uptrend back to a downtrend, or from a downtrend back to an uptrend. And do they all work? No. But a lot of them do, and a lot of them are 4, 5, 6, 7-to-1 reward to risk setups. We had a great trend line break Thursday night. It started Wednesday night and then continued Thursday. And I think Doc saw my Twitter. It was a great double top and a potential trend line break. and then Wednesday night, and then Thursday morning, some great follow through. It dropped 45 to 50 points on 8 to 10 points of risk on a daily time frame. So that was just it was Wednesday night and Thursday. So on the S&P daily chart, NASDAQ as well. But and then they bounced back Friday nicely, but then they closed very weak. They got a big selling pressure tail on the daily chart on the NASDAQ and the S&P. They ran them up early Friday and then ran them right back down and left a big, long, greedy selling tail on the daily chart, which we'll look at momentarily. So, again, this is not Dan Sugar saying this. This is John J. Murphy, okay, about trend and trend lines. So a little backup and trying to create some validation, right? So here's my little Venn diagram. You got to have a trading methodology strategy. You got to have the right mindset, and you got to have risk management. And you put those all together, that's your edge, right? That's your edge. So here's some of the math I was talking about. So if you lose 10%, you got to make back a little bit over 11% to get back to break even. You can do that. But if you lose 50% of your account, in other words, if you have a 15 grand account and after a quarter of trading, a couple months, it's down to 7,500, you got to double it just to get back to break even. And that puts a lot of pressure on you, you know, emotionally, psychologically, plus financially. So keep those losses small. Risk management, of course, is super, super powerful. Got to understand the math. And here's some more math. Again, if you're looking at this as a new side hustle or eventually become a full-time trader, which a lot of people have that goal, you know, $50 a day could be about $12,500 a year. $100 a day, if you can average, can be 25 grand a year, a little side hustle. If you can get $250 a day, 63 grand a year. $500 a day on average, 126,000. And then if you can average $1,000 a day, some days might be 2,500, some days you lose 500 or 1,000. But if you can average over 30 day or 20 or 22 day, you know, trading day month, that's $250,000 a year. So some more math. So some things you learned today, folks. Understand how powerful the macro long-term trends are. They're very, very powerful. Be able to look at a chart quickly and confidently discern if there's a trend up, down, or sideways. Realize the power of buying pullbacks and retracements during uptrends and selling strength and rallies during downtrends. You're trading with the trend, which is what you want to do as much as possible. When you get proficient and competent, can you do some counter trend trades? Of course, but that's down the road after you're competent and proficient with trading with the trend. I want you to be able to identify high probability opportunities or high probability locations where to buy long and sell short using support or demand or resistance or supply. And then all a trend line is resistance or supply on an angle, or an uptrend line is demand or support on an angle. So don't just think of support resistance as or supply demand as horizontal. You know, an uptrend, once it has three touches, is demand on an angle. And a downtrend is resistance or supply on an angle. And the last thing, of course, risk management, position sizing, and psychology. The edge starts in your head. So here's a couple of minutes on the history. Some names from the past. David Ricardo was a great London stock and bond trader in 1790 to 1818. He made a fortune. He's credited with that first saying, cut short your losses, let your profits run on, okay? Which is the number one thing in trading and investing. Been around for a long time. Arthur Cutten, Chicago grain trader, CBOT, early 1900s, stay with the trend. There was a restaurant bar right in the corner behind the CBOE and Chicago Board of Trade, Van Buren and Jackson, right by the sale, called Cutten's for years. And traders and brokers would go there to eat and drink after the close or for lunch or whatever, but that was from Arthur Cutten. Jesse Livermore, reminiscence of a stock operator. You want to size up the market in its trend, right? He also say, you know, sit on your hands, be patient. Patience is a virtue in life, as they say. Patience is a triple uber virtue in trading. Patience to wait for your setups, for your strategy. And then the second part of patience is letting winners run, recognizing when you can make 4 or 5 to 1 on a trade versus just maybe 2 to 1 or 3 to 1 based on your charts. If you're short, where's the opposing support or demand zone? If you're long, where's the opposing supply or resistance area? and let some winners run. A good scenario is, let's say you have 300 shares of a stock. What me and my partner like to do is get out of half and then quarter. So if you have 300 shares, you get out of half, 150 shares at 3 to 1 or 2.5 to 1 or 4 to 1, whatever that target is. And then you get out of a quarter and then a quarter. So if you have 300 shares, you sell 150, lock in some money, move your stops up when you're long, get out of the other 75 shares at 4 or 5 to 1 or whatever. And then you always let that last portion run in case you get a big winner. And out of 10 trades, 2 or 3 of them might go to 7 or 8 to 1. And if you give it some room to let it run, you'd be surprised how much you can make on that last quarter of your position. Or if you're doing micro Dow or micro S&P, micro NASDAQ, let's say you have 3 on. I guess you can't do half, quarter, but you could do a third if you have 3 on, right? If you have 4 on, then you can sell 2 and then 1 and 1, half, quarter. But I like to scale in and scale out. So if you got 3 on and you sell all 3 and that's your trading, okay. But it's great to let 1 run, and you might get 2 or 3 of those per week, or 5 or 6 or 7 per month. That's going to make your month. That last quarter position, either a third, or half, quarter. You can pick. There's not a huge difference between them, but if you can leave 1 contract on, or a couple micros, or 50 shares, or let's say you do 1,000 shares, then you have 250 left, and you get a 6 or 7 or 8 to 1 trade. That's a beautiful thing. Be patient. Let those winners run. Remember that. And in your methodology and strategy, you have to have some kind of way to do that. Whether it's moving averages, trend line breaks, opposing supply demand targets, etc. But let those winners run. You want to poop like a bird and eat like an elephant, right? Wake up. It's almost 6 o'clock. Wake up. We're almost done. Long day. Charles Dow and Dow Theory. He was a journalist at Wall Street Journal. He wrote a series of articles. 1899, 1902, folks. We're talking 125 years ago. He talked about bull and bear markets and trend following. Google Charles Dow, Dow Theory. Some of you are already familiar with it. Elliott Wave expanded on Dow Theory. Richard Schabacher, Technical Analysis in Stock Markets Profits. He talked about trend following. Harold Garley, Profits in Stock Markets, 1935, mentions trend following and trend lines. Edwards and McGee. Some of you folks out there have probably read that. That's a go-to Bible from 1948. Bob Edwards and John McGee, Technical Analysis of Stock Trading. Technical Analysis of Stock Trends in 1948. They talked about trend following and trend lines. And then Richard Dennis and his famous Chicago Turtle Traders, they use Donchian channels, which I believe is in the MetaStock platform. Like a lot of platforms, that's a trend following methodology, and they used them. Also all these people made major contributions to chart patterns as well. Bull and bear flags, pennants or wedges, or ascending and descending triangles. Okay, so there's a big history there, folks. We're not reinventing the wheel. I was thinking the other day, I have a Latin girlfriend that's been here for 10 years, knows a lot of English, but the three best inventions were fire, the wheel, and Google Translate. Right, 3 best inventions ever. All right, charts are used primarily to monitor trends. Another comment from a quote from John Murphy. They're used to primarily to monitor trends. 2 basic premises of chart analysis are that markets trend and that trends tend to persist. Trends tend to perpetuate. Trend analysis is really what chart analysis is all about. Trends are characterized by a series of peaks and troughs, highs and lows. An uptrend, this is the definition of an uptrend, a series of rising peaks and troughs, higher highs and higher lows, higher swing highs. Some people call them swing highs and lows. Some people call them pivots, but they're used interchangeably. A downtrend shows descending highs and lows, lower highs and lower lows, or descending peaks and troughs. Finally, trends are usually classified into 3 categories: major, secondary, and minor. A major trend lasts for more than a year, a secondary trend 1 to 3 months, and a minor trend a couple hours, couple of weeks. So again, John Murphy, folks, a legend in this industry, in this business. Because trending markets offer the best profit opportunities, one of the most basic goals of chart analysis is to define and identify price trends so we can analyze and join them. You want to find 3-touch trend and then draw the trend line accurately and find a good location, a favorable location to join it. Once you define the uptrend, you can't just buy. You don't want to buy the peak and then use your 2% stop or $200 stop or whatever your stop is, and get stopped out, and then nothing worse being correct about the direction but getting stopped out. That's not fun. Been there a couple times in my 3+ decades, but it's going to happen. But you want to buy pullbacks. This is a strategy that goes back many, many, many years. If it's an uptrend, buy pullbacks, buy retracements, buy those sell-offs. They should stop at or near the uptrend line or a good support or demand zone. Sometimes both. Sometimes you have an intersection of an uptrend line and a double bottom or support or demand. Great. And then during a bear market or a downtrend, you want to sell rallies, sell into strength at resistance or supply zones or the downtrend line. A lot of times the market will bounce up and then fizzle out and stop right at the downtrend line. It's amazing how close it gets to the trend line and it respects the trend line. Again, they don't all work, folks. You have to put your stop in, but a lot of them do work. And when you're trading with the trend, your probabilities are on your side and the wind is at your back, right? If you're a sailor, windsurfer, the wind is at your back when you're trading with the trend. Definition of an uptrend, higher swing lows and higher swing highs, pivot lows. The buyers are in control. The controlling swing lows or pivot lows. And all a pivot low is, folks, and we'll get to that in a minute when we take a look at MetaStock and the charts. A pivot low is just, or a swing low is when the market, stopped going down and swung back up, or the market stopped going down and pivoted back higher. And there's no, I've had people tell me, students, well, Dan, trend following and trend lines sound great, but it's very subjective. And not really. If you know how to draw trend lines and get it accurately, it's very objective. It's either there or not. So a swing high or low should jump out at you from the screen, from the chart, and it's where the market stopped going down and reversed, or stopped going up and then reversed back down. It's not subjective at all. It's right there in front of you if you know what to look for. At first, can it be confusing because you got different ones, which one to use? Yes, but with proper knowledge, education, studying, practicing, you'll get it. And then the definition of a downtrend: lower swing highs and lower swing lows. The sellers or the bears are in control. Again, trends tend to persist. Trends tend to perpetuate. A trend in motion tends to stay in motion. How many people thought they're going to get some biology or some chemistry in today's class? All right, I know it's physics, it's Newton, right? But a trend in motion tends to stay in motion until acted upon by an outside force, a news event, FOMC, interest rate cut, whatever. But you'll see it with the trend lines. Here's a good example of this is the E-mini S&P on a daily chart, I believe. This is a daily. Yeah. So there's the COVID drop, February and March of 2020. One of my other favorite sayings: the markets take the stairs up and the elevator down, or sometimes it's the express elevator. And because of fear and greed, the markets climb a wall of worry. And when everyone wants to Katie bar the door, when everyone wants to exit, and those sell stops get hit, plus you got fresh selling coming in. So a downtrend can be new shorts coming in, plus a bunch of novice longs getting stopped out. So you got double the momentum to the downside. But that's a good trend line break right there. That big red candle. We actually gapped down. There's a gap down that day. This is a daily chart. So we gapped down, reverse, and then the next day we broke the trend line. And then there's the MJ retest. I think Mary Jo was in the house, if I'm not mistaken. And again, former student. She had a lot of knowledge about trend lines before she took my class. She took my class, and a short little side story. I have a 4-night class. She started saying, well, Dan, what about that retest? What about that retest? And I was a trend line break guy and trading with the trend. But then she mentioned it like 5 times during a 4-night class, and I started realizing some trend lines break, and it's a clean break. You don't get the retest. But as she pointed out that night of the class in 2020, I think it was the first class when I left my former employer, March of 2020, there's a lot of retests. And just like support resistance, you get a breakout retest, just like trendline breaks. And here's a great example. What does that mean? Here's the trendline break where my cursor is. The next day we opened, ran up part of the day from 9:30 maybe to 12:30, 1:30, maybe 2 o'clock or 2:30. But by 4 o'clock, look what it did. So we came back and retested that trend line very close, within 3 points, 5 points, whatever. But that's the retest. Sometimes you don't get the retest. On the next trend line break, you didn't get the retest. But here's a great example. We call it the Mary Jo retest because she's the one that we coined the phrase because she brought it up to our attention in that class. And it's a great thing. It's just like you've heard of like a breakout. A breakout, sometimes you break out of a wedge or a ascending triangle or a bull flag, and it just goes. Other times you break out, you get a 2.5 or 3 or 4 to 1 trade, but then it comes back and retests, right? You get the retest. Sometimes you get the breakout and you don't get the retest. Half the time or 60% of the time or so, you get the retest, whether it's a breakout out of a pattern, a breakout above resistance, and then a couple days or a couple hours later, you come back and you retest that old resistance sometimes, or you get close to it. It's just breakout retest, and it can be applied to any strategy. And there's we call it the Mary Jo retest. So here's another nice long uptrend with, grab these lows. There's a trend line break, 2-day drop, a little sucker rally, another drop, another rally. There's a great double top. And then we really started trending lower. Another trend line break right here. I don't have the dates in the bottom here, but this is, again, that was March of 2020. So this is, 2 years old or so. We'll get to some current situations in a uno momento. Here's a small one. Again, some of these trend line breaks, folks, work for 5, 7, 10 to 1 on the daily chart or weekly chart. Some work for 2.5 or 3 to 1 trade, and then they don't work. You got to grab your profit, move your stop, down and watch for the reversal. Some work for 2 to 1, 3 to 1 or so, and then it's only like they work for 12 hours or a day or two, and then the original uptrend, goes back into effect and it keeps going up. But others are major intermediate trend changes, and they work for a couple of weeks, and they work for 8, 10, 12, sometimes 15 to 1 risk reward. So you can do options or the stock or the futures. So just like any methodology, some are going to be losers, some are going to be small winners, some are going to be medium winners, and some will be large winners. There's another one. This is QQQs. There's the February 20 drop. Here's a gap below a trend line. The other one, the S&P, we gapped down, and then we broke the trend line the next day. Here's a gap below an uptrend line. That's a very bearish thing, folks. On a daily chart, if you gap below an uptrend line, very bearish. Sell, sell, sell. Get out of your longs and short or buy some puts. And conversely, if you gap up above a downtrend line, the opposite of this one, if you gap up above a downtrend line, very bullish. Does it always work? Of course not. But you just want to put the probabilities on your side. Here's a trend line break for 2.5 days. Small amount, but the risk was, minimal. And then the uptrend resumed. Here's a nice trend line break. This is a little trickier where my cursor is. We closed below the trend line. We closed below a 4 or 5 touch trend line. The next day we gapped down, open up on the left in the green candle, ran up one more time, and then closed below it. So this one is a retest. It got on. It not only did it retest it got past the retest and poked its nose with that little wick above the trend line. But then it closed below the trend line. So just like a gap below an uptrend line is very important. Technically talking, when you gap below an uptrend line, very bearish. When you close below an uptrend line, also bearish. Even though it's a green candle, we gapped down, we ran up one more time, left a big selling greedy tail. We closed below it, and then down, 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 sucker rally, down, 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 sucker rally, double top, and then here's a trend line break and gap and go. How many? 1, 2, 3, 4, 5, 6, 7 red candles on a daily chart. 7 days in a row, down, down, down after the steep trend line break. Folks, some trend lines are 85 degrees, 88 degrees, 90 degrees. Well, not 90, but 85, 88. And then some are 75 or 70, and some are 65. It all depends. But here's a break above a downtrend line with green, 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 about 4 days up, up, up above this downtrend line. We had some consolidation, 4 or 5 days. Triple bottom, and then there's a break of a trend line going back up. A short-term bounce. And then here's another gap below a trend line right here where my cursor is, right over here. Gap below a trend line, 2-day drop, 1 green candle, and then 1, 2, 3, 3 more down days. But look at that signal, risk reward, low. You're always looking for, no matter what strategy you're going to use, the goal is to always locate and look for the low risk, above average reward, above average probability. That's your bread and butter. Like Melissa, the last presenter, Melissa was saying, people with smaller accounts risk more and they're shooters and they're going for the big win. That's exactly wrong. So, risk management, knock out those singles and doubles, and then get the occasional 3-run home run and let those winners run. But you're always looking for low risk, no matter what size of account you have. You're looking for low risk, above average reward, and above average probability. That's what you're always looking for with your methodology and strategy. All right. So, and then here's another trend line break to the upside. We've got a higher low here. There's a low, a higher low, then a little double bottom over here. And then we got above this downtrend line that only had like 3 or 4 touches. And then here's a nice one too. This is actually a bull flag. I should have wrote this downtrend. I should have put another trend line underneath these lows. That's a bull flag pattern. And then we got above it. Okay, so some good trend lines and patterns, folks. Trend lines and patterns. Here's a very important concept. You can use trend lines and patterns for any trading style. Again, there's 4. Intraday, swing, position, and investing. Once you know trend lines, you can use them for your 401k, your IRA, your wealth bucket. You just look at the higher. You're not going to look at a 15 or 30-minute chart for your wealth bucket. You're looking at weeklies and dailies, higher time frames. If you're day trading, then you're going to look at the 5-minute, 50-minute, 30-minute, 60-minute, whatever so your time frames are going to align with your strategy and your goals and what your style. What kind of trader are you? Again, know thyself. And then the other good news is trend lines and patterns can be applicable to any asset class: stocks, exchange-traded funds, options, futures, forex, and Ethereum, Bitcoin, etc. As they say in Boston, a chart's a chart's a chart. How's my Northeastern accent? A chart's a chart's a chart, right? So you can use trend following and trend lines for any style and any asset class. It's universal. It's universal. Once you know it, you know it. Here's one of the trading turtles that work with Richard Dennis. Michael Covell. He wrote several books. Several of the turtle traders that made a lot of money for Richard Dennis and themselves in the 70s and 80s went on to become book writers, hedge fund traders, hedge fund managers in their own fund, etc. Well, Michael Covell, maybe you've read some of his books that he's written, but what type of strategy exactly is trend trading or trend following? Trend followers use reactive technical analysis. Instead of trying to predict, a lot of novices and newbies try to predict, right? Good traders react, not predict. But instead of trying to predict a market direction, their strategy is to react to the market's movements whenever they occur. This enables them to focus on the market's actual moves and not get emotionally involved with trying to predict direction or duration. Okay? So again, focus on the candlesticks. I call it mindfulness charting. What's really happening is the market making higher highs and higher lows? Is every pullback bought with aggressive buying, or in a bear market, is every little rally met with strong selling and we make lower highs and lower lows? So be mindful of what's really going on. Mindfulness trading and understanding candlesticks and momentum and patterns and trends will help you do that. So anything you can read from Michael Covell is good. Huge trend follower. And on my charts, I don't use MACD or Fibonacci, RSI. The only thing I use as far as indicator will be moving averages, because those are called dynamic trend lines. I'll use a simple 5, 10, 15 moving average on a couple time frames. My 10,000 ES volume chart, I use a 10,000 volume chart for short-term intraday. So it's not based on time, it's just volume, 10,000 contracts on the ES. And then, 15 or 60, whatever. I love the 240 chart and the 480 for futures, 480 and the 240. But I do use 5, 10, 15 simple moving average just to help me with the trend. And I look for those crossovers. My trend lines are rigid, So my trend line break is going to get you in earlier and at a better price than when you get the crossover 2 or 3 or 4 candles later. The crossover can still be a good confirmation entry, but trend lines are leading indicators. Moving averages are lagging. Sometimes they're only lagging by a little bit, but they're still lagging. Make sense? But that's the only, and I'll use volume profile also. I like volume profile, which is a whole other webinar, web class. But that's it. No other indicators. All right. One major tenet of technical analysis is that prices of equities and stock indexes and ETFs and currencies in all markets move in trends. Markets do not jump up and down in a random fashion. On the contrary, they show definite organization and structure in their chartered course. You can argue that like on a 1-minute chart or a 5-minute, there's a lot of riffraff and noise, but on those intermediate and higher time frames, there's a rhyme for every reason. I mean, there's structure and organizational, and the market's doing what it's doing based on order flow and supply, demand, fear and greed, all the above. During an uptrend, we want to buy long, buy those pullbacks, retracements to uptrend lines that has 3 touches. Excuse me, you have to have 3 touches for an uptrend. So you have a spike low, you get a higher low, then you go up, you have a higher low. Once you get 3 higher lows, you have an uptrend. You have 3 higher lows, you draw the trend line. Once you have I should do it down here. Once you have 3 higher lows, you draw the trend line. And you want to buy pullbacks. The 3rd touch is a signal. Don't draw it and then wait for the 4th touch. The 3rd touch is confirmation that you have an uptrend. And your sell stop for risk would go just below the trend line, whether you're on a 5-minute chart or a weekly. On a weekly, you might have to risk, $1,000. On a 5-minute, it might be $50 or $20 or on a micro. So risk is going to always be commensurate with your reward. The higher time frame, risk more, reward more. Lower time frame, risk less, make less. And during a defined downtrend or bear market, we want to sell short the rallies back to the downtrend line to join the downtrend. Find ways to join the trend. The probability of a trend continuing is a lot higher than the trend ending and reversing. There are some good trend line breaks that do reverse eventually after a quarter or 6 months or sometimes 5 or 10 years. The stock market had a monster bull rally from March of 2009 to January 2022, right? So 13-year bull market. Were there some 5 and 10 and a couple 18 or 20% dips during that time? Of course. But every time the market rebounded because the Fed was in a dovish policy, lowering rates all the time and buying bonds and the whole interest rate policy of the Fed. Now they're telegraphing they're still raising rates. So I'm a little bearish here because don't fight the Fed. As Marty Zweig said many years ago, don't fight the Fed. When the Fed is dovish and they're lowering rates and buying bonds and you want to buy stocks, you can't just buy anywhere. Find a strategic spot, support, demand, pull back to a trend line, etc. Bull flag breakout. But you want to be long stocks when the Fed is lowering rates. You want to be out of stocks and into bonds when the Fed is hawkish and raising rates, which they've been telegraphing since the spring of 2022, year and a half now. It's not over, folks. Will there be some crazy upside moves, even though the Fed is hawkish, like NVIDIA and AI? And of course, there's going to be some sectors and some momentum. That's technology, of course. AI has been going ballistic to the upside. How much longer is it going to last? The breath is not there right now. A rising tide lifts all yachts, right? Well, now the market rallying is just, the indexes are rallying on a handful of stocks. Tech, Facebook or Meta, NVIDIA, Microsoft is big in the AI, etc. So be careful. It could continue, but once those AI stocks start to maybe get frothy and break trend lines in the weekly or daily, it's going to bring the whole house of cards down potentially. Okay? Be ready for that. It might be 6 months from now. It might be in October, September. And then also be aware of a trading range market or non-trending, trading range market. Sometimes the QQQs can go in a $3 or $4 or $5 trading range from 120 to 116 for weeks and months. Every time it gets to 119, 120, it's a short. Every time it gets to 116, 115, it's a buy. That's a $4 or $5 trading range. Eventually, it's going to break out and either go higher or lower. But some markets or stocks or futures go into a trading range for prolonged periods of time. Define the range and trade the range. All right, 3 major applications. This is an important slide, folks. How do we use trend lines? There's 3 major applications for using trend lines as part of your strategy. Number 1, to lock in profits on existing trades or investments. If I'll show you Netflix. The first chart on MetaStock we'll go to is Netflix. If you were long Netflix 4, 5, 6, 8 years ago, you don't want to be subject to that 90% drop or 80 or 85% drop it had. It was the best stock for 5 or 6 or 7 years, but then, man, did it tank. And you would be a terrible investor or trader to be up 15,000 on Netflix over 3 or 4 or 5 years and end up only making, $5,000 or $4,000 or $3,000 or turning into a loss. That would be terrible. So if you drew a trend line on the weekly or daily chart, you could have put a sell stop in to get out of your Netflix when you broke that trend line, and you would have saved yourself a lot of money. So we'll look at that. But lock in profits on existing, or if you're day trading a micro NASDAQ or a micro S&P or a mini S&P, you can put, if you're long, you put your sell stop to lock in profits below a current uptrend line. Okay. Number 2, to locate favorable locations on a chart to join an existing trend using the 3-touch confirmation. So whether it's NVIDIA or gold or crude oil or anything, once you get that 3rd touch, that's your confirmation we have an uptrend. If it's a 3rd touch after lower highs and lower lows, then we have a downtrend. Okay. The 3rd way to help recognize when the current trend is ending and a new trend forms in the opposite direction or reverse, trend line break. After a nice uptrend, when you break the trend line to the downside, you might get a downtrend for a day or two. It might be a week or two. It might be a month or two. Nobody ever knows, right? But all you can do is read the candles and manage the risk and manage your emotion. Here's a basic construction of some trend lines. Upper left is higher highs and higher lows. These are swing highs and swing lows, or pivot lows and pivot highs. There's your 3rd touch right there. You go long, your sell stop goes a little south of the trend line. Once in a while, you're going to get a wick or a tail that's going to come down and get you. You put your stop a little too close, and the momentum carried it past the trend line. It turned to be a wick or tail, and then went back up and closed above it. You got to get in again. Don't chase it, but take it again. Find a spot to get in again and use the same stop. On the upper right, here's your trend line break. No retest, but just drop, pull back, drop, lower high. Get out of your longs. Look to get short when you get to TLB. Trend line break. Here's a downtrend, lower left. There's your 3rd lower high, shorter right there. Buy stop for risk goes above the trend line. And then here's a trend line break to the upside after a nice downtrend. We got above the trend line, breakout, small pullback, and then the market turns on a dime sometimes. Intraday or on a daily chart, the market can turn literally on a dime. And you don't know with the benefit of hindsight, right? But all you can do is take the cues and take your signals and trust your charts, trust the trend lines, and trust yourself. So here's the market wizards and the turtle traders and Richard Dennis, again, as I spoke about earlier. Again, all turtle traders were trend followers. The majority of market wizards that were interviewed by Jack Schwager were trend followers. Here's my bit.ly link for 15 years worth of testimonials. I got between 750 and 1,000 or so social proof and testimonials. If you can click on that link or so, if you want it from me directly, you can email me at dan@trendlinebreak.com, dan@trendlinebreak.com. I got a little document that has the social proof and 15 years of testimonials. And I got some reviews on my Facebook page as well. Trust but verify. So I do have a little MetaStock Trader Summit special. I have a 2-day, 5-hour masterclass all about trend lines, trend following, how to draw them, entries, stops, targets. It's got the 5 basic patterns I love, bull and bear flags, ascending, descending triangles, and then a wedge or symmetrical triangle, 5 patterns that are very accurate. Position sizing, risk management, psychology I cover in depth. You also get 1 hour live consulting 1 week after the class, 2 months after the class. It's all about your time. Whenever you're ready, you let me know, and we'll get our heads together and schedule a live consulting session. It'll be on Zoom, and you get to keep the recording. So I want to make sure you get it. I'll include my ebook as well, a little 25 or 30 page ebook on trend following. We looked at earlier. Normally I sell that for $8.75. Then I got the special for $6.25, and there's the link for that. I think Jeff can put that in the comments somewhere. But nice little savings there for the package deal. Again, the 5-hour masterclass, ebook, and 60 minutes of live consulting. If you want the book only, there's a little bit.ly link for my book only. That's $44.50. And then if you're very serious, I do a little consultation. If you want, a 16-week program of mentoring and coaching for 16 weeks for serious, coachable, and committed traders and investors who want to become consistently profitable, email me. You can book a call on Calendly. We'll go over a 30-minute consultation about your struggles, your goals, etc., what assets you trade, capital, very in-depth, comprehensive consultation, and I'll give you my ebook for free if you book that. Okay, so there's the bill again. If you want to email me instead, dan@trendlinebreak.com, we can set that up as well. Unless you can get that in the comments there for that mentoring program. All right, so I got this from a student in Charlotte, North Carolina years ago. Here's a lady, a couple. She's looking at Valentine's Day, and he's looking at that crude oil trendline break where you can risk 200 to make 1,200, or NVIDIA, or S&P, whatever. But let's take a look at some MetaStock charts, and then we'll wrap things up. Any questions, first of all? Any questions coming in I can address? If there's any questions, I clicked on questions here. Is there a question?
Yeah, Dan?
Yes.
Let's see. We've got, we've got a lot of comments that have come through.
Okay.
Are mostly the charts that you're looking at daily was a question that we had from Curdy.
The ones in the PowerPoint presentation were dailies, correct? But as the slide said, you can day trade off a 60-minute, a 120-minute, a 30-minute, a 5-minute, a 1-minute, a volume chart. Trend lines can be applicable to all time frames. Again, they're universal. So the ones in the slide were dailies, but I can show you on MetaStock some 4-hour trendline breaks, some 60-minute trendline breaks, some 5-minute trendline breaks. Absolutely, all time frames.
Sheik wanted to know, it actually had that exact question. Can you use 5 minutes, 15 minutes, 30s?
Yeah,
Are they effective?
I mean, I personally don't like the 5-minute chart. It's a lot of noise and emotion, and the lowest time frame I go is 15. But some people like the 1 minute, 3 minute, 5 minute. You can draw trend lines and identify short-term trends on those low time frames. Yes, you can.
William wants to know, when do you counter trend trade?
Okay, so that's a great question. So, lately, I mean, since January, the trend's been down. We've had a nice rally for many, many weeks and months now since the October lows, I believe. So you could say the macro trend is down, year and a half, but the micro trend, 12 weeks, 18 weeks has been up. But sometimes you get the macro trend is up and the micro trend is up, or the macro trend is down and the micro trend is down. Other times you get the macro trend up, the micro trend is down, short term, or vice versa. But the question is, when would I take a counter trend trade? Again, I've been doing this a long time. So even though the macro trend might be down, going back again 18 months since January when the market peaked, January 2022, the macro trend has been down, in my opinion. We've had lower highs and lower lows for 18 months now. But since October, we've had a nice uptrend, right? And here's, was it the October lows? Right here, right there. So we've had a nice uptrend. So again, use your charts. Even though the trend might be up, I'll still take a trend line break to the downside as long as the risk reward is there. If I can risk 250 to make 750, or I can risk 500 to make 1500, I'll take a counter trend trade. So if the macro trend is up, markets don't go in straight lines. Otherwise, trading would be a lot easier, right? But even though the macro trend is up, if I get a daily trend line break on the S&P or index or anything, or even a 480 or 240, you might get 12 or 18 hours or 36 hours or even 72 hours. The macro trend is up for months. You might get a 2.5 or 3 day drop of 3, 5, 8, 9%. and I'll take a counter trend trade. So I hope that answers it. But when you get more proficient, you'll be able to take some counter trend trades. Right now, you want to focus on trading with the trend as much as possible. But there will be some opportunities when you get more proficient to take counter trend trades opposite to the higher time frame.
Mario wants to know how much the course is for 16 weeks.
Oh, the 16-week complete mentoring program, that comes with 16 weeks of mentoring. 16 weeks program. It's the 4-night class. It's every Wednesday we meet for 90 minutes for ongoing education for 16 weeks, every Wednesday for 4 months. You get some consulting with that as well. And you get the ebook, you get one-on-one consulting, like two 90-minute sessions, one-on-one only, besides the group coaching Wednesdays. You get 2 90-minute sessions, and then you get the ebook, and that is $6,375, $6,375. 16 weeks of coaching and 4-night class, recordings plus live, and then the ebook and the ongoing coaching for 16 weeks every Wednesday for 90 minutes. And we're looking for trades and, meeting as a group and going over the current markets on those Wednesdays, and then the consulting. So, yeah.
Andrew wants to know, is the 4th touch typically the reversal?
No. A lot of times. See, that's a great question. Sometimes you might get 6 or 8. Like every time a trend line holds, it's getting stronger, right? And you might get 8 or 10 touches and it holds. So whether it's the 4th touch, you never know when they're going to get the trend line break. All we can do is manage our risk and, take the trade, manage our risk, and manage our emotions. All we can do, right? But some trend lines have 6, 8, 10, 12 touches and hold, and they go on for a long months and months and years. I mean, currencies can trend for a decade. Stocks, had the uptrend, from 09 to 2022. So you just watch your trend lines and you wait for a violation of the trend line. Some people like to wait for a close above or below a trend line, right? But if you do that, you might give up a lot of profit opportunities. So I'll wait for the trend line break, on a candle, instead of waiting for a close, because it might close way below a trend line, and you gave on the QQQs, you might give up $2.50 or $3 in reward by waiting for that close. So being cautious can cost you some money, but that's the cost of being a little cautious and conservative. So some trend lines have multiple touches. Some trend lines have 3 touches. You join it, and the fourth time it doesn't hold, and it goes through like a knife through margin or a knife through butter, right? You just never know. But good question.
Last question. Looks like, do you provide text alerts as part of your courses?
I don't have any text alerts right now. No text alerts. I have a swing trading group on Slack with my partner, Maddie Fish. We have a Slack trading group. And just a side note, Maddie Fish was one of my most successful students that decided to stay in touch with me. He struggled for a decade. This is a very inspirational story, folks. 60 seconds, but he struggled for a decade at Charles Schwab. He used to say, make some, lose some. He was spinning his wheels up and down like a yo-yo. He used to say, he's from New York, so it's a yo-yo, bada bing, like Sopranos. But he made some, lost some for 10 years. But he knew he could do it. He knew there was money to be made. He stuck with it. He worked hard in his day job, replenished his account a couple times. And then he had heard some good things about my teaching at the Long Island branch of Online Trading Academy. And then I think in October of 15, he took my class, and then he retook it online in March of 16, and he's made money 7, 8 years in a row now. And then October of 2020, when I won on my own March 1st of 2020, October of 2020, we started a swing trading group, and now him and I are actually managing money. January of 2023, we started managing money. We can only have a certain amount of accounts right now because I'm not registered. Once I pass the Series 3 and become registered as a CTA, we can take as many as we can get. But right now we're limited to 15, and we already have that. But anyway, inspirational. He's been killing it for 7, 8 years now, and he just loves trend lines, patterns. I taught him. He added some of his own stuff, but he knows how to position size. He's extremely patient, and he gravitated towards trend following and trend lines, and he's killing it. He trades his account, his mom's IRA, and his dad's account, and he's a very humble, great friend of mine, and my partner in the swing trading group and the managed money since January. But you can do it, folks. It takes time. He had 10 years of spinning his wheels, make some, lose some, make some, lose some, but he stuck with it, and now he's got a great side hustle. He makes more trading than he makes at his day job, and he makes 6 figures at his day job, and he's got great benefits, but he's close to leaving his day job and trading full time. But anyway, great inspirational story for anybody out there. That's all the questions, Jeff?
We actually did have one more come in.
Sure.
Can use trend lines on the VIX, and that's the last one.
Yeah. Oh, it's tradable. You can draw trend lines on freeze-dried cockroaches. CCR is the symbol, right? No, I'm kidding. But yes, volatility has patterns, trend lines. Absolutely. I read the other day on Twitter, a good friend of mine from OTA, Scott Marigolio, said there's a Bollinger Band squeeze on volatility like Tuesday or Wednesday on Twitter. And he said, well, the trend is up. So when you get a volatility squeeze, he uses Bollinger Bands. When you get real tight, it's not going to stay tight forever. He was looking for an expansion of volatility, and he said the trend is up. So he's looking for the upside, but the market might go down. And I put in there, I'm bearish. I think the market's going down. And then here's the chart. That right here does not look like a big trend line break, but that was 45 or 50 points. The scale's on the left, but that dropped from 44.80 to 44.30. 44.20 was, I think, Thursday's low, 19.50. But that was a big double top, and Doc McGinn saw my tweet. I put a thing on Wednesday night on Twitter, 11 o'clock at night, potential double top on the ES. The volume on this last rally was a lot lighter than the volume on this rally. This is a strong rally. The volume was good. Then we pulled back. We got above a downtrend line. We had 3 or 4 days of up. We made a new high by a little bit, but that's a double top, folks. Write this down, folks. Price has memory. Price has memory. One of my other favorite sayings, double tops and double bottoms are very, very prevalent. Give or take a couple pennies or a couple ticks or a couple points on the futures, but double tops and double bottoms. The market's giving you a second chance. Like the market's telling you, like if you were long and you didn't sell here or you didn't sell short there, I'm going to give you one more chance before I go down, right? They don't all work, but there's a lot of tradable double tops, double bottoms, low risk, above average reward, above average probability. And then exactly what, and Doc said on Twitter, I'm right with you, Dan. He caught that trend line break as well Wednesday night and Thursday morning. And there it was right there. And that was 45, 50 points on 7 or 9 points of risk on either intraday or a swing trade overnight, either way. But double top with a trend line break. There's a wedge right here, folks. A little squeeze, talking about a Bollinger Band squeeze for volatility on the VIX. But here's a squeeze, getting tighter and tighter. There's a symmetrical triangle. And all it is, folks, is 2 intersecting trend lines. A downtrend line, I want to introduce you to an uptrend line. Getting tighter and tighter. And you have 2.5 days of strength. And what's this called? We talked about it earlier today. What's this called on right here? Anybody? You got the breakout. And then you have the 2-day drop. Look where it stopped. Anybody know what that's called? Can I see the comments or chat? Well, in the sake of time, there's your retest. There's your breakout, retest. The market likes to go back to the scene of the crime, as I call it. The market likes to go back to the scene of the breakout, give you one more chance to make the right move. I call it the apex revisitation trade. Here's the apex, right? There's the breakout, and there's your retest. Sometimes you break out, folks, and it ain't coming back. It ain't coming back. Half the time, 40, 60% of the time, you get the retest. So you get 2 trades out of it. There's the wedge breakout, 3-to-1, 4-to-1, 5-to-1 risk reward. And you could have got long again at this, support zone, apex revisitation trade. And then the second rally was the bigger one. Sometimes the first breakout's the best one. Sometimes the second one is, you never know. But there's a great wedge. Here's one more wedge, a couple, when was this? January 6th. So there's a drop, then you get tighter and tighter, and then you break out. And there's the retest right there. Right? And you break out of a wedge. Just draw your trend lines, attach the highs. It's about the wicks and tails, not the body. It's about the wicks and tails. So you draw the highs, you draw the lows. The market gets tighter and tighter until inertia, breakout. Do they all work? No, but a lot of them do. You want to trade when it's trending, not that chop and slop. I coined that phrase. If you go to the United States Patent Office and Google chop and slop, it'll say Dan Sugar. But day trading or swing trading, you don't want to trade. You don't want to get chopped up in that chop and slop. You want to trade when it's trending, whether it's a breakout or a third touch trend line or reversal trend line break. Trade when it's trending, not get caught up in that chop and slop. Much less stressful, folks. My goal is to make trading as least stressful as possible. Namaste. See you next time. No, I'm kidding. But seriously, if there's ways you can make trading and investing less stressful, do it. You know, you don't want to be day trading like this on a 1 minute chart, and you got to stay emotionally under control, manage your risk, be patient for your signals, be patient for the trade to develop, and be patient for letting your winners run. It's easy to talk about it, but once you have live money on the line and you have skin in the game, a whole different ball game emerges. But if you have a plan, a strategy for risk, a strategy for losses, a strategy for winners. Once you have a strategy for losses and winners and revenues and expenses, then fear and greed is the other guy's problem, right? You'll still feel a little bit of it, but if you have a plan where to take profits, move your stop, where to cut your loss, you're going to be much better off than everyone else that doesn't have a plan and is overly emotional. So anybody got a symbol that want me to look at real quick? Anybody? Caterpillar, NVIDIA, any crude oil or gold? Anybody type in? Where's the? I guess. Anybody have any? Click to read your unread chat message. I tried finding that. That's Jeffrey to all entire audience. Anybody? Thanks for putting those Bitly links in there, Jeffrey. Anybody have a symbol? Type it in. If not, we can wrap things up. All good with me, but. Here's the chat questions. Yeah, I'm big on Zoom. I don't know. GoToWebinar is good as.
We're starting to get a few. Andrew wants to look at Citi.
Citigroup. Okay, let me pop in Citi.
I don't think we. Citigroup. C.
And then just okay. Is the daily okay? Daily okay?
Sounds good to me.
Okay. So here's Citigroup. Let me draw a couple trend line breaks and draw some trends. Okay. Here's an important candle, folks. Here's one more really nugget of information, folks. Here's a nice uptrend. There's one. You make a spike low or swing low. There's close enough for touch number 2. There's touch number 3, touch number 4, touch number 5. So after touch 3, we went from 47 and change to 53 and change. So about $6, 550, 10%. But this candle right here, folks, that's a reversal candle. Heads up, alert to trader. Look what happened. We made a new high for the move. That's a new multi-week, multi-month high. But we closed lower. One candle gave you a lot of information and knowledge about who's in control, right? We didn't break the trend line. But that one candle said, wait a second, if the bulls are still in control of this Citigroup, where should that candle have closed? At or near the upper quarter quadrant. And it closed lower. We made a new high for the move. That's February 2nd. We haven't been that high since August, so that's a 4 or 5 month high, but we closed lower. And then the next day, what we do? Gap down. You had a 2-day a 2-day move lower, sucker rally. There's close to a retest, but then drop, another sucker rally, double top, drop, double bottom, and then there's another rally. One more little rally. It's a sucker rally, folks. Draw your trend line, and look at that. There's 1, 2, 3, 4, 5, 6 touches. But once we got below about 51 and change, 51, what happened? The uptrend is over and a new downtrend. I know it looks easy after the fact, folks. I get it. I'm a phenomenal hindsight trader. My old website was www.hindsight.com. I'm kidding. But we don't know it's going to go from 51 to 42. We don't know that. But we do know when you break an uptrend line, you want to be out of your longs and short. You want to be out of your longs and long puts or short to stock when you break an uptrend line. We don't know how far it's going to go, but once we broke 51, down, there's a doji indecision, down, 1 day up, down. 51, your stop was 51.90. You're short at 51, so you got 90 cents of risk. It went about $9 or $10. $9. 42.01 was the low. $9 move in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days. $9 move on 90 cents of risk. That's 10 to 1. Quick math. Some trendline breaks are 3 or 4 to 1. Some are 8 or 10 to 1. You never know. But there's a good Citibank trendline break. Some double tops. Currently, we got lower highs. Let's look up and to the left. Grab that swing high. It should be obvious, folks. That's the swing high. It stopped going up and swung back down at that peak. And then here's your trend line. We didn't get quite to it. We got close to it here. But that high is lower than that high. This high is lower than that high. This high is lower than that high. There's 4 lower highs. This trend is still down on Citigroup. Looks like.
All right. Mario asks, again, for a beginner, would you recommend this to study the 625 or go directly to the hedge fund course?
The 625? It all depends on your goals and your resources and, your resources basically and how much commitment you have. I mean, it's a big separation in price, obviously. But again, depending on your goals, your resources, and, if you have the capital, that's, in my opinion, that's the way to go because that's a lot more comprehensive than the master. The master class is 5 hours, 2 days. The group coaching is, the full course is 4 3-hour sessions, so a total of 12 hours. You get to keep the recordings, and then you get the 16 weeks of mentoring as well. But again, I'm not here to sell anybody anything they don't need, but depending on what their goals are and their capital, I got a lot of social proof and testimonials of trend following and trend lines was the game changer. I'll be happy to send you the link for the the testimonials and social proof. But it can be a game changer if you apply what you learn. Can I sit here and say everyone that takes my class, is insanely profitable? Of course not. That would be, insane to not everyone stays in touch and blah, blah, blah. But I can't prove if they apply what they learn in the curriculum, right? But the ones that do apply what they learn, it's comprehensive. It's just, trend following, trend lines, psychology, risk management, position sizing, and patterns. So it's very comprehensive. The master class is, about a quarter of that roughly or so. But anyway, yeah, good question though. But yeah, so here's a couple more trend lines on Citi. Anybody else have any other?
Yeah, I mean, we're out of time, but I think we can squeeze another one in.
Okay.
CCL, if you have a chance.
What's
if it's okay with you?
Yeah.
CCL, Carnival Cruise Lines.
Oh, sure, Carnival. Yeah, they've been volatile. Choose instrument and CCL. Carnival ORD. That's the Chicago airport. Is ORD. Oh boy, yeah, Carnival. Okay, so let's go back a little bit. Let's just go back a little bit and draw a couple trend lines quickly. There's a gap down below a trend line. Remember, when you gap down below a trend line, that's very bearish. There's a trend line break with a lower high. There's a gap up. There's a gap up, and then a Harami inside candle, and then a couple days later. Look at all those red candles in a row. Once we broke about 24.50, we went down to 16. There's about an $8 drop on a $25 stock in 2 weeks back in November of 21. But I'm just trying to pick some trendline breaks to show people how powerful they are. I can draw them in my sleep, folks. I've been in front of the screen since March of 1996. So, but there's some great, and you can have 2 trend lines off the same pivot, right? There's 2 different ones. And there's one of those reversal candles, folks, right here again. Here's a new high for the move. We gapped up and had no follow through. We gapped up that day. Today's opens above yesterday's high. We gapped up. It's like a 3 or 4 week high, but then we closed lower. Very bearish candle. The next day we gapped down below an uptrend line and went down, sucker rally. The second trend line break was bigger than the first one. The first one made money. The second one was the big mammoth jamma. Sometimes the first one's the big trade. Sometimes the second one's the big trade. You never know. But currently, let's see. Where did we get above a downtrend line? Here's where we got above a downtrend line to indicate that the downtrend is over and a new uptrend is starting. Right here, we made a higher low. Here's the low, December. Here's a higher low, and there's a higher low. So let's draw this. There's your uptrend, and then there's your little wedge or compression, and then there's the breakout, small retest, breakout, small retest, but higher highs and higher lows. But once we got above 970, 990 or $10, once we got above 980 on Carnival, the downtrend is over. A new uptrend or bull market might be starting. We don't know it's going to go to 19. We don't know that. My crystal ball's in the shop. I can't find a mechanic to fix it. But we do know if we get above a downtrend line, it's bullish. Above a downtrend line is bullish. Below an uptrend line is bearish. And we never know how far it's going to go. But we got higher lows. There's the trough in October. So there's another low. So there's your higher lows. And then if you want to draw a little bigger picture, we might have multiple trend lines right there. So again, once we get above $9, $9.20, there's a little apex wedge. One more thing I'll leave you with. Another old saying I learned from the floor. Doc's heard it. If Mary Jo's still in the house has heard it. A new move comes out of the middle. A new large directional move comes out of the middle of an old move. Your apex or a wedge breakout. A new move comes out of the middle of an old move. And it's just two intersecting trend lines, folks. Downtrend line meets uptrend line. There's your breakout. A new large move comes out of the middle of an old move. And there's one more downtrend line that was broken November of 2022, November, above 870. And this thing went to 12.15. So there's over a $3 move in a couple of weeks above that downtrend line. Again, I know they look easy after the fact, but once you know how to draw them, the trades will jump out at you. They're not all winners. You got to manage the risk, but a lot of them are nice winners. A lot of them. Trend line break. That's my website. Look at that one. We closed below it by a little bit, and then we gapped on the next day. And once we went from 1030 to 6. There's a $4 move in 2 weeks, and there's a bear flag, by the way, with a gap. Last thing I'll leave you with. It's been a long day for a lot of people, but there's a bear flag right there. Here's your pull, a little sideways to higher, and there's a gap down. That's a bear flag, folks. Impulse, correction, impulse. Trend lines and patterns. That's all you need. Some psychology, risk management, and position sizing. Put all those things together will go a long way. All right. Thank you so much, Jeffrey. Hope everyone got a nice little Cliff Notes version of trend following and trend lines and some nice nuggets. Email me with any questions. Hit those links.
What's the email address? Let's put it in the comments again. Also, a couple comments for you. Anise said, great last presentation. We'll surely replay. Great lessons. Thank you, Dan and Jeff and MetaStock. Marco Polo, which I'm sure it's his real name, says good info. So, and what a great name. Your mom. No, I'm just kidding. I'm sure it's just a handle. What's your email address? Let's go ahead and put it in the chat again.
Dan at trendlinebreak.com.
And then one last question.
Yes.
And I've said that for about 15 questions in a row. But do you have one tip? Just one tip to help people develop patience.
One tip to develop patience. You just have to be patient. And we spell patient, by the way. We spell patience P-A-Y because patience pays. So it's not P-A-I-T-E-N-C. It's P-A-Y hyphen T-I-E-N-C. So we've been spelling patience like that for a while because patience pays. But you just have to, less is more many, many times. I think, less is more. So don't overtrade. Be patient. You have to realize when you have a sound methodology strategy, there's going to be more winning trades and more good setups an hour from now, 20 minutes from now, 2.5 hours from now, or 2 days from now, or a week from now, depending on your time frame and what kind of trader you are. But when you have confidence in your methodology and strategy, it's going to generate a decent amount of a low risk, above average reward, above average probability opportunities. So be patient. Write it down on your desk. Be patient and spell it P-A-Y, because patience pays. Patience is a virtue in life. In trading, patience is a triple, uber virtue. It took me a while. I was a floor guy. So long-term trade for me was, 4 seconds after non-farm payrolls came out. That was a long-term trade back in the day. But I had to develop from the floor trading mentality to the screen. It took a while. A lot of very successful floor traders own pizza parlors now, or are driving Uber, or are retired, depending on how good they were as a floor trader. But they couldn't make a nickel from the screen. They were phenomenal floor traders. I know many, many of them. The majority of them could not make money from the screen for whatever reason, but some did. And but patience is very, very important. So whatever you can do to develop it is a good thing, and just know your strategy is going to develop, is going to present many, many good trades. Let me read you one little quote I have on my desk here, which goes along with that question. Every trade that you take outside of your trading plan is an insult to yourself, to the time and effort you put into your trading, and to your self-respect. Right? Every trade that you take outside your trading plan. So if you're going to trade trend lines, forget about Fibonacci or Bollinger Bands for now. Or forget about MACD. I mean, getting back to that, learn and trade one strategy. Don't be a jack of all trades and a master of none. Get good at one thing, whether it's trend following or gaps or MACD or whatever. Get good at it.
All right, very good. Do you have a Twitter? Do you twit?
Yeah, at TLB. At TLB. TLB is Trendline Break. I think it's at TLB Trader. At TLB Trader.
And I think ours is at MetaStock, if that's what you're looking for, future reality. Okay, very good. Thank you, Dan. I appreciate it. Have a good
My pleasure, Jeff. Always a pleasure. Thank you so much. And again, hope everyone got a good nugget out of it. And stay in touch and on Twitter or email me. And I'm looking forward to the next one, Jeffrey. Thank you so much.
All right. Thanks for coming. We always love to talk about trend lines. All right, very cool. Let's go ahead and do this. And we'll just kind of wrap up real quick. Oops, no. Let's do this. Thanks, Dan.
Thank you.
All right, very cool. Oh, I'm turning this back on, too. All right, cool. Oh, my hair did get kind of messed up. Greg wasn't wrong. All right, very cool. I do want to say thank you one more time to AAII and Stocks and Commodities Magazine for sponsoring the events today. Appreciate it. The sponsorships and kind of the work that they do with us is really good to see them. So if you're watching on YouTube and you want to get a free issue of Stocks and Commodities and another bunch of really good bonuses, go to metastock.com/Trader Summit. For everybody, I want to say special thanks before we wrap up to all of the presenters today, the speakers, the partners that we've had over the years. I love all of you guys. You did a great job today, and I think this was a really good session. I wouldn't say any of the sessions we had today sucked. They were great. So I want to say thank you for everybody that came in, worked with us over the years, worked with us today. And if you're coming and you watched, I want to say thank you for coming. Thanks for, if you're watching on YouTube, liking and subscribing. That helps a lot. But I really do appreciate all the support that we've had with these events. I will draw your attention to our Traders Summit Action Pack again. It includes that brand new update to Steve Bigelow's Candle Profit Systems, the Steve Primo strategy, Ray Rondeau's Conviction Plus, the Around the Horn, the training that is done by Oscar Carboni. What a great session called Trend Lines and Training, 3 months of a premium subscription to learnmetastock.com and Unleash the Power of MetaStock. And so normally that entire package would be about $4,000, $3,987. Here today, you can get it for just $2,344. And you can do that at metastock.com/summit deal. You can still give us a call, 800-882-3040, or you can visit us online at metastock.com/saleschat. If you don't do anything else today, try out MetaStock. There's a reason that it's been rated #1 in its price category for 30 years in a row. And you can get a 3-month subscription for as low as $23 a month. So get in touch with us, 800-882-3040. It's great at scanning. It's great at testing, all of that kind of stuff. So I wouldn't trade without it. metastock.com/sales-chat, 800-882-3040. Big thanks everybody again for coming. I appreciate it. Thanks to all of our presenters today. And make sure to hit that like and subscribe if you're on YouTube right now. And that way you can see other great sessions like this again in the future. So much, much, much appreciated. Thanks everybody. We'll see you again soon.
Hi, Kelly Clement here from MetaStock. Before you go, I have two quick things for you. One, thanks for joining us today. We love having you here at our webinars and viewing our videos. So what I'd like to invite you to do before you go is like and subscribe. Like the video, subscribe to the channel. It helps us a great deal and it helps us bring you more awesome content like today's video. The second thing is we have a great ebook on trading that you can get for free. If you go to metastock.com/YouTubebook, you can get a free copy of The Secrets of Successful Traders. It's a great book with lots of content from traders just like yourself who can teach you some of the secrets that they have learned. Thanks for taking a second with me and learning about those two things. Thanks for joining us and keep on trading.